Welcome back to the deep dive. Our mission here is always the same. We take a stack of your critical source material, the articles, the research, your private notes, and we turn it into powerful, distilled knowledge, giving you a serious shortcut to being well-informed.
And today we are diving into something I know is a huge pain point for so many people in the corporate world. We're talking about the finance function.
Specifically, we're on a mission. This deep dive is all about how to transform a traditional, maybe even struggling finance team into what the source material calls a future-ready powerhouse.
Yeah, and if you're a CFO, a controller, or anyone on a finance team who feels like you're just perpetually stuck in the mud, this is for you. We're talking about those long hours drowning in spreadsheets, always playing catch-up.
It sounds familiar to a lot of people, I'm sure.
Oh, definitely. So we're going to lay out a blueprint, really. It's both philosophical and practical, with some very concrete benchmarks to aim for.
And the urgency here is a big theme. The sources are pretty blunt. They don't talk about small tweaks. They use phrases like a burning platform.
They do. The argument is that many of the processes we take for granted in finance are, and I'm quoting here, well and truly broken.
Wow. Okay, so this isn't about incremental improvement.
Not at all. It's a fundamental rethink. We're going to be drawing on lean philosophy, that revolutionary model from manufacturing, and applying its rigor directly to the accounting world.
And we're also bringing in some heavy hitters from management theory.
That's right. We'll be looking at the management wisdom of some true giants, specifically the ideas around leadership and courage from Peter Drucker and the, frankly, radical way Steve Jobs challenged the status quo.
Okay, let's jump right in. This term, future ready. It sounds good, but what does it actually mean? What are the tangible traits of this new kind of finance team?
The sources break it down into 4 key characteristics. The first is that they have to be fast and light on their feet. This is about reacting in real time, not, 3 weeks after the month is closed.
So speed is paramount.
Speed and agility, that's the second point. They have to be nimble, always looking for and using world best practices. They aren't satisfied with how things were done last year just because, say, the auditors were happy with it.
And technology has to play a huge role here, right? We can't be nimble if we're stuck on old systems.
Absolutely. The third trait is being an advanced adopter of leading-edge technologies. This is about finally moving past what one source calls the spreadsheet epidemic and into robust, integrated systems that give you a single source of truth.
Okay, speed, nimbleness, tech. The fourth trait, though, that one really gets to the human element, which I feel is so often missed in these big transformation projects.
I agree completely. The fourth trait is that they have to embrace modern people practices. This is absolutely crucial for retaining your best talent.
So it's about more than just efficiency. It's about making the work meaningful.
Exactly. It's about recognizing that the long hours, the endless reconciliations, the tedious, repetitive data entry, these are what sources call ill-conceived management practices. They're the things that burn out your best people and push them out the door.
So a future-ready team focuses on what? What's the alternative?
The alternative is value-added advisory work. It's giving your staff fulfillment and a sense of ownership. It's about making that shift from being a reactive historian, just reporting on what already happened, to being a proactive advisor, helping the business make better decisions about the future.
That distinction is so powerful. Reactive historian versus proactive advisor. That's really where this performance gap that we hear so much about seems to live.
It's the core of the problem, because for so many organizations, that platform really is on fire. You see these brilliant, talented people working incredibly long, frustrated hours with systems that are just antiquated and, frankly, prone to error.
And it's not just the systems, it's the mindset, isn't it? The sources mention this adherence to procedures just because, and I love this quote, they were carried out last month.
And that is the very definition of waste. It's doing something without questioning its value. The sources are clear. The whole traditional toolkit, the massive KPI decks, the painfully slow annual planning cycle, standard forecasting, the agonizing month-end and year-end reporting, it's all severely flawed.
And the argument is that maybe these processes never even worked that well to begin with.
That's the provocative idea, yeah. They may never have provided true strategic value, but they've just persisted because of inertia and, I think, a real fear of change.
And look, this isn't just a feeling or anecdotal frustration. There's hard data that proves this disconnect. The 2015 IBM Global C-Suite study really laid it bare, right? This gap between what CFOs want and what their teams can actually deliver.
It did. The IBM research was fascinating. It found that CFOs had two massive future-focused priorities. Number one was to identify and track new revenue growth opportunities. That's pure strategy.
Looking forward.
Completely. And number two was developing talent within the finance organization, which speaks directly to that modern people practices point we just discussed. These are high-value, forward-looking activities.
But the reality on the ground, what the teams were actually capable of, was a very different story. What did the study identify as the single biggest skill gap?
The single biggest skill gap was the ability to integrate information across the entire enterprise. Now, just stop and think about that for a second.
That's huge.
It's everything. The CFO wants to be a strategist, finding new revenue, developing people, but their teams can't even efficiently gather and harmonize the basic data required to even start thinking about those things. They are stuck, completely bogged down in the operational weeds, unable to look up and see the horizon.
So that data integration gap, that's the anchor holding them back.
It's the structural failure that keeps the entire function tethered to the past. And you can't be future ready if you're chained to yesterday's data problems.
Okay, so that failure to integrate and focus on the future, it's the perfect lead-in to our first section. We need to trace the roots of these bad habits. To understand why finance is so stuck, the sources say we have to go back in time, more than 100 years actually, all the way back to the Model T.
Yeah, the Henry Ford analogy is so important to understanding this. When Ford famously said you could have any color as long as it is black, he was describing a world of commerce built on simplicity, standardization, and massive production runs.
A much simpler world.
Much simpler. If you only make one thing, your capacity planning is relatively straightforward. You estimate your sales for the year, you work out your inventory, and you know your total fixed production capacity. It's a very linear process.
And in that era, you didn't need real-time data. A slow month-end process was fine because things didn't change that fast.
Exactly. And the accounting textbooks from that period, like the famous one by Horngren, Cost Accounting, they embedded a worldview, a view of costing, budgeting, and overhead allocation that is now, today, diametrically opposed to modern ideas of speed and efficiency.
So that industrial mindset is what installed these bad habits that are still with us today.
It installed what the source material calls the 9 self-inflicted punishments. These are 9 deeply damaging habits that modern finance teams have to aggressively, purposefully abandon. If we want to get future ready, we first have to stop doing the things that are actively hurting us.
Okay, let's spend some real time on these 9 because I think a lot of our listeners will recognize them instantly. They're the ballast holding the whole ship down. Habit number 1, treating direct labor costs as a variable cost.
This is such a classic historical hangover. We're running these complex modern businesses, but we're applying a costing assumption based on like Victorian-era labor practices.
Well, you could hire someone for a day and then let them go.
Exactly, a time when staff were hired and fired on a daily or weekly basis. But today, in 2024, our skilled staff is a fixed cost. You don't hire a trained production line worker on a Tuesday and then lay them off on Wednesday because volume dipped by 5%.
Of course not. So what's the actual harm of holding on to that outdated assumption? Why does it matter so much?
Because it completely distorts your performance analysis. It sends all the wrong signals to management. If you treat labor as variable, you get these traditional reports, like an unfavorable labor efficiency variance.
Right. And management sees that and immediately thinks the supervisors need to crack the whip or the assembly line is inefficient.
Precisely. You start trying to solve the wrong problem. In reality, the cost is fixed, so the only truly relevant analysis is capacity utilization. Are we getting the most out of this fixed resource we've invested in? By miscategorizing the cost from the start, the system points you in the wrong direction, leading to bad decisions about everything from hiring to capital investment to pricing.
Okay, that's a big one. Habit number 2, artificially transferring operating costs to the balance sheet, specifically absorbing as many fixed overhead costs as possible into work in process and closing stock.
Ah, yes. The classic way to, shall we say, manage your period-end profits. By absorbing fixed costs like factory rent or depreciation into the value of your inventory, you're effectively pushing this period's expenses into the next period.
So you make this month's profit and loss statement look better.
It looks great for a month, but you're just kicking the can down the road. The finance team is essentially guaranteeing that the next accounting period will start with a bloated, inaccurate inventory valuation. The sources call it a blowout waiting to happen.
And the consequence of that isn't just a one-time profit bump, is it? This has to have a ripple effect on strategic planning for years.
It has a massive ripple effect. It creates a complete lack of transparency into your true cost of goods sold. So when management comes to you and asks, which product lines are most profitable? Which should we cut? You're giving them an analysis based on figures that have been distorted by these transferred fixed costs.
So you're sacrificing long-term strategic insight for a short-term superficial profit number.
That's it in a nutshell. It's a terrible trade-off.
Okay, bad habit number 3. This one is about being wedded to complexity, installing one complex system after another, always chasing the perfect measurement.
This is the siren song of precision. Think about that endless cycle of projects. Implementing hyper-detailed timesheet systems, overly complex work order tracking, or, the big one, diving headfirst into activity-based costing, ABC.
ABC is a classic example. In theory, it sounds amazing, perfect cost allocation.
In theory. But in practice, it often demands this enormous data collection overhead. The effort to gather all that data far outweighs the marginal benefit you get from a slightly more granular cost number. Finance teams get seduced by the promise of detail, but the reality is they end up installing more administrative overhead, which just creates more waste. It becomes complex for the sake of being complex.
Which flows perfectly into habit number 4. Excessive detail in general. Specifically, having a massive chart of accounts with, say, 200 or more account codes just for the P&L.
A massive chart of accounts is a self-imposed obstacle course. If your goal is speed and strategic clarity, it's one of the first things you have to attack. Every single extra code you have introduces friction and increases the probability of error.
Because people just get lost and start putting things in the wrong bucket?
Constantly. Miscoding becomes rampant. And then your team has to spend hours at month end correcting entries that should have been simple in the first place. The truth is, the level of detail you actually need for high-level P&L reporting rarely exceeds 50 categories. Anything more than that is just administrative noise that doesn't illuminate anything.
Number 5 is the one that causes so much pain. The painfully slow month end, all driven by this pursuit of the perfect number.
This is one of the most frustrating sources of waste for finance professionals. We burn countless hours, late into the night, arguing over minor accruals or reconciling immaterial variances. We're chasing a level of precision that is ultimately meaningless for decision-making.
The standard isn't perfection, is it?
No. The principle of financial reporting under both GAAP and IFRS is to provide a true and fair view, not a perfect one. Think about the trade-off. The difference between a true and fair number delivered on day 1 versus a so-called perfect number delivered on day 10 is 9 days of lost management decision time. You've held back vital information and burned out your staff in the pursuit of a perfection that doesn't even exist.
And that slowness inevitably rolls into habit number 6, the slow year-end. Spending the first 3 months of the new fiscal year just endlessly adjusting that month 12 number to satisfy the auditors.
This is the definition of a wasteful cycle. The sources point out something that I think everyone in finance knows in their gut. Often, after months of agonizing adjustments and reconciliation work, the final audited number lands within, say, 5% of the initial quickly generated month 12 report.
So you've gone full circle.
You've gone full circle after wasting a fortune. You've immobilized your most strategic finance people for an entire quarter. You've burned immense organizational effort, all to confirm what you essentially already knew on January 15th. It's just monumental inefficiency.
Habit number 7 is the modern scourge, the spreadsheet epidemic. A spreadsheet for everything, which guarantees you'll have multiple versions of the truth. I don't think there's a single finance professional listening who doesn't have a horror story about a VLOOKUP fail that cost them a weekend.
We all have that trauma, and that emotional attachment, that reluctance to let go of the manual control Excel gives you is disastrous at an organizational level.
Why is it so bad?
Because whenever you have a critical process like forecasting or consolidation relying on these complex multi-tab spreadsheets, you inevitably introduce divergence. Version 1A gets emailed, someone makes a change and saves it as version 1A final, then someone else updates the original. It's chaos. Different versions of the truth spread like a virus, making data consolidation impossible and management certainty a fleeting dream.
So the rule should be?
The rule has to be that large spreadsheets, the sources say anything over about 100 rows, are liabilities, not assets. They are a signal that you have a broken process that needs a real system solution.
Okay, number 8. Maintaining the annual planning disaster, believing that this time, after last year's fiasco, it will magically be better, quicker, and easier.
This is the operational definition of management insanity, right?
Okay.
Doing the same thing over and over and expecting a different result. We pour unfathomable resources, time, intellectual energy, political capital into a process that everyone hates, which rarely produces a strategically robust outcome and is often completely obsolete 3 months into the new year.
It's a massive input for a minimal real-world output.
A huge input.
Yeah.
And it is absolutely ripe for the kind of aggressive abandonment we're going to talk about later with Peter Drucker.
And finally, number 9, calendar blindness. The blind adherence to Julius Caesar's calendar.
It sounds funny, but it's a real issue. A standard calendar means your month-end closing dates are always shifting. You might close on a Tuesday in January, a Friday in February, a Sunday in March. That lack of standardization makes your month-to-month, even year-on-year comparisons inherently difficult. It forces you to make manual adjustments for working days, holidays.
So what's the alternative?
The sources strongly advocate for at least exploring the benefits of a reporting cycle based on 4 or 5-week months. That way, every period ends on the same day of the week. That predictability and standardization dramatically improves your process flow and the comparability of your data over time. So, these 9 habits, they aren't just minor irritations. They are deep systemic flaws that are actively preventing the finance function from ever reaching its true potential.
So we've spent a good amount of time detailing this,
Mm-hmm.
this weight of history, the systems, the habits, the beliefs that are holding finance back. And that situation you've described, the slow month end, the endless planning cycle, it really does sound like a catch-22. It's this absurd, senseless routine that there's seemingly no escape from.
It is a self-imposed trap. And the only way out is not to try and work harder or faster inside the broken trap. The only way out is to aim for concrete, transformational benchmarks that force you to break the trap itself.
So you need a new destination to aim for.
Exactly. We have to create the time for change, and that time is currently buried under all that waste we just talked about. We find it by adopting the specific, aggressive targets set by the lean finance movement. These benchmarks give us a timeline for radical speed and transformation.
Okay, let's get into those specific goals. Let's start with the most immediate and painful process for most teams, the month-end accounts. What does the lean standard look like for closing the books?
The framework sets 3 distinct goals, each more aggressive than the last. The immediate goal, and this is for your very next month-end close, is a fast close by day 3 or less.
Day 3. That alone would be a revolution for many organizations.
A huge revolution. And it requires immediate discipline. It means you have to ruthlessly cut out that search for the perfect number we talked about. But that's just the start. The intermediate goal, something to aim for in the next 12 to 18 months, is reporting by the close of the first working day.
Day 1 reporting. So the board gets its numbers the day after the month officially closes. That requires a fundamental shift in how you work, doesn't it? It's not just about doing the old process faster.
It's impossible with the old process. It demands what's called continuous flow and a high degree of automation. We'll touch on that when we discuss the 8 wastes. But even that isn't the final destination. The most aspirational target, the long-term goal to achieve inside of 3 years, is true virtual reporting.
Virtual reporting. What does that mean in practice?
It means you're reporting key metrics like net profit intra-month. The system is constantly feeding key indicators and profitability measures to management in near real time. The month-end close becomes a non-event. It's just a formality, a snapshot in time, not this big discovery process where everyone finds out how the month went for the first time.
That's a massive philosophical leap from waiting 10 or 15 days just to get a closed book.
Yeah.
Okay, what about year-end accounts? The auditors are so often the bottleneck there. How do you possibly force speed into that process?
This one requires a really clear, committed mandate right from the top. The benchmark is to commit the entire ecosystem, the auditors, the finance team, the board, and the executives, to achieving a final signed set of annual accounts in only 15 working days.
15 working days.
3 weeks. 3 weeks from the fiscal year end. And what this does is it forces the entire organization to streamline everything. You have to pre-clear complex accounting issues with the auditors in November, not February. You have to streamline how you gather evidence. And you have to abandon all those unnecessary time-consuming adjustments that add only marginal value but take weeks to finalize.
Let's go back to the annual planning process, that disaster we identified earlier. How do we apply lean thinking to transform that?
The initial benchmark is to produce the entire annual plan in less than 2 weeks. And you do that by using a rolling planning exercise as your foundation, which we'll detail in the final section. But The ultimate target, the true act of abandonment here, is to drop the annual plan entirely.
Ooh, okay.
Yeah.
Drop the annual plan completely. Our board, our lenders, our shareholders, they often rely on that single massive document for their forward guidance and compliance. How do you replace that without causing a serious revolt?
That's the leadership challenge, isn't it? You don't just take it away, you replace it with something far superior. You replace it with a quarterly rolling planning process. A forecast that continually updates to show the next 12 or 18 months is intrinsically more accurate and more responsive to real-world market conditions than a static budget that was created, 6 months before the year even started.
So you have to sell them on the idea that faster, more current information provides greater security and better decision-making capabilities than the old, comfortable, thick binder.
Exactly. You're replacing volume and inertia with accuracy and speed. It's a better product.
What about key performance indicators, KPIs? So many organizations suffer from what you could call KPI overload.
The lean benchmark for this is simple and powerful. It's called the 10-80-10 rule. The organization should work with no more than 10 strategic KPIs across the entire company.
Total.
10 total. That's for the board and the executive team. Now, any remaining operational measures, and there might be, say, 80 of them, they need to be strictly renamed. They are not KPIs. They are operational metrics. This is critical to eliminate the noise and focus leadership's attention.
10 KPIs. That seems almost brutally restrictive for a big, complex, multinational organization. Is there a danger you might miss some vital operational detail by shrinking the list that severely?
The danger is only there if you confuse measures with indicators. Those 10 KPIs are the top-level strategic levers. The other 80 operational measures, they don't disappear. They still exist. They're just managed further down in the organization by department heads and their teams. But the board's focus, the C-suite's focus, must be limited to those 10 critical items. If everything is a key priority, then nothing is a priority.
Okay, that makes sense. We talked about the spreadsheet epidemic. What's the hard benchmark for technology adoption to fix that?
The rule is simple and uncompromising. All large critical spreadsheets, and we're defining that as anything over 100 rows, especially those used for forecasting and consolidation, must be replaced with a robust modern system. This means investing in specialized planning and reporting tools that enforce a single source of truth and eliminate the chaos of manual spreadsheet jockeying.
And finally, fixing that bloated chart of accounts.
The target here is radical simplicity. You need to get to less than 50 account codes for the profit and loss statement. We've seen that anything beyond that level of detail is just unnecessary overhead. It increases the risk of miscoding and slows down every process from data entry to reconciliation.
When you put all these benchmarks together, it's clear they would fundamentally change how a finance team allocates its time and energy. The source material has a chart, Exhibit 1.2, that compares a non-lean team to a lean team, and the shift in workload is just staggering.
It is a total reversal of priorities. A typical non-lean team's time is absolutely dominated by annual planning, budgeting, and monthly reporting. They are, by definition, focused backwards on what has already happened.
They're historians.
They're historians. In a lean structure, the work shifts dramatically. The goal is that 75% of the finance team's time becomes dedicated to being future-focused.
And that's 75%. That's what the sources call advisory time. This is the real prize at the end of the transformation, isn't it?
It is the ultimate value unlock. This newly freed advisory time is what allows the team to stop being scorekeepers and start adding real, measurable value to the business.
What does that look like in practice?
It means they can provide timely support to the business units on strategic pricing, on capital project analysis, on competitor intelligence. It means they finally have time for selling and leading change internally, like implementing those new systems we talked about and driving automation projects. They have the bandwidth to lead the entire organization in the battle against waste.
And having that advisory capacity, that space to think, allows for the adoption of more profound lean practices that go beyond just accounting rules.
Exactly. When you are no longer chasing the perfect number until midnight on the 10th of the month, you have time to introduce powerful methodologies. Things like post-it re-engineering to map and improve your workflows, or implementing project management disciplines like Scrum or Kanban to manage finance initiatives, and just holding effective action-oriented meetings instead of endless status updates.
So the end result isn't just a more efficient company.
The end result is a happier, more fulfilled finance team, a team that's doing rewarding strategic work instead of tedious, error-prone data entry. That's how you attract and retain A+ talent.
So these benchmarks give us a clear destination, But now we need the vehicle, the philosophy that's going to get us there. That moves us into section 3, where we focus on the lean movement itself and this core idea of eliminating the 8 wastes.
Right. And this movement is, often credited as this Japanese process that was responsible for the incredible rise of their multinationals from the 60s through the 90s. But its intellectual roots are actually deeper.
They go back to the U.S., right?
They do. The real foundation of lean comes from principles established by American writers and statisticians like W. Edwards Deming. But its practical application was undeniably perfected by the Toyota production system. And while lean has been standard practice in manufacturing for decades, lean accounting is a much more recent discipline. It's only really been gaining serious traction since about 2004.
And there are some key pioneers who really led that charge, who successfully translated the logic of the factory floor into the world of the general ledger.
We absolutely have to recognize people like Jeremy Hope, Brian Maskell, Gene Cunningham, and Francis Kennedy. They were the ones who pioneered this idea that the same relentless rigor you apply to a physical production line, ruthlessly eliminating every non-value-added step, could be applied to the abstract flow of financial data.
And the key message for our listeners is that they have to get up to speed on this, and fast.
It's imperative. Most corporate accountants are, of course, aware of lean's impact on production, but very few truly understand the profound implications it has for their own function. The sources suggest that CEOs are catching on to lean accounting very quickly. It's becoming a hot topic, and soon they're going to start asking their CFOs some very pointed questions about it.
So it's unavoidable. And the core of lean, whether you're making cars or closing the books, is this systematic elimination of waste. The original Toyota concept identified 7 wastes, but modern application, especially in knowledge work, usually extends that to 8. Let's apply them directly to an accounting function.
Okay. Waste number 1 is overproduction. In a factory that's making more product than the customer needs right now, creating excess inventory.
And in finance?
In finance, overproduction is our reports. Our reports are too large, they're too detailed, and they're produced too frequently. We generate a 50-page monthly reporting pack because the system can do it, not because the internal customer, the manager, actually needs or consumes that level of a detail. We create information that just sits in an inbox, undigested. That's overproduction.
Okay. Waste number 2, waiting. Idle time when resources are just sitting there waiting for the next step.
Waiting is absolutely rampant in a non-lean finance department. It's the whole concept of processing transactions in batches, waiting until the end of the day or the end of the week to process a stack of accounts payable or accounts receivable invoices. It's the hours or days a transaction just sits idle. And of course, it's the massive amount of waiting time that's baked into the month-end process, waiting for data feeds, waiting for approvals, waiting for the system to run a report.
Number 3, transportation. In a factory that's physically moving materials or products around unnecessarily.
In our digital world, transportation is the constant manual shuffling of information. Think about it. If a critical piece of data, say the justification for a large accrual, has to be written in an email, sent to a manager for approval, then forwarded to a director for a second approval before it can finally be entered into the system. All of those handoffs, that movement of information, is pure transportation waste.
That should just be an automated workflow.
It should be, but in most places it isn't. Next up, extra processing. This is adding complexity or features that the customer, internal or external, doesn't actually value.
We've touched on this already.
We have. It's everywhere in traditional finance. It includes the unnecessary complexity within that bloated chart of accounts. It's all the arcane, complex steps that have been added to the year-end close or the annual planning process over the years that don't actually help a decision maker. They just serve some historical or bureaucratic purpose. It's when we process data 3 different ways, just to be sure. That's all extra processing.
Waste number 5, excess inventory.
So beyond the physical boxes in a warehouse, the key accounting manifestation of this is that absorption costing distortion we detailed earlier. Pushing current period fixed costs into the value of next period's inventory. This creates a financially false excess inventory situation on your balance sheet, which misstates performance and distorts all your key metrics like working capital and inventory turnover.
Number 6, waste of motion. The physical movement of workers that adds no value to the product.
In an office setting, this translates directly to searching for information. It's the disorganized shared drive where no one can find the final version of a contract. It's the cluttered desk where a critical receipt is buried. It's the inability to quickly locate a specific policy in the digital filing system. Finance teams need a serious makeover in, kind of, time and motion studies, focusing on standardized, disciplined, organized filing protocols so that finding any piece of data is instantaneous.
Waste number 7, defects, scrap, and rework. This is about having to do things over again because they weren't right the first time.
This is the rework cycle that kills so much productivity. It's the generation of all those complex proprietary spreadsheets with a, quote, dubious function that are only completed because they were completed last month. This often requires these elaborate inspection steps, manual reconciliations, line-by-line checks to overcome a fundamentally flawed process or a poor system design. All that time spent correcting and recorrecting is pure defect waste.
And the final waste, number 8, which is potentially the most damaging of all, unused employee creativity.
This is when your own bureaucracy crushes innovation. When your employees have great ideas, suggestions for automation, for process redesign, for system improvements, but those ideas face layers of obstacles and approvals before they can ever be adopted, you are wasting your single most valuable resource, their intellect and their passion.
The benchmark for this from Toyota is just stunning.
It's mind-blowing. Toyota's benchmark is 10 innovations implemented per team member per year. Now, just imagine that within a finance function. Most organizations are orders of magnitude away from achieving that level of adopted creativity from their people.
And the scale of all this waste combined is what should truly shock every leader listening to this. Dr. Jeffrey Leiker's research noted that most business processes are 90% waste and 10% value-added work. 90%.
You really have to pause and let that number sink in. 90%. If your team is working a 50-hour week, Leiker's research suggests that 45 of those hours are spent on non-value-added activities. Things like reconciling 5 different spreadsheet versions of accounts receivable or manually chasing down signatures for expense reports.
And the potential for improvement is just as massive.
It is. Leiker highlighted that Boeing, by adopting these lean principles, was able to reduce over 1 trillion internal transactions. 1 trillion. That is the true scale of the opportunity that comes from systematically eliminating these 8 wastes in a corporate structure.
And the philosophy that drives all of this is encapsulated in those foundational principles from Toyota.
That's right. Jeffrey Leiker, in his book The Toyota Way, broke their 14 principles down into 4 simple categories. There's philosophy, which is all about long-term thinking, not short-term gain. There's process, which is that relentless elimination of waste and focusing on flow. There's people and partners, which is about respecting, challenging, and growing every single team member. And finally, problem solving, which is about continuous improvement and constant learning.
And these aren't just for a car factory.
Not at all. They should be the core operating principles embedded in every part of an organization, and that absolutely includes finance.
So the mandate is crystal clear. Go find and eliminate that 90% of waste. But to do that, you have to first have the courage to let go of the procedures that generate the waste in the first place. This leads us directly to Section 4 and the leadership of abandonment, leveraging the incredible wisdom of Peter Drucker.
And the psychological barrier to this is just immense. In both our work and our personal lives, we have this deep-seated fear of admitting we made a mistake. We often cling to something just to avoid loss of face.
The sources use a great analogy for this: the unused exercise machine in your garage.
It's the perfect analogy. You keep it, even though you know you'll never use it, because throwing it out means finally admitting that the initial investment of your time, your hope, your money was flawed. And that's a hard admission to make.
And in a business context, that translates to holding on to a legacy IT system or an ill-conceived project, maybe because you were the one who championed it 5 years ago.
Or just because the previous CFO implemented it and no one wants to question their legacy, it creates this institutional paralysis. And this is precisely why Peter Drucker, who many consider the Leonardo da Vinci of management, defined abandonment as one of his greatest gifts to management thinking.
His genius was in reframing the question, wasn't it?
Completely. He would say, don't tell me what you're doing, tell me what you've stopped doing.
That is such a profound shift in perspective. If you can't abandon yesterday, you can't possibly have the resources to fund tomorrow.
That was Drucker's core point. Innovation doesn't just need new resources, it needs released resources. He wrote that, without systematic and purposeful abandonment, an organization will be overtaken by events. It will squander its best resources, including its most talented people, on things it should never have been doing or should no longer do.
Which is exactly what's happening when your finance team is spending 75% of its time looking backwards.
Their resources are trapped in the past. So applying this directly to finance means you have to start systematically stopping all those reports, all those reconciliations, all those procedures that only exist because it's the way things have always been done, and nobody has had the courage to ask why we started doing it in the first place.
It requires a profound commitment from leadership to challenge those historical rules.
It does. When a junior accountant asks, why do I have to generate this 5-page variance report for the regional manager every single Tuesday? The answer can no longer be, I don't know, there must be a reason, just do it. The answer has to become, that's an excellent question. Let's investigate the value-added component of this report right now and decide if it should be abandoned.
So how do you operationalize a philosophical shift like that? How do you make abandonment a real, mandated, measurable activity in the organization?
You have to formalize the process. The sources give an example of one organization that successfully held abandonment meetings at every management level on the first Monday of every single month.
A dedicated time just for stopping things.
A dedicated time. But given the urgency and the depth of the waste that's typically found in finance, the recommendation for our listeners is even more aggressive. It's to meet once a week for the specific purpose of discussing and actioning at least 2 processes or reports that can be abandoned immediately.
That requires serious leadership and conviction from the CFO. It takes real courage to sign off on stopping a process that might have been considered standard practice for decades.
It absolutely does. But the relief it gives the finance team is immediate and powerful because it stops the past from constantly haunting the future. The CFO has to be the champion of this movement. They must demonstrate that asking the question, is this truly adding value, is far more important than avoiding loss of face.
And of course, if we want to ensure this becomes part of the culture, we have to measure it, just like any other strategic initiative.
Of course. You get what you measure. The source material suggests making the frequency of abandonment a key performance indicator, an abandonment KPI that literally measures the number of processes or reports that were successfully eliminated across the organization last week.
And if the CEO is actively tracking that and praising the teams with the highest number of abandonments,
then you force cultural change incredibly rapidly. It incentivizes and empowers everyone to look for waste everywhere.
Okay, so Drucker's courage in abandonment. It links perfectly to our next section, Section 5, which is about challenging the status quo. And this is personified by the genius of Steve Jobs.
It's a perfect connection.
But before we get to the Jobs anecdote, the sources make this fascinating and pretty stark comparison between modern corporate finance and the medical profession.
It's the leeches analogy.
Yeah.
And it's a powerful one. The argument is that if surgeons operated with the same adherence to historical practice as corporate finance often does, we'd still be relying on bloodletting to cure illnesses.
That's a strong statement.
It is, but think about it. Now, specialized modern medicine does occasionally use leeches for very specific things, but the medical profession as a whole aggressively seeks out and adopts breakthrough procedures. Surgeons go to conferences, they train on new technology, they adopt new techniques on a monthly basis. CFOs, who are supposed to be the surgeons of corporate financial health, are often so consumed by that financial catch-22, the month end, the budget, that they miss all of these breakthrough conferences. They just keep clinging to the old ways.
And Steve Jobs, when he was reflecting on his early career, had this amazing insight into why businesses tend to perpetuate these broken processes.
He did. Even as a young millionaire, Jobs realized that most business practices were actually shockingly straightforward. But he also saw that very few managers ever stopped to think deeply about the why behind what they were doing. They were just following the instructions that had been passed down to them. And that blind reliance on received wisdom is what he always sought to shatter.
And he had a very famous, very direct confrontation with this kind of antiquated accounting practice early on at Apple.
Yes, this is a classic story. When Apple established its first computerized factory to build the Apple II, the finance team, as you'd expect, issued the standard costing report. And Jobs, who was always the iconoclast, asked the accountant a very simple, very powerful question. He said, why do we have a standard cost? Why don't we just use the actual cost?
And the accountant's reply was the classic, unthinking defense of the status quo that every finance professional has probably heard 1,000 times.
That is the way it's done.
The ultimate conversation stopper.
But not for Jobs. He realized that the way it's done was actually just a cover story for a technological failure.
What do you mean?
He saw through the philosophical defense, and he realized the real reason they used standard costing was because the old accounting system simply could not record and report actual costs quickly enough to be useful. It was a technical limitation that was being disguised as a methodological standard.
So once the technology was fixed,
The whole justification disappeared. Once the system was upgraded and that technological bottleneck was removed, the standard costing reports at Apple immediately vanished. The process was ruthlessly abandoned because the only reason for its existence was gone.
that one anecdote is such a powerful mandate for every single listener to challenge every single process they execute. And the source material highlights a quote from Jobs that they say should be the mantra for every finance team.
It's the ultimate inspiration for critical thinking, he said. Your time is limited, so don't waste it living someone else's life. Don't be trapped into living with the results of other people's thinking. Don't let the noise of others' opinions drown your own inner voice.
And for a finance professional, that inner voice must constantly be asking,
Why? Why are we doing this reconciliation this way? Why are we using this many account codes? Why are we waiting this long for the data? It's about cultivating that deep-seated curiosity and refusing to accept that's how it's done as an answer.
okay, so we have now established a really solid philosophical foundation. We have lean principles, we have Drucker's abandonment, we have Jobs' challenge to the status quo. Now, in our final section, section 6, we have to make this real. We're shifting to practical application by taking on the most notoriously painful finance routine of them all, the annual planning process.
And the goal here is incredibly aggressive. We're aiming to complete the entire process from start to finish in 10 working days or less.
10 days. Okay. This is where we apply all the lessons we've just discussed.
Exactly. And achieving that 10-day goal requires radical simplification and streamlining, particularly of the data input phase. The very first step is to ruthlessly reduce the level of detail you require from all of your budget holders. You have to apply that principle of abandonment to the detail.
So how do we practically streamline that data input phase?
There are 3 key techniques. First, budget holders must budget at the category level, not at the individual account code level. So if your chart of accounts has 200 codes, you hide 190 of them. You force the input to focus on just the 10 or 15 high-level categories that actually matter for strategic planning. This immediately cuts down on the minutia and dramatically reduces the risk of miscoding.
Okay, that simplifies things a lot. What's the second technique?
Second, you forecast the annual plan using quarterly figures, not monthly figures, at least during this initial data entry phase. You literally hide 2 of the monthly columns for each quarter in the input template. This makes the input screen far less burdensome and visually overwhelming for the managers.
That makes a lot of sense. It radically simplifies the task for the operating managers. But a question comes to mind. If we don't plan monthly, how do we get the monthly visibility we need for things like cash flow management?
Great question. The monthly numbers are set in a quarterly rolling process just before each quarter begins. This initial 10-day exercise is purely to establish the annual strategic envelope and the high-level quarterly plan. You are consciously abandoning the incredibly time-wasting exercise of trying to lock down month 7's electricity bill during month 1 of the planning process. It's a fool's errand.
Okay, and the third critical streamlining technique. That one has to target the spreadsheet epidemic.
It does. Wherever it is technically possible, you must consolidate the budget via the general ledger system using modern planning tools instead of relying on a web of external spreadsheets. If you can build the category headings and the budgeting templates directly into your GL or your planning system, you eliminate the risk of multiple versions of the truth and you kill all of that transportation waste.
A 10-day cycle is incredibly intense. The sources suggest that only 3 working days should be allocated for all the budget holders to enter their data. Now, to make that work without descending into complete chaos, every single one of those budget holders is going to need immediate, personalized, one-to-one support.
You're absolutely right. The support model for that compressed 3-day window has to be radically expanded. You simply cannot rely on your core financial planning team of, say, 3 people.
So what do you do?
You have to involve every qualified accountant you have available, even those who are outside the strict finance team. And this has to include the CFO. The CFO should be actively participating, taking calls, and helping budget holders. It sends a powerful message of commitment from the very top.
It's a huge signal. What other resources can you mobilize that quickly?
This is where you have to get creative with resource management. For example, you can ask your external auditors to loan you some of their audit seniors for that 3-day data entry window, especially to help cover remote locations or departments. Audit firms are often keen for their staff to get non-audit experience.
That's a clever idea.
You can also bring in temporary staff who have specific budget system experience. And for the smaller budget holders who just need simple guidance, your senior accounts payable staff are actually ideal trainers because they understand the operational flow of expenses better than anyone.
And for organizations that are spread out across different geographies.
You have to leverage technology. You use Skype, Zoom, whatever virtual meeting tech you have for remote one-on-one training and support sessions. The fundamental requirement is this: no budget holders should be waiting more than 30 minutes for assistance during that 3-day crunch. Total, overwhelming support is the only way to enforce that fast turnaround.
Now, with a process moving this fast, you can't rely on lengthy documentation. We know from experience that budget instructions are rarely, if ever, fully read.
You must abandon the 50-page PDF of instructions. Just get rid of it. Instead, you hold a mandatory, compulsory briefing workshop. Attendance, whether it's physical or via webcasting for your remote staff, has to be enforced. This is the forum where the new streamlined process is introduced, and, most critically, it's where the CEO personally delivers the mandate for change.
Okay, so what are the 3 key non-negotiable messages that the CEO must stress during that workshop?
The first one is fast, light touch. The CEO needs to make it absolutely crystal clear that every single manager must cooperate to meet that 3-day window for data entry. And the language needs to be very direct. Late forecasting, late data submission, or refusing to follow the simplified category structure will be considered a career-limiting activity. This puts serious organizational weight and urgency behind the change.
A strong mandate like that is definitely necessary to overcome years of slow, ingrained processes. What's the second key message?
Help at hand. The CEO needs to stress that total, high-quality, one-to-one help will be provided. They need to explain exactly who is on the support team, how to access them instantly through the virtual platform, and how to use the new, simplified planning tool. They also need to explicitly detail the new process of forecasting by categories and clarify which expense categories have now been automated or are forbidden from manual input. This is all about alleviating the fear that such a tight deadline will naturally cause.
And the third critical mandate: level of detail required.
Simplicity is the key message here. The CEO must state explicitly that a monthly breakdown in the annual plan is now forbidden. That level of detail will be generated just before each quarter starts. They also need to stress that real detail is only required for the most material or strategic categories, like major capital expenditure requests or detailed payroll plans. And crucially, the sales forecast must already be completed and announced before this planning process even starts.
So the budget holders are only planning expenses based on an agreed revenue target, not wasting time speculating on sales.
Exactly. It removes a huge variable from the process. So, by applying Drucker's principle of abandoning unnecessary detail and applying Lean's principles of minimizing waiting time and eliminating extra processing, you can take a process that used to take 6 weeks or more, and you can shrink it down to 10 days. That is the very definition of becoming future-ready.
This has been a true deep dive into both the philosophy and the very practical steps required to transform the finance function. And the big takeaway for me is that becoming future-ready, it's not really about bolting some new technology onto old, broken thinking.
Not at all.
It's about having the conviction to constantly ask Steve Jobs' question, why do we do it this way? And then having the courage to embrace Peter Drucker's idea of systematic abandonment of yesterday's flawed practices.
And the core takeaway for you, for everyone listening, is simple, but it's really profound. The time you need for advisory work, for strategic partnership, for actual innovation, that time isn't missing. It is currently hidden inside that 90% waste that's inherent in your traditional processes. You need to stop looking for new resources and start looking for waste. Identifying and systematically eliminating those 8 wastes is the most direct path of finding that time and completely changing the trajectory of your role and your team.
It really is a systemic and a philosophical change. It's about that shift from being historians to becoming forward-looking strategists.
And that leads us perfectly to our final provocative thought for you to take away and explore. Given that the experts state that 90% of our business processes are waste, what specific non-value-added procedure are you currently performing, whether it's a detailed monthly variance report no one reads, or 5-step sign-off process for a $50 expense just because it was completed last month? And what is the first small, courageous step you will take toward formally abandoning it this week? Think about that one thing, challenge the status quo, and start the change today.
Far too often in the corporate world, we see these massive, well-intentioned initiatives, especially in areas like finance, where teams are trying to embrace lean practices or implement a new ERP system.
Right, or overhaul the annual planning cycle, things that are genuinely needed.
Exactly. And they crash and burn. It feels like such a tragedy of wasted effort and money, and I think critically lost momentum.
It is, and the tragedy is made so much worse by the fact that the underlying technical idea is often completely solid.
That's the frustrating part.
Yeah, I mean, we've seen estimates in our source material that suggest a pretty startling diagnosis here. More than half the initiatives that are declined at the concept stage were simply undersold.
Undersold. Not that they were bad ideas.
Exactly. The sales process, the organizational prep work, it was all, deficient.
That is a staggering statistic. So if you're listening and you're prepping for a major change project, or maybe you've been burned by these past failures and want to make sure the next one sticks, well, this deep dive is your shortcut.
It really is. We're looking for that special set of skills required for selling change, which goes way beyond just presenting the logic.
It's about getting into the deep psychology of organizational transformation.
Our mission today, really, is to distill the psychological frameworks and the precise, practical steps you need for a successful implementation. We are integrating 3 foundational works that, honestly, when you put them together, they just open up a whole new way of rethinking how change happens.
And how you overcome that resistance.
That's the key.
Okay, so we're talking about the 3 pillars of modern change leadership. First up, we have Steve Zaffron and Dave Logan's work on performance in the future and the 3 laws of performance.
A really profound book. Then second, Harry Mills, who guides us on the quiet power of self-persuasion and the aha advantage.
And finally, the big one, the essential time-tested roadmap from John Cotter's seminal work, Leading Change.
So our journey today will first root us in understanding that deep-seated psychology that drives resistance and failure. Then we'll establish that step-by-step Cotter roadmap.
And then finally, we're going to dedicate a good chunk of time to mastering the very specialized techniques you need for selling this vision to the senior management team.
Which is, let's be honest, the earliest and most common point of failure.
That sounds like a plan. If we're going to master the sale and the execution, we have to start at the root of the problem, the fundamental reason people resist.
Right.
And that takes us directly to Zaffron and Logan's work on the concept of the future.
Zaffron and Logan give us this incredible insight into why organizations just get stuck into inertia. And it revolves around something they call the default future.
The default future.
Yeah, and to truly grasp change, you have to understand what this is and why it functions like this. A massive anchor just dragging down every new initiative.
Okay, so let's define it clearly. Is it just pessimism? Or is it something deeper than that?
It's much, much deeper. The default future is essentially what the organization's staff know in their bones is going to happen.
Based on history.
Based on decades of embedded history, yeah. It's the sum of all the systemic failures, the past projects that crashed, the promises that were broken.
All the baggage.
All the baggage. And it dictates the ingrained belief system. So think of a finance team that's had, say, 3 failed attempts to implement a new ERP system over the last decade.
Okay.
Their default future isn't success. Their default future is disruption, cost overruns, and ultimately a return to their complex spreadsheets. They just know that's what's going to happen.
So if that team's default future is, we always miss the month-end deadline, the planning system never works, and management will just pivot back to the status quo in 18 months, then the staff will subconsciously or maybe even consciously sabotage the new thing.
They will. Just to validate that original premise, it's a way of protecting their own prediction and, in a really twisted way, their sanity.
Wow.
They're driven to keep the status quo, even if the status quo is painful and inefficient. You hear that mindset of, I'll just wait this fad out.
I've definitely heard that.
And this leads to the core sort of counterintuitive paradox that Zaffron and Logan came up with. The more you change, the more you stay the same.
How does that work?
Well, if you only apply superficial changes, a new piece of software, a slightly different process, without ever addressing that underlying perception, that default future.
The gravitational pull of it just brings everything back down.
It always will.
So that immediately suggests that the key to real lasting change isn't just a better technical solution.
No.
It's about recreating a new reality in the minds of the staff. It's creating an invented future.
Exactly. And that invented future has to be compelling enough to overcome decades of embedded belief. It must feel real, achievable, and, significantly better than the painful status quo. This concept is the basis of their 3 laws of performance.
Okay, let's walk through those 3 laws, starting with Law 1. That's the connection between performance and situation.
Law 1 states that how people perform correlates directly to how situations occur to them. This is the mechanism, really, for how the default future operates.
How a situation occurs to them. Can you give me an example?
Sure. If staff walk into a new project workshop and the situation occurs to them as, this is just another corporate flavor of the month that will fail in 6 months and I'll have wasted my time.
Then their performance is going to reflect that. Their attention, their willingness to innovate.
It all goes down. And their performance will inevitably lead to that failure. If they perceive failure is inevitable, it will be.
So if I'm the project leader, I can spend weeks perfecting the technical design. But if the staff just see the situation as a threat to their current skills, or as a mandate from some out-of-touch management team, I've already lost.
You've lost. The situation has occurred to them as a negative.
So how do we change that occurrence?
And that's where laws 2 and 3 come in. They shift the focus to communication, to language. Law 2 is about language itself.
And what's fascinating here is that Law 2 states that without language, we wouldn't have a past or a future.
Right. Language is the processing system that allows us to categorize thoughts and process complex ideas beyond, the immediate moment. It lets us build narratives.
The source material has that great analogy.
The cat on the mat.
Yeah, without language, we'd be like the cat on the mat, sunning itself for yet another afternoon. We'd only focus on the immediate.
Reacting to hunger or sun, but without any capability to link a current action to, say, a 5-year strategy.
That immediately clarifies the difference between just reactive execution and real strategic action. Language is what makes us capable of long-term vision, of imagining a future that hasn't happened yet.
Which brings us directly to Law 3. To make change, we must use a future-based language.
This is so crucial.
It is. And this isn't just corporate jargon about synergies. This is about using language that literally transports the listener into that invented future. You have to paint a picture of where the organization is going, not just keep detailing the problems of where it has been.
Okay, let's nail down the practical difference there. Future-based versus problem-based language in a real corporate setting.
A problem-based approach would say, our current budgeting process takes 3 months, it involves 50 people, and has a 12% error rate, which costs the company X amount.
Which is fact-based, but it's heavy. It just reinforces the problem.
Exactly. A future-based language, using Law 3, would say, imagine a world where our planning cycle is completed in 2 weeks. Our senior leaders will have real-time forecasting data, enabling us to capture market opportunities 3 months before our competitors.
We will shift from being reactive historians to strategic foresight partners.
Yes. Spending our time advising the business, not reconciling spreadsheets. See the difference. The first one uses the past to try and motivate, which often just reinforces that default future.
But the second one uses an imagined better reality.
It creates pull. This is why great orators intuitively use this technique. This source even mentions Sir Winston Churchill.
Of course. If you analyze his speeches during the Battle of Britain, he wasn't dwelling on past mistakes or the current losses. His language was relentlessly focused on the future.
When he said, we shall fight on the beaches, we shall fight on the landing grounds, we shall never surrender, he wasn't just describing current military positions.
He was creating an invented future.
Of resistance and ultimate victory, yeah. He was forcing the entire nation to step into that commitment. And that commitment came from internalizing that future, not from just analyzing the depressing facts of the present.
So Zaffron and Logan give us the way we have to escape the default future, and what the invented future communicated through future-based language.
Right.
But if we have thousands of staff, how do we scale that? How do we make sure they all internalize it and reject the status quo?
And that is the perfect bridge to Harry Mills and the whole concept of self-persuasion. Harry Mills' central idea is so simple, but it's transformative. It's that self-persuasion is fundamentally more powerful than direct persuasion.
And this is so critical because, like we just discussed, that default future creates a massive resistance engine inside the organization.
Exactly.
I get the mechanism. If I, as the project leader, stand up and try to directly persuade you that this new system is great, you automatically put up a mental defense shield.
You do. You start questioning my numbers, my agenda, looking for flaws in the argument.
You're trying to find reasons to say no.
That direct approach often triggers resistance, which in turn strengthens the hold of the default future. But if we can structure the conversation or the workshop in such a way that the staff persuade themselves,
If they come to the conclusion on their own,
then that resistance just dramatically reduces. Because when the idea is internal, it becomes self-sustaining. It's no longer my idea, it's their discovery.
this connects beautifully back to Zaffron and Logan. The ultimate goal, then, using Mill's work, is to get the staff to have their own aha.
It's a
And to reject the default future from the inside out, they have to come to the realization themselves. Hell no. We do not want the default future of manual consolidations and late reports anymore.
And that moment of self-discovery, the aha, has a very specific and predictable anatomy. Mills detailed it as a 4-stage journey that every effective change process has to guide people through.
Okay, let's detail those 4 phases, because this sounds like a blueprint for structuring any meeting designed to get buy-in. First, we start with impasse.
Impasse is that essential recognition of the problem. It's the feeling of, I'm stuck, and this current state is just unsustainable.
So this is where you establish the burning platform.
Clearly and without exaggeration, you illustrate the cost and the pain of the status quo. If staff don't see the current situation as an impasse, if they think, yeah, it's painful, but it's manageable, they won't feel the need for a new solution.
You have to show them the 10-year projected cost of doing nothing.
That's how you create impasse. Then you move to the stage that I think is most often skipped in corporate change.
I have a feeling I know which one.
Reflection.
Yes, the necessary mulling period, where the internal thought is, okay, I need to clear my mind and weigh the options.
That is absolutely correct. Corporate environments prioritize speed, right? People are presented with the problem, the impasse, and then immediately pressured for a solution.
What are we going to do about it? Let's decide now.
Mills emphasizes the need for time. Time to process the issue, to let the facts and that future-based vision really sink in and challenge the ingrained beliefs of the default future. You need time to dismantle decades of organizational history.
So if a 2-hour presentation is followed immediately by a vote, you're basically guaranteeing that resistance is still high.
Extremely high.
So what are some specific techniques to build this reflection period into a workshop?
You structure the agenda to force it. Instead of going from the problem straight to the solution, you dedicate time to small, cross-functional breakout groups. And their instruction isn't solve the problem.
What is it?
It's discuss the implications of the problem and discuss the viability of this proposed invented future, you might ask. If we actually achieve this 2-week planning cycle, what's the biggest internal challenge we'll face?
So it gets them wrestling with the idea on their own terms without the project leader dictating the answer.
Exactly. And when that reflection is done right, when they've wrestled with the facts and the vision, it leads to the moment we're all aiming for.
Insight, the aha moment itself.
This is the staff's self-discovery of the solution. The light bulb goes on. And crucially, they connect the dots themselves, which makes the solution feel organic, not imposed.
This insight is the death knell for the default future in their mind.
It is. And finally, that insight has to translate into action. Motivation, the commitment phrase, let's go for it.
That's where the self-persuasion has fully taken hold. They commit to the new path because they realize it is their path to a better future.
And the practical application here for any change leader is to structure your entire engagement strategy, whether it's a presentation or a multi-day workshop, around this 4-stage journey. And the instruction is critical. Avoid dogmatic rhetoric about the facts.
Because facts alone don't drive commitment.
Self-discovery and insight do.
Which means sacrificing speed for depth. The source suggests that a 2-day workshop is often far more beneficial than a quick 1-day session.
It is. That extra time allows the reflection stage to truly work its magic. You have to be patient if you want lasting commitment. Otherwise, you're only getting temporary compliance.
And compliance is cheap and temporary.
But commitment, which comes from self-persuasion, is priceless and enduring. So now that we have the psychology, the why, and the how, we need the practical map to manage all of this across an entire organization.
And that takes us to Cotter.
That's it.
So we have the psychological frameworks, we've got Zaffron and Logan defining the why, the invented future, and Mills providing the how self-persuasion.
Right.
Now we need the step-by-step roadmap for actually executing this. And John Cotter's leading change, even though it was published back in '96, it's still the undisputed seminal work.
It really is. It provides this clear, 8-stage map for real transformative change. And what we need to do is integrate our psychological insights into his practical steps.
Cotter's great contribution was showing that major change isn't a project management checklist. It's a managed process of building momentum.
And that skipping steps is a recipe for, well, catastrophic failure. The process starts by setting the foundation, which is often the most political and difficult part.
Okay, let's start there. Stages 1 and 2, setting the foundation.
Stage 1 is establish a sense of urgency.
And this isn't just about showing a spreadsheet of declining metrics, is it? It requires a dual appeal. You have to hit both the intellectual side, the data, and the emotional side.
The fear of loss, the desire for status, you have to appeal to the whole executive team. And this needs a highly tailored approach, broken down into 2 distinct phases. Phase 1 is the unplanned encounter. You have to be ready to ambush the CEO with a compelling elevator pitch.
So this is about capturing their attention when they're distracted, giving you literally 30 seconds to plant a seed of urgency.
And that sets up phase 2, which is the formal request. You deliver a masterful 15 to 20-minute sales presentation. But its aim is very specific.
What's the aim?
To get permission to run a focus group. That's it. It's not full project approval. It's just buying the next small piece of time. And we'll spend a lot more time on those sales techniques later.
Got it. Okay, moving to stage 2. Create a guiding coalition. This is where you start to really internalize that invented future.
And this stage involves identifying the oracles.
The oracles.
Yeah, these are the crucial individuals that everyone in the organization refers to when they need an answer. They might hold a seemingly unimportant title, a long-serving analyst, an administrator in a key department.
But they're the trusted knowledge brokers.
Exactly. And Cotter and the source materials stress that investing in these oracles is absolutely paramount. They are the human embodiment of the organization's collective intelligence and, crucially, its emotional barometer.
And this is where you bring the psychology into practice. The coalition forms when you present the burning platform, that impasse leading to an overwhelming, shared, and emotional hell no response to the default future.
That shared rejection of the status quo is what drives them toward the alternative you've articulated, the invented future.
I have to ask about the feasibility of this. The source gives this striking case study example of a company that held 3 two-week workshops, so 6 weeks total, just to develop a blueprint for a planning tool.
And the CEO was present for part of each of those 6 weeks.
How on earth do you justify 6 weeks of that kind of intense focus?
You justify it by calculating the cost of failure. 6 weeks of intensive engagement from 20 of your best people is nothing compared to a failed multi-million-dollar system implementation.
That's a good point.
And the key purpose of that time was to channel the wisdom of the oracles. The facilitator didn't lecture. They used Mill's techniques, creating impasse, enforcing reflection, to draw out the organization's existing knowledge. They essentially co-created the blueprint.
So the oracles became the authors of this solution, which guarantees their buy-in and cuts down resistance from day one.
Exactly. Once that foundation is set, you move into building momentum. That starts with stage 3. Develop a vision and strategy.
And this has to be compelling, easily understood, and it requires mastering Zaffron and Logan's Law 3, that future-based language. The vision is the magnetic north of the invented future.
Then we hit stage 4. Communicate the change vision. This is where most organizations just fail, utterly, due to complacency.
Cotter's point here is harsh but true. He said project leaders will likely undercommunicate by a factor of 10 to 100 times.
100 times. People need to hear the message repeatedly from different sources in different formats and connected to their daily work.
So the practical tip here is aggressive, pervasive communication. The project leader has to get CEO permission to literally gate crash any gathering, department meetings, team huddles.
Just to get a 10-minute update slot? You cannot rely on passive communication. People will delete your project newsletters and mass emails. They just will.
If you're tired of saying it, you're probably only halfway there.
That's a great way to put it.
Okay, stage 5 is empower broad-based action. Once the vision is communicated, the need for change has to be actively handed over to the teams.
This is the moment of truth. Management has to be prepared to let go of the reins and tolerate a temporary increase in chaos.
Some chaos is good.
Some chaos is good. It signals that people are actively experimenting and owning the solution.
Yeah.
You empower teams by removing bureaucratic obstacles and trusting their expertise.
But how do you do that without it just becoming a free-for-all? Where are the boundaries of that good chaos?
Senior management's role shifts from prescription to boundary setting. They provide the what, the invented future and the expected results, and the why, the burning platform. But the teams have to own the how.
So management might say, by the end of this quarter, the monthly reconciliation process must take less than 5 days.
But the team decides which tools, which templates, and which training they need to get there. Delegating the how is what turns staff into empowered agents.
Okay, so now we're into the crucial phases of making the change actually stick, starting with stage 6. Generate quick wins.
And here we have to acknowledge that difficult truth again. Senior management can suffer from an organizational attention deficit disorder.
It's a management imperative then. If you proceed in a slow, introverted way, the project will just lose oxygen.
You need easy, clear, tangible wins, and you have to celebrate them extrovertly. Quick wins provide that visible, undeniable proof that the invented future is actually happening.
And there's a specific strategic move mentioned here. Set up the CEO to score the easy goals.
Oh, this is vital. These wins aren't just for the staff, they're for maintaining senior management's attention. So, for example, if the planning tool implementation is massive, a quick win might be automating one single high-visibility report in 3 weeks.
And you present the CEO with the metrics comparing the old and new process.
And let them announce the success to the board. The CEO gets credit, the project gets validation, and the staff see immediate results.
Which leads to stage 7. Consolidate gains and produce more change. This is the flywheel effect, right, from Jim Collins.
Exactly. When staff start working together toward that invented future, the momentum of the change flywheel starts to turn quicker and quicker. Success breeds more success.
So you use the energy from the first success to fuel the second.
And you avoid the temptation to declare victory too soon. In that planning tool case study, once they got the quick wins in reporting, they immediately moved the goalposts. They realized they could optimize the annual budgeting cycle next.
It's an aggressive, iterative cycle of consolidation and expansion.
It has to be. And finally, stage 8. Anchor new approaches in the culture. This is the long-term part, where the change stops being a project and becomes just how we do business around here.
So you celebrate the change agents, you make them heroes.
You embed their new behaviors into the corporate values. The new, faster process isn't just a process, it becomes a core value of the finance team. We are strategic forthright partners, not historians.
This stage also includes the difficult topic of weeding out resistance. How do you reconcile celebrating heroes with, removing dissenters?
It's the painful reality of major change. The goal is to maximize the success of the 95% who have embraced the invented future. You have to ensure the removal of management who haven't embraced it.
The ones who will undermine the vision covertly.
If you leave pockets of entrenched influential resistance, they will ultimately undermine the entire transformation. The default future will creep back in. Leadership has to be prepared to make those tough calls to protect the new culture.
That makes sense. Allowing a high-ranking dissenter to stay just sends a message that the old ways are still okay.
It erodes all the momentum you just built.
Okay, so let's go back to the starting line, back to stage 1. Because all of Kotter's stages rely on mastering that initial sale to senior management.
This is it. This is where a huge majority of fundamentally sound initiatives just die. Getting the senior management team, the SMT, on board requires that prepared elevator pitch, a masterful sales presentation, and, most importantly, a really acute understanding of emotional drivers.
This is the crucial disconnect, isn't it? Especially for technical experts, engineers, accountants. We love facts and logic.
We do.
But the source material is so explicit. Stories are sold through the audience's emotional drivers, not through logic. And if you fail to appreciate that, you're just going to undermine your entire pitch.
Logic provides the necessary defense against scrutiny, but emotion is what provides the commitment. If you just present data, the SMT will analyze it. If you connect the data to their emotional drivers, they will act on it.
And the source material emphasizes the need for a public relations machine behind major projects. Every single communication presentations, emails, memos should be vetted by a PR expert.
And the warning is blunt. Don't get offended when they rewrite most of your content. You should just admire their genius and claim the credit when it works.
It's recognizing that the mechanics of language and emotional connection are a specialist skill.
Exactly. And we can see the power of this emotional tailoring through that illustrative car sale example in the source. It's a brilliant demonstration of how the exact same product is sold using totally different emotional hooks.
Okay, let's run through those 3 scenarios. We're selling a high-performance, high-safety sedan. Buyer 1 is the young IT professional. What are their dominant emotional drivers?
Performance and status. They want to be seen as Competent, successful, a little edgy. The salesperson doesn't waste time on maintenance schedules. The pitch is aggressive and status-focused.
So something like, I hope you have some track racing experience. You need to be a Lewis Hamilton to handle this beast.
Yes. This car has 320 bhp, a twin turbo, and corners like it's on railway tracks. Only a top driver can truly harness this power. It's a real driver's car.
SOLD. They bought the status of being a top driver.
Exactly. Now, buyer 2, the older, experienced CFO, the one with the gray hair, the needs are totally different.
Risk mitigation and control.
The pitch changes immediately. The CFO cares about legacy, reliability, avoiding problems. The pitch becomes all about security. This car is 5-star rated for safety, with 8 airbags, enough instantaneous power to get you out of trouble.
Unbelievable braking when you have to avoid the idiots on the road, and self-sealing tires that will never fail you.
SOLD. They bought peace of mind, the power to control external risk.
They're finally buyer 3, the stylish, marketing-focused executive, impeccable grooming. Logic is irrelevant here.
It's all about image and external validation, so the salesperson appeals to aesthetics. This car has won many awards for its innovative design. Sit in the driver's seat and feel the quality of the finish, the leather, the wood grain.
You look $1 million in that outfit you are wearing, and every time you drive this car, you will feel like $1 million.
SOLD. They bought the feeling of self-worth and alignment with their personal brand.
The lesson translates perfectly to the SMT. Before you pitch your change initiative, you have to identify the dominant emotional drivers of your key decision makers.
Is the CEO driven by legacy? Is the controller driven by fear of regulatory compliance risk? Is the CMO driven by market reputation? Your language has to be tailored to their specific emotional hook.
And that groundwork prepares you for that critical stage 1 encounter, the elevator speech.
The purpose of this 30-second speech is singular. Capture attention and curiosity. You have to recognize that a brief chance encounter might be the only one-on-one you get.
The goal isn't to sell the whole project.
No. The goal is to create enough urgency and intrigue to secure 15 or 20 minutes of their time later.
The source has that brilliant I am troubled approach. It uses surprise and genuine urgency, not the expected polite small talk.
Let's walk through that. In answer to the common corporate question, how are you? You don't say fine, you say, I am troubled.
That immediately breaks the script. The CEO will almost have to ask, why is that?
And your reply has to be focused, punchy, and anchored to a quantifiable fear. I have just been looking at the risk associated with our delayed forecasting cycle. I have estimated that over the next 10 years, we will be spending $50 million in unnecessary rework and potentially $15 million in fines if we do nothing.
I have been researching a new approach that would save much of this cost and eliminate 80% of that compliance risk. I just need 15 minutes of your time this week to explain this.
It immediately connects the intellectual facts, the $50 million cost, with the emotional drivers, massive potential loss, reputation risk, and the instruction is critical. You have to practice that 30-second speech at least 10 times until it is absolutely focused.
You have to deliver it with conviction. Okay, assuming the elevator pitch works, you then need to deliver a compelling burning platform presentation.
Right, that 15 to 20-minute masterclass. And the key to success here is all the preparation outside the room, what we call priming.
You have to focus weeks of effort on selling the thought leader, on the SMT, or the board before you even give the presentation.
And this isn't a casual chat. It might take weeks of informal meetings, sending them curated articles, telling them concise stories about competitors who've already adopted the invented future.
This thought leader may not even be the CEO.
It's just the person who holds the most intellectual or moral sway with the rest of the board.
And you have to prime them to speak first after your presentation.
Yes. If the thought leader who you've already convinced throws their weight behind the project immediately, it hugely maximizes the chance of a positive vote from the rest of the team.
Okay, finally, we get to the true objective of this pitch. Asking for the easy next step.
You do not ask for full project approval. That's a huge multi-million-dollar commitment. You only ask for permission to run a one-day focus group with the organization's oracles.
That's the smallest, easiest commitment for them to make.
It is, and the justification you provide seals the deal because it plays into their desire for control and risk reduction. You say, I want to road test this proposal with the people who actually run this business.
If I can convince the oracles that this project will work and get their involvement in the project plan, I will be able to present to you a project that has a far greater chance of success and a significantly lower risk profile.
This approach is brilliant. It leverages the known power structure, the oracles, and it minimizes the immediate risk to the SMT. It's an easy yes.
So once the SMT grants permission for that easy next step, we move into action with the one-day focus group. This is the crucial workshop where the magic of self-persuasion really happens.
And where the foundation of Cotter's guiding coalition truly forms. Holding a one-day focus group meeting is just a superb way to get a solid coalition of oracles behind the project.
And remember, these are the individuals the entire organization trusts, regardless of their formal titles. Their buy-in is more valuable than any mandate from the CEO.
Because they neutralize the resistance that's generated by the default future.
Okay, let's talk composition. The group should be 15 to 30 experienced staff, and it has to be a cross-section of the entire organization.
Business units, area offices, head office, different roles too, from highly specialized administrators all the way up to senior management.
Why is that diversity so important?
It's essential because it ensures that when that invented future is finally articulated, it gets road-tested against all facets of organizational reality. The vision isn't siloed or naive.
The agenda for this one-day meeting is very specific. It's basically a fast-track, facilitated version of Mills's self-persuasion process. What are the key objectives?
The meeting has 4 critical structured objectives. First, you dedicate the morning to discussing the existing issues. This is the impasse phase.
So you ask them to discuss the problems with performance measures or the flaws in the current data. You have to get everyone to acknowledge the systemic pain collectively.
Exactly. Shared urgency. Second, you expose the attendees to the new thinking. This is where you introduce the principles of the invented future. You're seeding the idea for the reflection phase.
Third, you outline the intended approach. But it's still consultative. You're not dictating the plan.
Not at all. You're framing the scope and the direction and opening it up for their feedback. And finally, the most important objective, to drive insight and motivation. You seek their advice on viability and lessons learned from past projects.
So you're not asking for permission. You're asking for their deep organizational expertise, which validates their importance as oracles.
You ask them, based on our last failed implementation, what's the single biggest mistake we must avoid this time?
The energy from a workshop like that must be incredible.
It should be one of unified commitment. The aim is singular. To get the green light and secure their full support by facilitating their aha moment. And once that support is locked in, the next step is leveraging it into the Cotter roadmap.
So you develop a robust blueprint that sets out the direction using some of the oracles who are in that focus group.
And they become the initial, highly motivated members of Cotter's guiding coalition. They've already personally rejected the default future.
And this structure can be applied to almost any major change, right?
Well, absolutely. The source notes the availability of sample agendas for things like re-engineering month-end reporting, annual planning. The underlying psychological structure is universally effective, regardless of what process you're changing.
This deep dive gives you not just a checklist, but a psychological toolkit for implementing change that fundamentally shifts the dynamics of resistance.
It does.
And the summary takeaway is clear. You need all 3 models working together to create a self-sustaining transformation.
Absolutely. You need Zaffron and Logan's invented future and that future-based language to establish the motivation and overcome the inertia of the default future.
Then you need Harry Mills' self-persuasion framework to reduce resistance and ensure true commitment from the teams, not just compliance.
By forcing them through that impasse and reflection. And finally, you need Cotter's 8-stage roadmap to manage the complexity of the whole journey, from that initial ambush pitch all the way to cultural embedment.
The most critical insight for anyone listening has to be that failure is often not due to a poor technical idea, but a spectacularly undersold one.
That's it in a nutshell.
The difference between success and failure is the ability to shift from selling the facts, the dry logic of the spreadsheet, to strategically selling the emotional drivers of your audience.
Whether that's the CEO's desire for a legacy or the controller's fear of regulatory risk. And remember that strategic selling starts weeks, sometimes months, before the presentation.
By identifying and priming that single thought leader who can carry your torch when it matters most.
To get that easy yes to the focus group.
We talked about how when empowering broad-based action, Cotter Stage 5, leadership needs to embrace some chaos.
Yeah.
And true commitment to the invented future means letting go of microcontrol and trusting those motivated teams to execute the how. That seems like the single hardest philosophical shift for senior leadership to accept.
It often is. It requires shifting from viewing the staff only as executors of a dictated plan to viewing them as co-creators of the organization's future. The degree to which management is willing to embrace that initial necessary chaos often dictates the ultimate success of the whole thing.
So here is the final provocative thought for you to chew on. If you look back at past initiatives that failed in your organization, how many of Cotter's 8 stages did those projects effectively skip? Especially that extensive communication in stage 4 and the strategic celebration of quick wins in stage 6. And what was the ultimate quantifiable cost of that missed opportunity, both in dollars and in lost organizational belief?
Now you have the tools to ensure that doesn't happen again. Welcome back to the deep dive. This is where we take, stacks of raw information, complex business processes, and just dense data, and we boil it all down for you. We give you the critical insights you really need to stay ahead.
And today, we're going after a big one.
Oh, yeah. We're targeting an area that is, let's just say, traditionally associated with a lot of stress, a lot of overtime, and, well, sheer exhaustion. We're talking about the corporate month-end close.
We are absolutely cutting through the noise on this one. It's this process that so many people dread, but our goal here is to provide the structure, the context that really transforms it. It stops being a clerical chore and becomes a real competitive advantage. This deep dive is about radical transformation.
Exactly. It's not about small tweaks. We're diving straight into how you can re-engineer your finance processes so that the end-of-month scramble, that mad dash, it becomes a day 3 delivery, or maybe even faster.
And for so many organizations, that sounds impossible. Their finance teams are just trapped in processes that are, well, career limiting is a good way to put it.
It is. It forces brilliant staff to perform these low-value cleanup tasks when what they should be doing is providing strategic guidance to the business.
That's the core tension, isn't it? Month-end reporting is a zero-sum game. Every single day you spend producing historical reports is a day you've lost for analysis, for looking forward.
So our mission today is to move organizations off that historical treadmill. We're not aiming for average.
Not at all. We're aiming for the exceptional standard.
Our mission is huge. We want to extract the specific, the actionable process changes and the really critical mindset shifts that will allow you to close your books, report your results by the 3rd working day of the month.
And doing that dramatically increases the value, the sheer relevance of that financial data.
So how are we going to do that? What's the scope here?
Okay, so the scope is pretty clear. We have to look at the processes that we need to be brave enough to just abandon completely. Then we look at the necessary activities we have to accelerate. And this is the crucial part, the strict early cutoffs required to make this timeline physically possible.
Right.
We're going to look at benchmarks, we're going to quantify those hidden costs, and lay out a systematic approach.
And all of this is built on a key idea from our sources, which I found fascinating. It's that when it comes to closing the books quickly, common sense is, it's not always common practice.
It really isn't. The pressure of the deadline often leads people to be more conservative, to use slower procedures that they think are safer, but which ultimately undermine the whole function.
So our focus is on those systemic radical changes, the ones that let you report last month's results before we're even halfway through the current month.
That's the goal. Maximum relevance, maximum strategic capacity.
Okay, let's unpack this. If we're aiming for day 3, what does the spectrum of reporting speed? What does it actually look like out there in the corporate world? How do you even measure where you currently stand against the competition?
Yeah, you need a yardstick, right?
Yeah.
But the definitive one. And the source material gives us one. It's a ranking scale based on observations across thousands of companies. This isn't just a ranking. You should think of it as a strategic map.
It sets the bar. So at the very top, you have the exceptional organizations, and they operate on a 1 working day cycle. Is that even possible?
It is, but it requires near-perfect integration and automation. You're talking about organizations with incredibly sophisticated ERP systems, incredibly disciplined processes. For most, that's maybe a stretch goal.
So what's the realistic target?
The realistic sweet spot is outstanding. That means reporting your results within 2 to 3 working days. Hitting day 3 and hitting it reliably every single month, that's what unlocks that 75% future focus we're going to talk about later.
Okay, so after outstanding, we drop down to above average, which is 4 working days. That sounds pretty good, but you're already losing an entire day of strategic time compared to the outstanding group.
You are. And then you get to where the vast majority of companies fall, which is average, 5 working days.
A full calendar week.
Exactly. If you're taking 5 full working days, the data is already getting stale. And critically, we know that many organizations are even slower than average. It's not uncommon to see 7, 8, even 9 days to complete the close.
So the whole point of this deep dive is to give you the tools to move your organization from that average or, below average category.
Right, up toward outstanding.
But I want to linger on the cost side of this. What is the hidden cost of delay? I mean, speed is great, but what's the tangible dollar and cents penalty for running a slow operation?
It's the opportunity cost, and you have to monetize it to make the case to your executive team. There's a powerful quote from a CFO in the source material that just says it all. Every day spent producing reports is a day less spent on analysis and projects.
When you put it like that.
Right. When your finance teams are trapped in processing, they can't be advising, they're just historians, they're not architects of the future.
And when you quantify that, the difference in available strategic time it's jarring. So if you have an entity that somehow reports on day one...
The ideal state.
Right. That finance team has, on average, 21 days left in the month for current activities, for strategic planning, for all that future-focused work.
Now, contrast that with an organization that takes 9 days, which, alarmingly, is not that uncommon in mid-sized companies with a patchwork of different systems.
So what's left for them?
That team only has 13 productive days left. 13. That's a 40% reduction in productive time for value-adding work compared to that day one entity.
40%. 40% of your entire team's capacity, all their intellectual capital, is just being eaten up by a slow, inefficient historical process.
It reframes the problem completely.
It does. It's not just an inconvenience anymore. It's a severe structural constraint on your strategic capacity. And it costs real money.
Precisely. And we had to put a dollar sign on that loss.
Yeah.
We need a way to estimate the dollar cost that includes the entire month-end process. And this is the key. That includes the non-finance time. Specifically, senior management time. If you can show your executive team that their time is the most expensive variable in this whole equation, the case for change becomes undeniable.
That makes perfect sense. I mean, senior management's time is exponentially more valuable than junior staff time, and they inevitably get dragged into a longer close cycle. They're approving things, reviewing variance reports, getting stuck in the weeds on details that a faster process would just eliminate.
Absolutely. When you calculate this cost, you have to factor in that senior management time factor. I mean, think about it. How much truly productive time does an executive actually have in a year?
Not as much as their calendar says.
Exactly. You remove holidays, sick leave, required travel, all the routine management meetings. A senior manager barely has 32 weeks of truly productive project-focused time in a year.
32 weeks, that's shockingly low. It makes every single hour of their time incredibly precious.
It does. Therefore, costing senior management input at a minimum of, say, $1,000 per day for this kind of internal analysis is actually pretty conservative. But you have to do it to capture the true cost of the delay. This isn't about their salary. It's an opportunity cost calculation based on their strategic potential.
Okay, I want to see the numbers. If we take that day 9 close versus a day 3 close, what's the cost difference? Where does it land?
Well, the analysis in the source material estimates that for a typical organization, let's say one with around 40 budget holders who all need to review their P&Ls and maybe 500 full-time staff, the total time suck, once you include that senior management multiplier.
What's the number?
The estimated cost of that slow reporting is somewhere between $6.9 million and $1.5 million.
Annually.
Wow. A potential loss of over $1 million just from running an inefficient, slow closing process. That's a compelling, hard business case.
It is.
But how does that figure break down? Is most of that cost sitting in the finance department, or is it more spread out?
It's highly distributed, which is exactly why the case is so powerful for the executive team. A big chunk, yes, comes from the dozens of finance staff spending those extra 6 days chasing down immaterial adjustments and running reports over and over.
But the multiplier effect is what really drives it.
It's massive.
Yeah.
If you have 10 senior managers, your CFO, your COO, department heads, and they're all spending 3 extra days reviewing reports, providing sign-offs, arguing over minor miscodings, at that $1,000 a day rate, that's 30 manager days. That adds $30,000 per month in sunk costs just from their wasted review time.
So we're literally paying our highly compensated strategic leaders to be proofreaders and historians.
Instead of market strategists, it moves the conversation from, hey, let's be a bit tidier, to we are hemorrhaging money and severely limiting our strategic bandwidth.
So if we connect this to the bigger picture, accelerating the close isn't just about cutting costs, is it? It's about fundamentally changing the purpose and the function of the finance department. Absolutely. It's about shifting the finance team from being scorekeepers to being active business partners.
So what does that seismic shift actually look like for the people running the business, the management team?
For management, the benefits are immediate and very tangible. First, reporting plays a much bigger, more current role in their decision-making process. If you get the previous month's full results by day 3, that data is still fresh. It's relevant enough to influence how you allocate resources in the first week of the current month.
And speed forces simplification, which I love. The source material highlights that you get this necessary reduction in report detail in the length of the reports.
Right.
You start focusing only on what truly matters to the bottom line.
You have to. The shorter the time to close, the less patience management has for extraneous detail. The reporting process naturally starts to focus on the top 5 variances, not the 50 tiny ones. And it drives greater budget holder ownership. They become responsible for their own accruals, their variance analysis, and for fixing their own coding errors during the month, rather than just relying on the finance team to do a big clerical cleanup after the fact.
So that sounds like a proper delegation of responsibility, which is the key to efficiency. Less senior management time tied up in the close means they're free to focus on long-term strategy, which is where they should be anyway. But let's look internally for a second. What about the finance team itself? I mean, they're the ones whose processes are being radically changed here.
For the finance team, the benefits translate directly into a much better working environment. I mean, we see happier staff, higher morale, increased job satisfaction, because they're finally tackling the fundamental structural bottlenecks and locking in true, permanent efficiencies. They're solving problems, not just repeating them month after month.
It's that critical shift, isn't it, from being internal processors who are just handling historical cleanup
to becoming strategic business partners.
Yeah.
Exactly. The focus shifts to being a true business partner to the budget holders, helping them shape the future.
And they have more time.
They have significantly more time. That 40% capacity gain we talked about. They can use that for rewarding, value-added activities. Things like implementing quarterly rolling forecasts, driving systems, implementation projects, and doing real strategic advisory work.
That's a huge psychological and professional upgrade. You're moving from a scorekeeper cleaning up last month's messes to a future shaper advising on tomorrow's decisions.
And we can visualize this. If you compare the non-lean model to the lean model, the difference is stark. In a traditional non-lean finance department, the workload is just dominated by historical activities. Month-end and annual reporting dictates their entire schedule. It often leads to burnout and, frankly, limited career progression.
But the prize, the lean model, is where that work truly shifts away from historical processing and toward forward-looking activities.
Correct. The goal is to achieve a 75% future focus. That 75% is dedicated not to journal entries and reconciliations, but to rolling forecasting, deep annual planning, optimizing systems, adopting new lean processes, and critically, that strategic advisory work with the budget holders.
That's fascinating. So if 75% of my team is now focused on this forward-looking strategic partnership, what specific skills should I be hiring for? Does this mean the traditional bookkeeper or the transactional accountant? Are they made redundant in this new model?
That is an essential question for you to consider. The structure of the team absolutely evolves. Transactional skills are still necessary, of course, but they become much more centralized and highly automated. The source material suggests that a rapid month-end is almost always accompanied by a significantly higher percentage of qualified staff in the finance team, CPAs, CMAs, and so on.
So you need fewer people focused on raw data entry and more people who are capable of interpretation, of performing deep analysis, and providing that strategic partnership to the business unit managers.
Precisely. The whole nature of the finance team evolves. The skills shift from data processing competence to business acumen, analytical rigor, and communication skills. You're aligning your expertise with that high-value 75% future focus. It's a career accelerator for the finance professionals themselves.
Okay, here's where it gets really interesting for me. Because the first step in this whole transformation isn't about the numbers, it's not about software, it's not about systems, it's psychology. It's about managing expectations.
It is.
Finance teams must realize they are sculptors, not scientists.
That analogy is fundamental. The finance team is sculpting a true and fair view, which is, it's an artist's interpretation based on the best available facts at a specific point in time. They are not conducting a laboratory experiment aiming for absolute, verifiable 100% precision.
I understand the philosophical point, but how do you sell that to a very conservative accounting culture? I mean, this mindset shift means you have to get them to recognize that monthly accounts are not precise documents, and in fact, they will never be perfectly right. They can only ever achieve a true and fair view.
That is the hardest sell, especially to people with an audit background. The counter-argument you have to use is that the pursuit of perfect detail is infinitely expensive and often completely futile. I mean, we could hold the accounts payable open for 6 months after the month end, and you still might not receive that one plumber's invoice that arrives when their company does its year-end and realizes they forgot to bill you.
So the pursuit of perfection destroys the value of timeliness. But how do we enforce this sculptor mindset across a big team of accountants who have been trained their whole careers to chase every single dollar?
You need rules, mandatory non-negotiable reporting rules for the finance team. These rules enforce the discipline, and they give your staff the permission they need to let go of immaterial detail.
Okay, so what are the key rules for these sculptors?
First and foremost, do not delay the report for detail. That minor invoice, that small miscoding, it can wait. Push it to the quiet mid-month period. The speed of the result is paramount. If it doesn't materially change the bottom line, it is not worth holding up the close for.
Makes sense. What's next?
Second, you have to maintain consistency. Consistency from one month to the next, consistency in the judgment calls you make, especially on things like accruals and provisions, and consistency in the format of the reports. Inconsistency erodes trust instantly.
And the last two.
Third and fourth are about communication and efficiency. Be concise. The final report has to be a strategic document, less than 10 pages total, and that includes the one-page reports from major business units. And fourth, merge your numbers, your graphs, and your comments onto one page wherever you can. The easier it is to digest the key findings, the faster management can move on.
Those rules enforce discipline, but it seems like the absolute core rule, the foundation that all these speed hacks rest on, is a rigorous definition of materiality. This has to be agreed upon at the highest level, right?
It absolutely must. Materiality has to be an agreed corporate view, signed off by the CFO and by operational management. It cannot be varied by each individual budget holder or department head. The second they're allowed to set their own thresholds, the whole process immediately breaks down.
Can you give us a specific practical example? How does this strict definition of materiality apply across the board and set a single, non-negotiable benchmark?
Certainly. Let's say that after careful consultation, the corporate materiality is agreed upon and set at, say, $20,000 for a P&L item on the consolidated result. That exact amount, that $20,000, then becomes the threshold for everything.
Everything.
Everything. It's the minimum required amount for posting adjustments, it's the trigger for requiring variance commentary, and it's the lowest threshold for certain types of accruals across all entities, no exceptions.
So if an accountant finds a miscoding of, say, $15,000, they have clear, signed-off permission to ignore it for now. They can push the correction to the following month, knowing it won't derail that day 3 target.
That consistency is the engine of speed. It is the license to ignore the irrelevant. If you don't set this rule firmly, the finance team will always regress to chasing every dollar, and that day 3 target will remain permanently out of reach.
Okay, so this raises a really important question. How do we stop that? That inevitable tsunami of work that hits right at the deadline. Because if we wait until the 30th or the 31st to start the heavy lifting, we're already way too late to report by day 3.
You're doomed before you start. If all the activity piles up on the last day, then day +1 and day +2 become these impossible fire drills. The answer, as you said, lies in strict early cutoffs and leveraging those recurring processes.
Let's start with the biggest bottleneck, the thing that often keeps the entire team chained to the office, accounts payable.
We have to actively avoid the accounts payable tsunami. The last thing your AP team needs is a mountain of invoices arriving at 5 p.m. on the last working day that then have to be processed before the general ledger can even think about closing.
So the process change here has to start well before the actual cutoff date. How do we reduce the volume of invoices that even hit those final days of the month?
You push back your payment runs. Instead of waiting for one massive run on the 30th or 31st, a much better practice is to institute weekly or even daily direct credit runs. And crucially, you specifically avoid doing payment runs on the very last day of the month and the first 2 days of the new month.
Why is that so important?
Because it frees up the AP staff to focus purely on processing invoices for the current month's close. They're not distracted by managing cash outflows.
And we also have to tackle supplier management directly, which I imagine requires some leverage and foresight. You're forcing third parties to work to your timeline.
You are. You actively change the invoicing cycles on all your big monthly accounts. Yeah. Utilities, company credit cards, high-volume recurring suppliers. For instance, instead of letting a credit card cycle run to June 30th, you negotiate to change it so transactions run through June 27th, and the invoice must be received by the 28th. If it arrives later, it's next month's liability.
That is a subtle but incredibly powerful change. And the real genius of that move is how it interacts with accruals.
It's a fantastic speed hack. When you compress the window for those recurring bills like rent, utilities, major service contracts, the accruals for them become almost immaterial if you just use the previous month's reversing accruals again.
Wait, hold on.
You accept a known minor inaccuracy, say 3 days worth of difference, for massive speed gains.
I need to dig into that for a moment because you need to see the mechanics of that. If my utility bill cut off on June 27th, I am missing the 28th, 29th, and 30th. If I just reverse the accrual from May, isn't that just mathematically wrong?
It is technically wrong, but practically immaterial. If your May accrual for utilities reversed on June 1st and you just repost that same amount for June, you're capturing 99% of the expense. The difference between 3 days of utility usage and 0 days relative to that $20,000 corporate materiality threshold we talked about is almost always negligible. It passes the true and fair view test while avoiding all the manual effort of calculating 3 days of expense for 50 different suppliers.
That makes the sculptor mindset actionable. Okay, so with that in place, we can enforce the radical AP cutoff.
We must. The best practice is to cut off accounts payable processing at noon on the last working day, day -1. The invoice has to be physically processed and approved by that deadline.
Noon on the last day. That gives the AP team a very clear target. But this is where the pushback happens, right? What's the biggest risk of closing AP that early, and how do you stop the AP manager from cheating the system and sneaking invoices in later just to keep vendors happy?
The risk inherently is that you miss the occasional large, last-minute invoice. But the justification has to be organizational, not clerical. Holding AP open after month end is just not justifiable. It delays reporting, and it doesn't even guarantee you capture all the invoices. We already talked about that phantom plumber's invoice.
Right.
The AP manager has to be empowered by the CFO, who reinforces that crucial quote. Your month-end result doesn't become more accurate the longer you leave it. It just becomes more expensive to produce.
That quote should be on a poster in every finance department. You're sacrificing an illusory precision for a guaranteed high-value timeliness. AP closes at noon. Full stop.
Now, we take an even more radical step with accruals management. We set their cutoff before AP.
Wait, you're cutting off accruals on day -2 before we've even cut off the real invoices on day -1. That seems deliberately counterintuitive to traditional accounting procedure.
It is, but it's based on a fundamental behavioral insight. Budget holders know very little more about what invoices are coming at day +2 than they do at day -2. Waiting 2 extra days for an estimate doesn't make the estimate significantly better, but it does make the close significantly slower. We're asking them to use their best judgment slightly earlier when they still have time to focus.
So the new accelerated timeline dictates that we introduce the accrual cutoff on day -2, the day before month end.
Yes, budget holders must send any final invoices they have to AP by noon on day -2, and they prepare their large accruals directly into the general ledger that same afternoon. This means that by the time day -1 hits, the accrual estimates are already locked in. The AP team is then focused purely on processing that final batch of real invoices that made the noonday -1 cutoff.
And this whole rapid accrual process relies entirely on setting those strict materiality rules for accruals to stop the finance team from drowning in hundreds of tiny estimates.
Absolutely. If we go back to our corporate P&L materiality figure of $20,000, the source material suggests setting the minimum department accrual threshold at about 40 to 50% of that P&L materiality.
So if overall materiality is $20,000, we set the minimum department accrual threshold at $10,000. That's ingenious. It immediately limits the effort required from both the budget holder and their finance partner.
It should limit accruals to less than half the budget holders in the organization. If a department is too small to reasonably generate $10,000 worth of uninvoiced expense in a month, they don't have to do any accruals. They just rely on the reversing entries, which we know are close enough to be true and fair.
That is a huge productivity gain. You're focusing the effort only where it materially impacts the net result.
We can go further. We should also limit the individual debit items within those accruals to about a quarter of the accrual threshold. So if the department threshold is $10,000, we'd set an individual debit limit of, say, $5,000. This maintains the focus on genuinely significant items and stops budget holders from spending an hour creating 5 separate $2,000 accruals.
That discipline around accruals feels like the difference between speed and chaos. But AP and accruals aren't the only bottlenecks. We need early cutoffs for other ledgers, too.
Starting with accounts receivable, AR. This should close immediately on the last working day, day -1, preferably at noon, just like AP. The organizational impact here is massive, and it's largely behavioral.
Right, because closing AR early sends a signal to your sales reps, the people driving the revenue, that sales completed on the very last day will just roll into the next month. It changes the incentive structure.
It encourages them to start the game earlier in the month. It spreads the revenue across the 30 days instead of having them jam 40% of their sales into the final 72 hours just to hit a monthly target. The positive side effect is much smoother revenue recognition and better operational planning for everyone.
Okay, then there's capital expenditure, CapEx. Processing additions, calculating depreciation.
Yeah.
That often drags the close down because the fixed asset module depends on other GL data.
Exactly. Why are you waiting until month-end to calculate depreciation? You should close your projects and freeze the fixed asset module at least 1 week before month-end.
But wait a minute, what if we buy a critical piece of machinery on, say, June 28th, and it's installed and operational? Are you saying the business is using an asset that isn't yet financially recognized in the books?
Yes, that's precisely what I'm saying. If the equipment arrives in the last week of the month operationally, they can use it. But for accounting purposes, it is treated as arriving next month. You are sacrificing absolute precision for speed.
And depreciation.
Depreciation is calculated and posted by day 3, but ideally even earlier, based on your annual plan. You only need to correct it to actual at month 12 if depreciation is not a significant driver of your P&L.
That's a huge time saver. Running a fixed asset roll forward and posting all those entries can be incredibly time-consuming, especially in complex manufacturing environments.
Anyway, we have to talk about the foundational hygiene task that makes all this balance sheet work even possible. Daily bank reconciliation, DBR. This needs to be established and operational well before the close even begins.
So DBR means you're reconciling the bank accounts every single day. Why is this so critical for a rapid close?
Because if you wait until month end to reconcile your bank accounts, you are forcing the team to find and process 30 days of differences, outstanding checks, bank charges, errors, all under the intense pressure of the deadline. If you perform DBR, you're only dealing with the differences from the previous 24 hours. Your bank GL account is effectively closed and accurate by day -1. It takes bank reconciliation from a month-end cleanup task to an ongoing low-stress hygiene task.
Now, inventory. That's a massive time sink for manufacturers and retailers. Physical counts, valuation adjustments, closing out work in progress.
For sophisticated organizations with integrated state-of-the-art systems, you can achieve an inventory cutoff immediately at the close of business on day -1. However, if your systems are not perfect, you must enforce the inventory cutoff at the close of business on day -2.
Meaning all production and all raw material arrivals on the very last day of the month belong to the next month.
Precisely. This gives you a full day to check your valuation, process final cost adjustments, and confirm your records. The crucial close-off transfer of WIP to finished goods is also completed on day -2. And critically, you must always avoid a month-end physical stock count.
The traditional dreaded month-end physical count that shuts down the whole operation. Instead, we move to a rolling stock count.
Yes. The rolling basis count should be held no nearer than the 3rd week of the month. The source gives a great anecdote about a high-end jewelry chain. They count watches 1 month, gold chains the next, always during a quiet time, mid-month, when the operational disruption is minimal. This completely separates the physical effort from the financial reporting deadline.
Okay, so once the books start closing, even with these extremely strict early cutoffs, how do we handle the inevitable mistakes and disagreements without derailing the whole process? I mean, accountants, by their nature, want to fix everything immediately.
You have to enforce the purpose of the overs and unders schedule. This represents a radical mindset shift. Month-end is not the time for spring cleaning. All miscodings, unless they are truly material, are processed during the following quiet mid-month period.
So instead of stopping the clock to correct every little mistake, you track them. You see how they net out before you make any decision to adjust. This keeps the process moving.
Correct. You set up 2 simple spreadsheets on a shared drive right at the close of the last working day. These are your adjustment traps.
The first spreadsheet traps the major adjustments. So let's go back to our $20,000 corporate materiality figure. We'd set the threshold for major adjustments at 40 to 50% of that, so maybe $8,000 to $10,000. Let's use $10,000 as the minimum for a major adjustment.
Right. And the second spreadsheet traps the minor adjustments. Those are the amounts between a lower limit, say $5,000, and that major threshold of $9,999. Accountants enter their potential adjustments onto these shared drives, categorized by department and by direction, over or under.
And the brilliance of this mechanism is the behavioral insight it relies on. Most of these small adjustments, they tend to net each other off globally.
They absolutely do. In the final review on day +1, the finance team looks at the total net effect of all the overs and unders. Only if there's a material misstatement of the net result, meaning the total net effect on that combined schedule exceeds the corporate materiality of $20,000. Only then are one or two appropriate adjustments actually processed to correct the imbalance.
And all the other small corrections that don't materially affect the net result?
They get pushed. They're pushed to the quiet mid-month period. That's when the team can review the causes of those minor adjustments and implement fixes. This turns clerical cleanup into process improvement time, which aligns perfectly with that 75% future-focused model.
Another notorious bottleneck is avoiding intercompany conflict. Nothing kills a multinational or multi-entity close faster than two internal groups arguing endlessly about which ledger is right.
This requires a rule that is intentionally brutal for the sake of speed. The simple rule is this: the accounts payable or accounts receivable ledger is always right. The other party has to adjust accordingly. They accept the stated amount without any debate.
But wait, isn't that unfair? If subsidiary A is the buyer and they insist their AP ledger is correct, but subsidiary B is the seller and they know their AR invoice is the one that got messed up, are you forcing the innocent party to book a correction?
You are. It sounds unfair. I know. But the priority of the close is to report the overall result accurately and quickly, not to arbitrate internal disputes. Intercompany issues get sorted out in the following month when the pressure is off. You accept the minor intercompany imbalance for day 3 delivery, because at the end of the day, the net consolidated effect on the P&L is zero anyway.
That's a necessary evil. You're sacrificing a little bit of internal harmony in the short term for overall corporate speed.
And the really resourceful organizations, they've found ways to automate this out entirely. They eliminate the conflict before it can even start. They use specialized intercompany software that posts transactions simultaneously. When the selling party enters a transaction, the software immediately posts the corresponding entry in both the buyer's and the seller's general ledgers.
Eliminating mismatches before they can occur, that's the ultimate solution. But until then, that APA rule is the necessary Band-Aid for speed. Okay, this is the make or break period from 5 p.m. on the last working day to 5 p.m. on the first working day of the new month. This is where you decide the success of the close. This is the critical 24-hour sprint.
This is where all the discipline established by those early cutoffs pays off. So at 5 p.m. on day -1, all cutoffs are complete. AP, AR, accruals, inventory, it's all done. The GL is closed for the first time. And you immediately print the first cut of the numbers.
And this first cut isn't just a simple summary, is it? It's a detailed report designed for review. It should show the previous 3 months' numbers, last year's columns, all for critical context and pattern recognition.
Yes, context is key for the review. All your reporting and management accountants should take copies home that night for the night review. They're reviewing for reasonableness, spotting anything that's immediately obvious. They're looking for accounts that suddenly spiked, major accounts that have zero balances unexpectedly, or trends that are just drastically outside the historical norms.
So they're searching for the 2 or 3 material issues that genuinely need fixing, not the 50 minor ones.
Exactly. The next morning, budget holder accountability kicks in hard. They are sent their summarized accounts, and they must provide commentary on any major variances by noon on day +1. And this is a non-negotiable deadline.
And this requires that stringent variance rule we talked about earlier to manage the volume. Commentary is only required if the variance is the greater of your organization's materiality level, say $40,000 for variance reporting, and D is also greater than 10% of the budget. If it fails either of those tests, no comment is needed.
That tight deadline forces the budget holders to prioritize. It ensures the analysis comes in while the numbers are still fresh in their minds. They can't spend 2 days polishing a response. They have to address the top-line material issues instantly.
Then, at 9 a.m. on day +1, after the budget holders get their data but before their commentary is due, the accountants have a meeting.
This is the critical quality checkpoint. The accountants meeting. All the accountants meet to discuss the areas they flagged overnight, the places where further work might be needed to ensure a true and fair view. Assignments are decided, who's going to investigate what, and a follow-up time is set before the flash report deadline.
It's structured and time-limited quality assurance. No rabbit holes allowed. The focus is exclusively on the material impact and finding those few necessary adjustments trapped in that overs and unders schedule.
Precisely. So between 3 and 4 p.m. on day +1, the team meets again. They discuss their findings, they review the net effect of the adjustments trapped on the overs and unders schedule, and the crucial step is then executed. They book only the adjustments required to restate the numbers as true and fair.
And then the moment of truth. The final polish and flash report delivery.
They prepare and issue a one-page flash report to the CEO by close of business, 5 p.m. on day +1. This document is the ultimate speed signal.
What should be in that flash report? It can't be complex.
It has to be simple. It focuses on the P&L bottom line, maybe a few key operational metrics, and crucially, it has to state a level of accuracy, often expressed as plus or minus 5% or maybe plus or minus 10%. This manages expectations right away. It makes it clear that this is a highly reliable estimate, not a guaranteed final number, but it's reliable enough for immediate decision-making.
And the strategic purpose of delivering it so early?
It acts as a great appetizer. By satisfying your CEO's immediate appetite for the overall result right away, you buy yourself massive leverage for the rest of the close process. This satisfaction creates a vital opportunity later to reduce the final CEO report, the one that comes on day 3, to a single A3-page summary.
Right. Because if the CEO already knows the main result and its level of accuracy, they don't need 50 pages of backup detail.
But there is a serious warning attached to this flash report practice, one that you cannot ignore.
What's the warning?
Never attempt a flash report until your AP, your AR, and your accrual cutoffs have successfully moved back to the last working day of the month. If you try to jump to the flash report without that underlying cutoff discipline, you create enormous pressure later on to use accruals or adjustments just to manipulate the final numbers to match your flash report estimate. And that's a dangerous, unethical practice. The process must be disciplined first. The flash report is the reward for that discipline, not a substitute for it.
Okay, so we've delivered the appetizer on day +1. We've satisfied that initial hunger for the numbers. Now we focus on deep quality assurance and, critically, stopping the processes that waste valuable time in the days that follow.
Right.
Let's start with a hard boundary, banning late changes. Once that flash report is issued, the battle to constantly update the numbers has to stop.
It does. Once that report goes out, typically at the end of the first working day, no changes are permitted to those numbers until the entire review is complete on day 3. If new adjustments are found on day 2, they get logged on the overs and unders schedule, but they are not processed.
So accountants have to resist that urge to constantly update and reissue reports because of small, non-material changes. That constant rewriting just destroys confidence.
Absolutely. You only process adjustments if they're very material. Nothing erodes management confidence faster than getting a reissued report with tiny, insignificant changes. The sources offer a great anecdote here about how to manage executive scrutiny.
The classic scenario where the CEO, seeing the flash report, says, "I know my business. I thought sales were higher."
And the recommended measured response is perfect. You acknowledge the CEO's astuteness immediately. "You are right, Chief. Based on what we processed by noon yesterday, sales are understated by $30,000. But then you pivot.
You pivot to the overs and unders schedule.
Exactly. You explain that while sales are understated by $30,000, other adjustments accruals that were slightly overstated or some minor expense miscodings total $27 going the opposite way. And you then justify holding the adjustment until the following month because the net difference is only $3,000, which is negligible against that $20,000 materiality threshold.
That manages expectations perfectly. Most CEOs, feeling clever for spotting the $30,000 discrepancy, will readily agree that the net effect is negligible and they'll move on.
Next, you have to enforce stopping detailed variance reporting. This is arguably the biggest efficiency killer in organizations that are closing slower than day 5.
We stop reporting variances at that low individual account code level, which just generates mountains of irrelevant commentary that nobody ever reads.
You move to reporting only at a higher category level. You group accounts like travel, supplies, and utilities into broader categories like operating expenses, and you double down on using materiality to decide if commentary is even required.
So the new combined rule, the rule that provides the real efficiency gain, is that a variance must be the greater of 10% of budget A&D over the organization's established materiality level. We use $40,000 for this variance example before a comment is even required from the budget holder.
This instantly reduces the number of variances requiring investigation by 90% or more. This allows the budget holder and the finance partner to focus only on the variances that genuinely impact the business, and it frees up that time for strategic advisory work.
And the third major time waster to eliminate is the practice of eliminating monthly reforecasting of year-end.
This is a ritual that so many corporate accountants perform simply because it's tradition, not because it adds any value. And the source material highlights that it's actually actively detrimental on 3 counts.
First, the timing is terrible. It delays the month-end results because the reforecasting task is often just shoehorned in after the month-end numbers are known, forcing the finance team into overtime.
Second, because of those time constraints, it produces what we call top forecasts. These are estimates made quickly by the finance team among themselves. They completely lack budget holder buy-in, which makes them essentially useless for operational planning.
And most importantly, it creates what the sources call number noise. I mean, why should one bad month or one good month caused by some temporary fluctuation translate into a change of the entire year-end position?
If management sees you change your forecast every single month, their confidence is eroded. They know that whatever number you've given them this month, you're probably going to change it next month. This constant noise prevents the board from seeing the genuine underlying trends of the business.
So the radical solution is that reforecasting should happen only 4 times a year, quarterly. And it should use a proper bottom-up process that involves the budget holders and uses proper planning tools.
This forces discipline. You only adjust the forecast when truly significant material changes to the operating environment happen. It provides genuine insight. The only exception might be for highly volatile sectors, like the airline industry, where they might update specific financial drivers monthly, like exchange rates or fuel costs, but they don't do a full labor-intensive P&L reforecast every 30 days.
This has been a complete re-architecting of the finance function. Let's bring it all together. What does this all mean? Can we recap the critical timeline that makes this day 3 close possible, focusing on how we've moved key activities around?
Okay, let's do it. We have to start early, ensuring discipline well before the month is even over. So by day -3 and earlier, you've finalized payroll and depreciation, and your key balance sheet GL accounts have been reviewed for reasonableness. Critically, that daily bank reconciliation process, DBR, is already established and running smoothly.
Right, so DBR moves from a month-end fire drill to an ongoing hygiene task. By day -2, we have our first critical hard cutoff. The close-off of accruals usually by noon, based on that 40-50% materiality rule. And you ensure the DBR is complete for that day.
Then day -1 is the final big cutoff day. You close off AP, AR, your work in progress transferred to finished goods and production for the last day, all typically at noon or 5 p.m. That's followed by the crucial first close, the GL. And that first cut of the numbers with the comparative columns is available to your budget holders by 5 p.m. for their night review.
The 24-hour sprint begins on day +1. DBR is completed for day -1. The budget holder's commentary on major variances, that $40,000 indeed 10% rule, is due at noon. The team meets, reviews the overs and unders schedule, and only books the truly material adjustments needed for a true and fair view. The flash report goes to the CEO by 5 p.m.
And finally, day +2 and day +3 are dedicated to quality assurance and the final reports. DBR continues daily. Budget holders complete their detailed reports, and the finance team conducts its quality assurance procedures, using that quiet time for real analysis. The final concise report preparation and issue happens by the end of day 3.
That is a remarkable transformation. You're moving from a 9-day processing cycle that costs $1 million a year to a disciplined 72-hour delivery schedule that frees up 40% of your strategic capacity.
The profound shift is really in the structure. The success of rapid month-end reporting isn't about working harder on day +1. It's about disciplined early cutoffs, strict materiality rules that empower your accountants to ignore the immaterial, and fundamentally redefining the role of the accountant to focus on insights.
They move from being a clerical cleanup crew to being strategic insight providers. They're leveraging that 75% future focus model. The data gets delivered when it's still relevant, making finance an active partner in current decision-making, not just a recorder of history.
You're transforming the finance function from a necessary evil into a source of undeniable competitive advantage.
Thank you for going on this deep dive with us. focusing on how you can stop being a historian and truly start shaping the future of your organization.
It's worth noting one final detail from the source material regarding leadership buy-in. In the really leading organizations, the senior management team is letting go of that time-consuming process of report rewriting and sign-off. They've informed the board that they simply concur with the writer's findings, delegating the final report to the senior finance writer.
So if senior management can delegate the final sign-off and agree to simply concur with the findings of the finance writer, what deep-seated management practice are you still holding on to? That required approval, that unnecessary review step, that insistence on detailed correction. What's the thing that limits speed and trust within your team? That is something for you to mull over as you plan your own Day 3 close strategy.
Until next time, keep digging.
The deep dive is back, and today we're tackling something that is quietly crippling countless businesses.
And that's the reliance on, well, 20th century technology inside the finance function.
Exactly. We've gone through a whole stack of sources, reports, industry analyses, real-world case studies, and our mission today is pretty clear.
It is. We want to distill the essential roadmap for technology investment.
Right, the roadmap that finally moves finance out of the dark ages and into what you might call a paperless, future-focused office.
And the stakes are high. I mean, this isn't just about making the month-end close a little bit easier.
No, not at all.
It's about mitigating a huge operational and knowledge risk that is, silently building up in companies as we speak. We really need to define what future-focused actually means for a finance leader today.
Okay, so let's unpack that core tension. All our sources point to one fundamental problem.
Chronic underinvestment.
Chronic underinvestment in systems designed for the modern era. And the paradoxes where companies are investing. It's often in completely the wrong place.
Right. Finance leaders are just pouring so much time, so much money, and frankly, so much consulting effort into upgrading the general ledger, the GL.
Which is fascinating, because the actual role of the GL in a modern, sophisticated company has been, well, it's been severely diminished, hasn't it?
It really has. But we still treat it like it's the command center. For so many organizations, the GL's main job now is just the basic task of holding the historical financial numbers for the current year.
So it's the vault, the history book.
It's the vault. That's a perfect way to put it. It is rarely the engine of decision-making anymore.
So if the GL is just the vault, where is the real high-stakes work happening? Where does the operational risk and, the value creation actually live?
It all lives in the auxiliary systems. The critical functions, like timely monthly reporting, rolling forecasts, the high-volume accounts payable process, and the ability for budget holders across the business to actually drill down into their costs and understand them. All of that, it lives outside the main, very expensive GL package.
That reframes the entire investment challenge, doesn't it?
It has to.
We need a complete mental shift. If we're stuck paying millions to upgrade a history book, we are fundamentally misunderstanding our priorities.
Precisely. This reprioritization shifting focus from, historical record keeping in the GL to future readiness in these specialized systems, that is the key insight for any finance leader looking to get a competitive edge.
And the biggest source of that risk.
Yeah.
It comes from trying to force old tools to do a modern job.
It does, which brings us directly to the star player of that legacy world, the one tool that we have to talk about first.
I want to introduce what's going to sound like a really radical idea, but it is supported by a massive amount of data in our sources.
Go on.
Spreadsheets, specifically Microsoft Excel. They must be banned from core finance routines like forecasting, budgeting, and consolidation.
It does sound provocative because Excel is just so ubiquitous. But for any organization that's serious about risk management, it's an absolute necessity.
And it's a revolutionary tool, isn't it?
It was. But it was never designed for large-scale, enterprise-level, complex financial modeling, especially not modeling that involves, rapid consolidation or continuous scenario analysis. It's a wonderful tool for ad hoc analysis, but it just shouldn't be the foundation of a company's financial planning system.
And this risk, it's not theoretical, is it? It's actually quantifiable. We found a truly shocking statistic that was cited by two separate global accounting firms.
That's right. Both Coopers and Lybrand and KPMG, they did these separate major studies on the reliability of corporate spreadsheets. And their conclusion was that there's approximately a 90% chance of a logic error for every 150 rows in an Excel workbook.
Hold on, 90%. A 90% chance of an error for every 150 rows. That sounds almost unbelievable.
It's an almost guaranteed failure rate once your models reach any degree of complexity.
So you're saying if a company's forecast model goes past that threshold, they can pretty much guarantee their numbers are wrong.
Statistically, yes. And this huge exposure is why the sources we looked at introduced this concept of the rule of 100 rows. The rule of 100 rows.
Yeah. The consensus among system designers is that you might be able to build a safe, auditable model in a spreadsheet if you keep it really tightly within that 100-row threshold. Go past that, and you are exposing your entire organization to unacceptable, unmitigated risk.
But what about a really skilled finance team? In a smaller company, where everyone is an Excel wizard, surely they can manage that risk.
Even the most skilled users are susceptible to the inherent design flaws of the tool itself. The problem is structural. I mean, let's just detail some of the specific pitfalls just to drive home why even the best team can't overcome them.
Okay, lay out the pain points. What makes it so unreliable under pressure?
First, and this is the most fundamental, is the reliance on external links and hidden formulas. Someone adds or eliminates a row, maybe a column, in a supporting workbook.
Right.
And when dozens of these things are rolled up, the master sheet is now referencing a cell 2 rows down, just pulling in the wrong data.
That's the classic consolidation nightmare where you spend half the month just trying to figure out which link broke. Exactly. Consolidation errors are just rampant because the spreadsheet was never intended to handle aggregating dozens of different complex worksheets made by different people using slightly different logic.
And the result is what? The screen locking up?
The screen locking up, or even worse, showing a screen just full of those dreaded #REF errors.
And what about just simple input errors, the ones that lead to bad data?
That's the data inconsistency issue. I mean, look, entering the wrong number can happen in any system, but spreadsheet systems often require manual rekeying of information from the GL or the ERP. Plus, a user might just overwrite a formula because they think they have a better number, or maybe they're relying on a hidden lookup table that's months out of date.
The black box nature of it is a huge auditing risk, too. If I inherit a complex model from someone, how do I trust it?
The short answer is you can't, not reliably. The lack of robustness means you can't be confident in the final number, you can't efficiently check all the formulas because they can be hidden in any cell, and you just don't have the quality assurance checks that are built into dedicated software.
It's like finding a needle in a digital haystack.
It is. And then there's the problem that keeps every risk officer up at night. No proper version control.
Oh, yeah. How many critical business decisions are being made based on a file called Q4 Forecast Final Version 7.2, Updated John's Changes.xlsx?
It is shockingly common. But maybe the most serious flaw is about talent and architecture. These complex spreadsheets are built by accounting staff.
Who are brilliant people.
Brilliant, innovative people. But they haven't been trained in the rigorous system documentation and quality assurance that you'd expect from a programmer designing a core company system. You end up with this evolving collage of logic that only the person who built it, maybe one other person in the whole company, has a prayer of understanding.
And if that person leaves?
The business is compromised. The expertise just walked out the door. That's the definition of a knowledge risk. And beyond risk, it's a competitive disadvantage. Well, what if the CEO asks, "We're thinking of shutting down our oldest product line. What's the financial impact, factoring in fixed cost absorption and severance? I need an answer by the end of the day."
Your complex, brittle spreadsheet system can't do that.
It can't. It would take days, not hours, to get a defensible answer.
Let's bring this to life. There's a perfect anecdote in the source material, the one about the financial controller and the new CFO. It just perfectly illustrates why this always ends in failure.
It's a very humbling story for any finance team. So you have this seasoned financial controller, and after weeks of intense work, burning the midnight oil with their team, they proudly present the first draft of the annual budget to the new CFO.
They're feeling confident. They've checked everything.
Exactly. They've done extra QA, cross-checked it against prior years. They're ready for approval. But the CFO, after maybe 5 minutes of just looking at the summary numbers, stops the meeting.
Just like that.
Just like that. He says, this annual plan is wrong. The final profit number doesn't make sense. And the controller is, understandably stunned and a little defensive.
So how does the CFO know so quickly?
He's not looking at the complex model. He's using simple, high-level business logic. He just quickly calculates an expected number using only 3 known inputs. The board-approved planned sales, the historical gross profit margin, which is pretty stable, and some estimated overheads.
And he comes up with a range.
He provides a narrow range where the final budgeted result should fall.
And the spreadsheet number is outside that range. The team has to go back to the drawing board.
They do. They spend the entire weekend poring over this enormous, complex, consolidated spreadsheet. And late Sunday night, they finally find the error.
And when they fix it.
When they process the correction and rerun the forecast, the new number falls precisely within the narrow range the CFO had suggested just minutes after seeing the report.
Wow, that's damning. And the real punchline is that this wasn't a new mistake, was it?
No. They traced the specific logic error back. That exact same flaw had been in the annual plan models for the previous 2 years and had gone completely undetected.
So it was influencing multi-million-dollar decisions.
Without anyone realizing. The CFO's simple, back-of-the-envelope math just validated the inherent instability and risk of that massive spreadsheet system.
That's a mandatory lesson. A clever, highly skilled accountant building something complex in a tool not designed for the job will eventually fail. Not because of a lack of effort, but because of a lack of governance and control.
And that leads to a harsh professional reality. If you are the one person who holds the keys to the company's core financial planning and your title is effectively the Excel expert, you're marking yourself as a technical dinosaur.
It means you haven't embraced modern tools
Or understood the risks, and if you leave, the business is compromised. That is a career-limiting factor in the modern world.
The spreadsheets have served us well, but it's time to admit they've severely limited finance's performance and capacity for rapid, future-focused analysis. The divorce is necessary.
Absolutely.
So, if the general ledger is just the history book and spreadsheets are banned, where should a finance director be putting their investment dollars? We have a clear roadmap here of 7 technologies, all prioritized for maximum impact.
And the investment philosophy is simple. You prioritize systems that let the finance function become a paperless office. And critically, you focus on the auxiliary systems first.
So you only upgrade the core GL after you've squeezed every last drop of value out of what you already have.
Exactly. After you have exhausted and maximized its existing features and acquired the specialized systems that actually drive business value.
And the reason for delaying that big GL investment goes back to a utilization stat we touched on earlier.
It does. Most finance teams, right now, are only using 30 to 40% of their GL's existing features. 30 to 40%.
It's like buying a Formula One car and only driving it in second gear.
It's financial negligence to invest millions in an upgrade when you haven't even used the features you already paid for.
30 to 40%. That's just a massive waste. Okay, so let's look at the correct priorities. What are the 7 key technologies in the recommended order of investment?
All right, here's the roadmap for future readiness. Number 1, implement a dedicated planning and forecasting tool. All those processes move there.
Okay, that's the Excel replacement.
Right. Number 2, upgrade your accounts payable systems. Think automation and electronic expense claims. Number 3, acquire a reporting tool. All reporting migrates there. Number 4, add a drill-down front end to the GL if it's not already built in. 5, install consolidation and intercompany software. 6, acquire a collaborative disclosure management or CDM application.
And the last one.
And number 7, implement an electronic board paper application.
That roadmap is a complete philosophical shift. The whole goal is pushing data accessibility, control, and future-focused decision-making out of that centralized ledger and into these fit-for-purpose specialized tools.
We're shifting the investment away from the historical repository and towards systems that enable rapid, agile management. The truth is that dedicated tools are almost always cheaper, faster, and better at their specific job than some all-in-one GL solution or a precarious spreadsheet.
Before we jump into priority number 1, let's just touch on that 30 to 40% stat again. How can a finance team maximize their existing GL right now before spending big?
2 simple, high-impact actions. First, you have to train and delegate. Train your budget holders relentlessly on how to use the GL interface for their specific transactions. Delegate responsibility for maintaining their part of the ledger to them.
So you foster local ownership.
Exactly. It reduces the bottleneck on the core finance team.
And the second action sounds incredibly low-tech, but high yield.
It is. Invest in a simple consultant visit. Get a GL expert in, even for a single day next week, to review how your organization uses the system and remind the team of built-in features that were covered in training years ago but have been forgotten.
And that consultant can unlock features you didn't even know you paid for.
Often, yes, like advanced purchase order processing. Getting that short, targeted review done 3 or 4 times a year is a much better investment than sinking millions into a new, confusing system.
Okay, let's focus on priority number one, planning and forecasting tools. This is the direct replacement for that spreadsheet monstrosity we talked about. Why are dedicated tools so essential?
Well, the decade of relying on spreadsheets for budgeting has shown us a pattern. What starts as a simple, manageable model inevitably grows into an out-of-control monstrosity. Dedicated planning tools solve the fundamental problems of scaling, version control, and governance that spreadsheets just cannot handle.
And our sources really emphasize that these tools are highly accessible now. They're for all sizes of organizations, from SMEs to multinationals. Many have cloud options. We're talking about suites like Adaptive Planning, IBM Cognos TM1, or Oracle's Hyperion Planning.
And their superiority really lies in two key areas: integration and speed. They're designed specifically to pull data seamlessly from the GL, ERP, HR systems, operational databases, all without manual rekeying. And that integration enables the speed you need for true scenario analysis.
That speed is so critical. How does a planning tool provide a rapid, defensible answer to those complex what-if questions in a way Excel can't?
Let's take that CEO question again. What's the financial impact if we stop production of this line today?
Right.
A planning tool has all the business rules and linkages, overhead allocations, fixed costs, tax impacts, all resident in its programming. You simply change one assumption, zero output for printer production, you hit tabulate.
And the system instantly generates a new P&L, balance sheet, and cash flow forecast.
All while maintaining a full audit trail. You can then instantly compare that scenario to your base forecast. Trying to do that in Excel requires days of nerve-wracking manual adjustments and cross-checking.
To really illustrate the power of this, we have the detailed case study of Balance Agri-Nutrients. Tell us about the sheer scale of the mess they had before they modernized.
Balance is a large farmer-owned cooperative in New Zealand, a significant enterprise, 700 employees, running a sophisticated SAP ERP implementation.
So, top-tier systems across their supply chain and finance.
Right, but despite all that investment, their core forecasting was still reliant on these legacy Excel files.
So their history book, SAP, was state-of-the-art, but their planning engine was a relic.
Precisely. Their 15-year-old Excel forecasting model had reached a point of absolute failure. It had ballooned into 254 separate workbooks.
254?
254, and it required a manual, nerve-wracking 5-hour consolidation process every single month.
I think everyone listening just had a physical shudder imagining opening that file, waiting for the hashtag REF errors to just flood the screen.
Yeah.
That's genuine PTSD for finance professionals.
The staff genuinely dreaded this monthly consolidation. And beyond the operational pain, their planning cycle was broken. They were stuck preparing annual budgets 3 to 15 months ahead, which meant the finance team was constantly chasing its tail, trying to justify why a forecast made so long ago was already wrong.
They were defending history instead of guiding the future.
Exactly. That's what they needed to change.
So how did they approach the selection process? Because that's where so many companies go wrong.
They took a highly disciplined, strategic approach. They identified 2 major options. Option A was a planning tool linked to their existing GL provider, SAP. Option B was a Tier 1 standalone product, like Cognos TM1.
Okay.
And critically, they hired a developer to act purely as a facilitator for the blueprint design.
Why separate the designer from the implementer?
To maintain control and ensure vendor neutrality. They made it explicit that the final blueprint had to be implementable by any provider, not just the one who designed it. In fact, the facilitating developers organization actually lost the subsequent implementation bid.
But Balance happily paid them for the blueprint work.
They did because it confirmed that they owned the design specification, not the vendor.
That is a masterclass in strategic procurement. You hire someone to tell you what you need, but you hire someone else to deliver it. It ensures the blueprint is truly optimized for your business.
And it secured their success. The implementation method itself was based on this intense upfront investment, following what's called the Toyota principle.
Which is?
Make decisions slowly by consensus, thoroughly considering all options, and then implement the decisions rapidly.
Make decisions slowly. How did they put that into practice?
They held 3 separate 2-week workshops, a full 6 weeks of focused design and consensus building. This ensures every piece of logic in the new system is well thought out, prevents errors, and critically, it ensures they retain the helicopter or big picture view throughout the technical rollout.
It prevents that carnage at the base of the cliff when you launch poorly planned systems.
Exactly. And the most important organizational principle they followed,
What was that?
the implementation was unequivocally business-owned, not finance-owned.
Ah, that's the key insight.
It is. The new system was a tool for the entire organization, not just for the finance department. The system testers came directly from the business units, sales, operations, supply chain, not from the external provider. This guaranteed that users had industry insight during testing and fostered immediate ownership before the system even launched.
So what were the results? What did implementing the new TM1 rolling forecast system actually do for them?
It completely transformed their planning cycle. The forecast became a truly continuous rolling business view, totally untied from the annual financial year. They now detail 18 months ahead with a summary level out to 36 months. And this is updated monthly with inventory data, quarterly with financial numbers, all linked directly to their ERP and their sales and operational planning processes.
And what happened to the finance team's role in all this?
Far from becoming obsolete, their roles shifted. They went from being data entry and reconciliation grunts to becoming strategic analysts. Finance now focuses on testing the process, ensuring the right questions are being asked, and leading the what-if analysis. They moved from historical reporting to future guidance.
After 2 years, what were the profound, quantifiable benefits that Balance achieved?
The benefits were huge, both internal and external. They achieved significant savings by getting a much better understanding of their bank facility requirements, which led to reduced borrowing costs. They provided more accurate profitability and dividend predictions.
But the most impressive benefit was external, right?
It was the ability to pay rebates to their shareholders, the farmers, 6 weeks earlier.
Which significantly improves cash flow for those farmers, proving that this kind of tech investment isn't just about making internal accountants happy.
Exactly. It became a strategic competitive advantage. It made the entire organization demonstrably more future-focused, allowing them to better recover cost fluctuations and ensure long-term stability. It's just proof that moving away from spreadsheets generates real, tangible business results.
Okay, moving to the next step on our roadmap. Priority number 2 focuses on accounts payable systems. AP. Our sources make a strong claim here
They do.
that AP provides the best return on dollar investment of any service department in the organization. We need to elaborate on why that ROI is so high.
AP is the low-hanging fruit for investment because it's universally paper-heavy, manual, and just prone to errors and bottlenecks. I mean, traditional AP involves sorting mail, stamping invoices, manual data entry, routing paper for approval, and then physically filing it.
And technology just eliminates most of those low-value steps.
It eliminates the vast majority of them, which yields rapid and tangible returns.
So let's talk metrics. How do we calculate that ROI?
Well, studies repeatedly show that the average cost to manually process a single invoice can be anywhere from $8 to $25.
Wow.
Yeah. And if you factor in labor costs, say a clerk spending 20 minutes on an invoice automation, can slash that per invoice cost down to $2 or less. For an organization processing thousands of invoices a month, the savings are instant, significant, and recurring.
Plus, you eliminate late payment penalties.
Right, because the system handles routing speed,
Yeah.
and you free up highly paid staff for analytical tasks.
So if the ROI is so great and so obvious, why is AP still so consistently underinvested in?
3 main reasons. First, a widespread lack of understanding by the CFO of the specific rapid ROI these technologies offer. They see it as an administrative cost, not a profit enhancer.
Okay.
Second, the AP team itself often fails to research the modern tech that's available. They're too busy processing invoices to be strategic. And third, the application suppliers themselves have historically done a poor job of educating buyers on the transformative power of their tools.
But the shift is happening. We have data that indicates the transition is gaining momentum.
It is. Our source material notes that 53% of organizations are using electronic payments now, and 46% are using purchasing cards. If you're still relying heavily on paper checks and manual approvals, you're already falling far behind your peers.
Total automation is the near future.
It is.
So describe the components needed for this comprehensive AP automation solution.
It requires a chain of integrated systems. You start at the point of receipt with optical character recognition OCR and data capture to pull data from invoices. That's paired with secure invoicing networks. This then feeds into robust purchase order matching and ERP integration.
And then comes the brain of the system.
Right, a smooth, rules-based approval workflow. And finally, secure e-payments via ACH or purchasing cards.
What's the single most transformative part of that chain?
The rules engine. It enables the automated answer to the critical question, Does this invoice need human approval?
So the system uses business rules to decide.
Exactly. Based on thresholds, supplier contracts, historical pricing, PO matching. If the invoice matches the PO and is within a pre-approved variance, it moves straight to payment. If it needs approval, the system instantly routes it to the right budget holder, along with all the necessary decision support documents.
The system takes the transactional decisions out of human hands, freeing them up for exceptions.
Precisely. And before you invest in brand new software, we have to go back to that GL maximization point. AP teams should immediately go research local organizations that are successfully using their current GL's integrated purchase order system. Most GLs have this feature, but teams just ignore it.
Go visit a peer who does it well and learn from them.
It's practical, it's cheap, and it works.
All right, that's practical advice. Moving to priority number 3, reporting tools. The goal here is simple. End the reliance on Excel for internal reporting.
And remember, the GL is just a data collection point. Dedicated reporting tools. We're talking about business intelligence or BI, platforms like Tableau, QuickView, Dundas, Sisense. They collect this GL data nightly or weekly.
And that shift is profound.
It is, because it allows budget holders to drill into their revenues and costs throughout the month, rather than waiting for finance to issue a month-end report, which is already history by the time they get it.
And these tools inherently solve the reliability and consistency issues of Excel downloads.
Absolutely. Think about cross-year comparisons. In Excel, that means manually downloading last year's data, manually formatting it, and just hoping a formula doesn't break. BI tools maintain data in a continuous stream, providing seamless trend analysis across years. The logic is built into the system, making the reporting virtually bomb-proof against human formatting error.
Finally, priority number 4, turbocharging the GL with a friendly front end. This ties directly back to making budget holders own their numbers.
If you want budget holders to take responsibility, they need easy access to their slice of the financial data. They need a user-friendly interface that lets them see what's going on without needing a PhD in accounting system navigation.
So how do these drill-down front-end tools achieve this without exposing the core GL?
They download transactions daily or weekly for read-only access. The budget holders never have to look at the GL directly, which prevents potential input errors or security risks. And the functionality is key. They enable trend analysis that seamlessly transcends the year-end cutoff.
So a manager can pull up a graph of utility costs or travel expenses over, say, 18 or 24 months.
Without any manual manipulation or creating a Frankenstein Excel sheet.
This functionality completely changes the conversation around upgrading massive ERP systems.
It does. It allows CFOs to step back and question the necessity of pouring massive investment into the most expensive Tier 1 GL systems.
I love the anecdote about the CFO in Australia. His organization, 400 full-time employees, runs their GL on a simple, inexpensive system like MYOB.
And his justification was simple.
He said, why invest millions when all the general ledger does is hold the historic numbers and only 2 accountants ever access it directly? All their high-value activity, the reporting, the drill down, the forecasting, it's all performed in these auxiliary specialized systems. The GL is just the vault. That perfectly summarizes the modern finance philosophy. Spend the big money where the business value is created, in the auxiliary systems, and let the GL be the simple, efficient, historic ledger it was designed to be.
We move now into the governance systems. These are the systems that ensure the integrity of the data once it leaves the individual business unit. Starting with priority number 5, consolidation and intercompany software.
And this is where the source material gets blunt, asserting that performing consolidation in a spreadsheet is inappropriate, or, put more bluntly, is stupid.
Given the error rates we discussed earlier, stupid seems justified. The value of these specialized consolidation tools is in efficiency and control across diverse, often multinational entities.
So they allow subsidiaries to keep their own specialized GLs.
Exactly. Excellent systems exist that let subsidiaries keep their own GL and their unique account code structures, which are often necessary for local compliance. You don't need to force a global standardization. Instead, the subsidiary's trial balance is simply mapped to the parent entity's account codes. The system handles all the conversions and eliminations automatically.
And this leads us to the common trap that CFOs of conglomerates often fall into, the standardization trap.
Yes, CFOs are often convinced they need to standardize the GLs across all their subsidiaries onto a single chart of accounts for better consolidation. And while that will technically work,
the source material warns that the primary beneficiaries of this massive, multi-year, costly exercise are the GL providers and the consulting firms.
the ones who charge exorbitant fees to harmonize global charts of accounts.
So standardization is often a consultant-driven benefit, not a business necessity.
It often is.
Yeah.
And dedicated intercompany software removes this necessity. Tools like CoProcess SA or solutions within the Blackline Intercompany Hub, they provide an automatic interface for intergroup transactions.
Can you elaborate on that automatic interface?
It's highly efficient. So when subsidiary A sells goods to subsidiary B, the transaction is entered once by subsidiary A. The intercompany software automatically ensures that the corresponding ledger entry is recorded in subsidiary B's GL, regardless of the fact they might be running a completely different accounting system.
Which allows subsidiaries to retain their preferred localized GL and account codes, saving immense time and complexity.
And consulting costs.
Moving on to priority number 6, collaborative disclosure management, or CDM. This sounds like the ultimate safety net for external and board reporting.
CDM software ensures you have one database that is the sole source of the truth across all your reporting channels. Think of the sheer volume of numbers you publish annually. The annual report, quarterly filings, investor presentations, board packs.
Every single number needs to be consistent down to the decimal point across every document.
Right. And CDM automatically links all these disparate documents, Word, Excel, PowerPoint, to that central database. When the underlying numbers change, say because of a final audit adjustment, CDM software automatically updates every single instance of that number across all reports. It even recalculates disclosed variances and related narratives automatically.
So if profitability moves from 40 million to 40.5 million, the commentary, the graphs, the statutory filing, all update simultaneously, it just eliminates the risk of human transcription error.
Exactly. It ensures that the commentary and numbers remain perfectly internally consistent. The source material makes a very strong professional assertion about this technology.
Which is?
For organizations with over 400 full-time employees, it's considered genuinely unprofessional for a finance team to report to a board and shareholders without CDM software. Tools like Paygitic, IBM Cognos, or Hyperion, it just dramatically speeds up the production of all your critical documents.
Finally, priority number 7, bringing the entire governance stack into the 21st century, the electronic board paper application.
Board procedures are often the last bastion of paper and outdated technology. Board members get these huge, dense paper packs, often arriving late by courier, which they rarely have time to read thoroughly. Specialized software is the elegant solution.
And what specific efficiencies do these systems offer?
Systems like Diligent or Azus Convene offer absolute security, which is paramount. They allow instant access from anywhere, anytime. They have features like intuitive use, the ability to attach notes easily, and instantaneous edits and page numbering. It avoids all the security risks of emailing sensitive documents around.
And the actual meeting experience is completely modernized, isn't it?
It's transformed. The modern boardroom rule is no papers allowed. Instead, board members use screens embedded into the table. The chairperson loads the relevant paper, and every member sees the same document instantly, while being able to access their own private, secure notes on their screen.
So it not only improves governance, but dramatically accelerates the entire decision cycle.
Absolutely. Board papers can be read as they're ready, instead of waiting for one final late paper to hold up the whole pack.
We've covered the what, now we need to focus on the how. Adopting a suite of new systems requires careful change management. Our sources stress that the time dedicated to planning is what avoids that costly carnage at the base of the cliff.
And that planning starts with appraising your options correctly. And here, we have to issue a strong warning. The first mistake many finance teams make is issuing a generic request for information, an RFI.
Why is an RFI bad advice? It sounds like due diligence.
It's the opposite. An RFI will bury you in details. Every provider will respond with massive amounts of generic, unusable documentation and immediately turn you into their newest hot sales prospect. Your team will spend weeks wading through marketing collateral. It's a huge resource drain.
So what's the targeted strategic research strategy instead? We need to limit the choice to the best 3 candidates.
You leverage the wisdom of your peers. Don't rely on vendors. Contact your existing GL supplier and ask for the contact details of the 3 most sophisticated, happy users of your GL system in your region. These are the organizations that have already figured out how to successfully link auxiliary systems.
And then you visit them.
Absolutely. Arrange to visit those 3 sites.
Yeah.
This is where you learn what tools they use, how they link them, what their pain points were, and crucially, what their ongoing support costs look like.
You also need to search locally for tools with local support.
Yes. You want to avoid those high-cost situations where a team has to be flown in each week and stays at five-star hotels just to fix a minor issue. And remember the vendor warning. Packaged tools are not always the best.
Right. The tools packaged with major GLs are often not best in class.
Independent, dedicated tools can accept data from any GL and are often cheaper and functionally superior.
Okay, so once we've narrowed it down to 3 or 4 solid options, the next step is getting approval for the formal request for proposal, or RFP.
You need a focused presentation to senior management. And don't talk about technology, talk about risk. Highlight the current spreadsheet pain points, the status of the failing application, the findings from your peer visits, and the short list of recommended providers and costs. The focus has to be on mitigating risk and improving future readiness.
Once we have the final 3 candidates, we move into the crucial paid testing phase. This is the ultimate differentiator.
We call this the paid test strategy. You reduce your providers to the best 3, and you request that they demonstrate how their application works, not with their canned, perfect data, but with your organization's messy data.
You force them to prove it in your environment.
Yes, and you agree to pay them 2 to 3 days of consultancy fees for this exercise. This is a strategic bargain. Providers will often invest way more time preparing this proof of concept, and paying the fees ensures you retain copies of the work if they refuse the paid test.
They're immediately disqualified.
Exactly. They aren't confident in their own solution. This also serves as a final, critical evaluation of the consultants themselves, which is arguably more important than the software.
Right. You want consultants who can present complexity simply.
If they start throwing around excessive technical jargon or make implementing a forecasting model sound as complex as setting off for the moon, avoid them. You need a team that simplifies the process, not someone who sees unnecessary complexity in everything.
Okay, moving into the contractual process. What are the crucial tips to avoid pitfalls?
Be prescriptive about resources. Ensure the key consultants you liked during testing are contracted for a specific number of days. Tie interim payments to specific agreed-upon deliveries, not just elapsed time.
And the most important contract term regarding the system build to ensure long-term institutional knowledge.
You must contract the model building to be done largely by in-house staff who are trained and mentored by the vendor. This is critical. External consultants will never understand your organization's messy nuances better than your own team. Training your staff to build the model ensures the system is fit for purpose, and that knowledge is retained long after the consultant leaves.
This minimizes dependency on expensive consulting fees later. You also mentioned selecting at least 4 internal staff to become experts. Why 4?
You need redundancy. These internal experts are often highly sought after and eventually get headhunted. If only one person knows the system, you're right back in that knowledge risk scenario we talked about earlier. 4 provides internal competence and long-term health.
Finally, let's look at the rollout strategy. Peter Drucker's advice on piloting systems is foundational here.
Peter Drucker noted that when you implement a new system, you must select at least 3 pilots across different business units. He famously said 1 pilot is never enough, as other units will always claim the chosen one wasn't representative. 2 is better, but 3 is best. It provides consensus and comprehensively tests the system's ability to handle diverse realities.
And what are the best criteria for selecting those 3 pilot business units?
You select BUs that have 3 key traits: a good existing relationship with the implementation team, a highly supportive leader, and a history of adopting technology well. This increases the chances of initial success, allowing you to fine-tune the tool on those 3 runs before the full mass rollout to the rest of the organization.
This disciplined, consensus-driven approach, mirroring what we saw at Balance, is really the bedrock of implementing a future-ready finance system.
It is.
This deep dive has provided a clear path forward for finance leaders. The era of the single, Excel-driven, GL-centric finance function is over. The future demands automation, specialized, fit-for-purpose tools for planning, AP, and governance, and absolute visibility for budget holders. This shift empowers the entire organization and provides that single version of truth the C-suite demands.
And the overriding insight is the strategic importance of prioritizing those auxiliary systems over the general ledger. We've seen overwhelming evidence that the best solution for many organizations is running the GL merely as an efficient historic ledger. The vault in shifting all active reporting, forecasting, and control to these specialized systems, the engine.
But this raises a final crucial question for you, the listener, to consider.
We noted that finance teams are often sold overly complex GL systems, often designed by people who prioritize complexity over usability. This leads to high consulting costs and an organization being held hostage by its own system. So, if the GL's primary job is simply to hold historic numbers, and the biggest productivity gains come from cheap, independent systems doing one job well, what percentage of your existing multi-million-dollar GL are you truly using?
Think about that 30 to 40% utilization statistic. You paid millions for an ERP designed for everything, but the greatest efficiencies often come from systems that only cost thousands.
This creates a profound paradox. Are the biggest GL providers actually selling you a level of complexity you don't need, holding your organization hostage for their benefit? Before you approve that next huge upgrade, ask yourself, how much efficiency could you unlock with a simple, inexpensive consultation on your existing system, instead of sinking massive funds into a transformation you might not actually need? Focusing on simplification is the true marker of future-ready finance leadership. Welcome to the Deep Dive. Today, we're heading straight into the heart of the corporate financial machine.
The engine room.
Yeah, exactly. We're talking about accounts payable.
Right.
Now, AP, it might sound like a purely back-office chore on the surface, but our sources today argue that it's the absolute center of any healthy accounting operation.
It really is.
Without AP running smoothly, the entire finance team and frankly, the entire business can never really move forward strategically.
What's fascinating here, and what the source material really digs into, is that AP's efficiency dictates the speed and accuracy of the whole enterprise.
The whole thing.
The whole thing. If your AP team is just drowning in paperwork and, manual processes, it's basically impossible for the CFO to get timely, accurate data. Our source material for this, Chapter 5 of Finance 6 Dimensions, it details these better practices from leading-edge finance teams. And they're all aimed at this colossal objective, reducing accounts payable processing volumes by 60%. 60, not 60%. That's a transformation, not just an optimization.
It's a total overhaul.
And the reason this kind of drastic intervention is needed is because, and I love this phrase from the source, too many organizations are wedded to Charles Dickens' processes and procedures.
That's a great line.
It really paints a picture.
Yeah.
I mean, you think about it. Charles Dickens, writing in the 19th century, he had a checkbook, he dealt with paper invoices.
And here we are.
Right, here we are in the digital 21st century, and so many companies are still relying on paper, physical signatures, manual data entry. I mean, these are processes that are fundamentally unchanged since the Victorian era. It's kind of shocking.
And we connect that to the bigger picture, the consequences of clinging to those Dickensian procedures. They aren't just about slow bookkeeping. They are severely detrimental to the health of the organization. Our source material points to, I think, 4 key failures that come from this.
Okay, let's break them down. What's the first one? First is the delay in reporting. It's the most obvious. When AP is slow, monthly accounts simply cannot be prepared promptly.
Which means management is flying blind.
Or at least they're making decisions based on old, stale data.
Okay, so that's number 1. What's next?
Second, accuracy just. It suffers. The organization doesn't know its total liabilities accurately at any given point in time.
Because you've got invoices sitting in piles somewhere.
Exactly. You could have hundreds of invoices piled up, waiting to be entered, waiting for an approval, so your balance sheet is fundamentally flawed. And that leads to low accuracy, missed liabilities, posting errors, a real mess.
And third, this one feels like the hidden cost.
It's a huge one. Budget holders, we're talking about highly paid strategic staff across the business, they end up wasting just valuable time processing orders, signing forms, chasing approvals for things that should be totally automated.
It's a massive misuse of intellectual capital.
A complete misuse. And finally, number 4 is that constant irritating stream of supplier queries.
Where's my payment?
Did you get my invoice? Why are we overdue? It consumes an enormous amount of the AP staff's time, just adding to that clerical burden instead of letting them do, actual accounting.
So the mission for this deep dive is to unpack the strategies that these leading finance teams are using to break that cycle.
Yeah.
We're looking at specific tech investments, aggressive paper elimination.
And crucially, the part people often forget, the organizational and behavioral changes that you need to actually make it all stick.
Right. Because the ultimate goal, and the data in Exhibit 5.1 from the source backs this up, is shifting the AP workload away from those routine clerical tasks and into more value-added areas.
And that shift is everything. We're going to show you how to transform AP staff from, data entry clerks into strategic analysts.
Okay, let's unpack this transformation. I think we have to start with the core strategy outlined in the source.
Mm-hmm.
Removing those Charles Dickens processes and just committing fully to going pagerless.
The initial strategic move is, well, it's simple in principle, but it requires absolute executive commitment.
And then that is?
Invest in AP technology and eliminate the receipt of paper-based invoices, period. The sources are so clear that this shift, it isn't just about financial efficiency. There's a huge human element. It boosts job satisfaction for the AP team. I mean, nobody enjoys tedious data entry and filing, right? And it increases appreciation from those budget holders who are currently just drowning in physical paperwork.
This brings us to a fundamental question the sources raise, which I think is just the irony of paper. We're in a world where a transaction starts electronically, a supplier creates an invoice and their system is generated from a digital ledger. So why? Why does it then become a piece of paper?
It's madness.
It's physically printed, mailed, manually opened, scanned, entered. It's a ridiculous, completely unnecessary step backward.
It is pure legacy thinking. I mean, leading U.S. multinationals solved this problem decades ago. The fact that we still rely on paper today is purely an organizational inertia problem. It is not a technical one.
So we need a toolkit to fight that inertia.
A very specific toolkit, yes.
So what does that paperless toolkit look like? The foundation, according to our sources, has to start way earlier than the invoice itself.
Oh, way earlier. It starts with the order.
Before any money is even committed.
Precisely. The bedrock is electronic ordering systems or, sophisticated procurement systems. You have to establish control at the very, very beginning of the spending cycle. And the sources are incredibly firm on the sequence here. These systems must be purchased and, this is the critical part, fully implemented before the accounting team even thinks about upgrading the core general ledger.
Okay, so why is that sequencing so critical? Why fix procurement before the GL?
Because the GL just processes the outcome of the transaction. The procurement system controls the commitment of the funds in the first place.
Garbage in, garbage out.
That's it. If you upgrade the GL first, you're just trying to efficiently process garbage input. A good procurement system gives you real-time control. It gives you 24/7 access to supplier price lists. It makes sure you're using preferred vendors, and it can auto-email the order as long as it's within the budget holder's authority.
So you control the spend before it becomes a liability.
And that drastically reduces all the queries and mismatches later on. You enforce the rules on the commitment, not on the consequence.
That makes a lot of sense. And the source has a great piece of practical advice. If implementing a whole new system seems, overwhelming.
Yes. It says if it feels daunting, your organization should go and visit another organization that successfully uses the exact same purchase order system.
Learn from their mistakes.
Exactly. Learn from their journey, their pitfalls, their best practices. Don't try to reinvent the wheel internally. It saves a huge amount of time and money.
Okay, so order is under control. We move to the invoice itself. We need the invoices to be fully electronic via electronic supplier feeds.
Right. And this is a significant resource commitment, but the payoff is massive. The organization has to invest dedicated liaison time, and we're talking high-level time and resources, between its own IT team and the major suppliers' IT teams.
This isn't just sending a few emails, though.
No. This is organizing meetings, collaborative sessions, really working together.
And the specific objective of that high-level meeting is what?
The objective is to organize robust electronic feeds of the invoices, which must, ideally, include the general ledger account codes already attached.
So it arrives pre-coded.
That's the dream. It requires some upfront work mapping out the GL codes for the supplies, but the source notes this is surprisingly manageable. Most big suppliers won't affect more than, say, 3 GL codes across the business.
And once that mapping is done, the system just takes over. The invoice data arrives ready for an automated 3-way match.
And that's where you start to see that 60% volume reduction really take shape.
Okay, so now we can tackle internal paper. Expense claims. The solution here seems pretty obvious. Mobile tech.
Exactly. Web-based expense claims integrated with mobile phones. This eliminates the physical receipt problem entirely.
So employees just take a picture on their phone.
Yep. They use their phone to photograph the receipt, upload it directly into the claim system, and, crucially, the system should allow them to immediately throw away the physical receipt.
As long as the image is good.
Yeah. As long as the image is high quality and auditable, yes. That immediately frees up AP staff from receiving, sorting, filing, and storing thousands of those tiny little thermal paper receipts every single month.
Okay, that's a big one. And for general invoices, the ones that are still coming in messy.
For that general invoice reception, the sources suggest a really immediate tactical implementation, a dedicated electronic invoice reception email address.
Like accounts payable at company.com or something.
Something exactly like that. It sounds simple, but the discipline required to maintain it is huge. The goal here is immediate image capture and a standardized inflow.
So everything goes to one place.
Everything. And by requiring all invoices to be sent to this one address, you create an immediate digital image of the invoice the moment it's received. This dramatically reduces the need for manual scanning.
Which the source says should only be temporary anyway.
Exactly. Scanning should only be a stopgap measure while you transition away from paper, mainly for handling the exceptions, like an invoice that shows up without an order.
So AP's role shifts from data entry to exception handling and workflow management.
Yes. And that ties directly into eliminating the sheer volume of supplier phone calls.
The where's my money calls.
That volume is pure clerical waste. And you can cut it drastically by implementing supplier self-service.
What does that mean practically?
You grant your key suppliers online, read-only access password protected, of course, to their specific account ledger within your AP system.
So they can see their own data in your system. What's the benefit?
The supplier can reconcile their own ledger against yours whenever they need to. They don't have to call your AP team to ask, did you get invoice 1234, or when are you paying us?
They can just log in and see the status.
They see the payment status, the expected date, everything. It just minimizes those time-consuming phone queries that interrupt the AP workflow.
And finally, closing the loop on paper. Electronic remittances.
This is a non-negotiable step. You post remittances electronically onto your secure, password-protected supplier portal. Suppliers log in, download them, and it removes all the cost, paper, and delay of emailing or posting physical remittance advice.
Okay, that covers the core paperless strategy. Now let's move to what the sources identify as the absolute core strategy for volume reduction.
Hit the big one.
The purchasing card, or P card. But before we get into how it works, we have to talk about the inefficiency it solves. You mentioned this stunning estimate, the full cost of processing a single transaction.
It's between $35 and $55 per transaction.
That number is hard to believe. How do they calculate that?
Well, that figure isn't an arbitrary guess. It's the result of an end-to-end activity-based costing analysis. We have to stress that $35 to $55 is not just the AP clerk's salary.
Right. It's everyone's time.
It's the budget holder's valuable time spent approving low-value forms. It's the overhead for paper, printing, storage. It's the IT support for the GL system. And critically, it's the cost of handling all those supplier queries about late payments. It's the cost of the entire manual process chain.
So when you realize that processing a $10 purchase of office supplies is costing the organization $40 just to manage the paper trail.
The true scale of the inefficiency just becomes blindingly clear.
And that's the whole argument for the purchase card system.
Exactly. But it has to be marketed correctly internally. The sources insist on this. You must never call it a credit card.
Why not? What's wrong with credit card?
Because that implies a personal or corporate liability instrument, for travel or entertainment. Instead, you market it as a free accounts payable system.
A free AP system.
It's free to the buyer because the entire administrative burden reconciling transactions, generating reports, the tech interface, it's all run by the card provider, and their cost is financed by the interchange fees paid by the suppliers. It is genuinely a no-brainer tool for volume control.
And this card directly targets the most wasteful part of AP processing. Can you walk us through the volume versus value profile of typical AP transactions?
Certainly, this is where the data from Exhibit 5.2 and the source is so crucial. Organizations consistently find that invoices under a certain low threshold, the sources suggest around $2,000, represent 70 to 80% of the volume of all supplier invoices.
70 to 80%. So most of the paper mountain is just small stuff, minor supplies, small parts, low-cost services.
It is a gigantic number of documents. But, and here's the kicker, if you look at the value spent, those same invoices only represent 20 to 30% of the total value spent.
So high volume, low value.
That's the critical insight. Automation has to target the volume, not just the value. It is completely inappropriate and a waste of high-value staff time to make a budget holder raise a detailed purchase order for a $50 transaction through the traditional AP system.
The P card is the escape valve for all that stuff. Okay, let's look at the mechanics. How does it integrate with financial coding?
The beauty of the purchasing card is its automated GL coding. Because most suppliers for these low-value items are consistent, office supply vendors, repair shops, national contractors, they only affect a limited number of GL codes, usually just 2 or 3.
So the AP team maps those suppliers to the codes up front.
Exactly. They work with the card provider to map those suppliers to the right GL code. So when the transaction feed comes in from the card provider, the coding is already, say, 95% complete.
That front-loaded work eliminates almost all the manual entry.
And the process really shines at month end. The card provider sends an electronic statement feed. On the cutoff day, cardholders get a brief window, maybe 24 hours, to review and code any remaining uncoded items through a web interface.
Which they can do from anywhere.
Anywhere. An airport lounge, at home, and if they forget to code something...
What happens then?
The AP team's role shifts entirely from data entry to exception management. They look at the status, send automated warning emails, and only if absolutely necessary, they code the small leftover items based on the supplier mapping they already did.
Okay, and here's the really transformative part. The payment.
It's the ultimate consolidation. Once the coding review is done, the AP team uploads the entire expenditure feed straight into the GL, and all the individual purchasing cards, maybe hundreds of them, are paid via just one single direct debit payment to the card provider.
One payment.
One payment. Thousands of individual purchase transactions are replaced by one electronic data feed and one single bank transaction.
That is a fundamental change in workload.
Yeah.
But there's a debate companies have to have internally, right? The liability question.
Yes, who holds the liability for the card spending? The source discusses 2 options. The preferred option, the most efficient one, is where the organization accepts sole liability for the card. The organization handles the fraud risk, implements controls, all of that.
And the other option?
The more cautious option is to place the liability with the staff member. They use the card and then get reimbursed before the payment is due to the provider. But
that brings back paperwork.
It reintroduces processing steps and documentation, and it undermines the efficiency gains. The better practice is clearly for the organization to accept liability as long as there are strong internal controls and limits in place.
So let's talk implementation. How do you make sure the P card actually captures enough volume to hit that 60% reduction goal?
You have to set a hard barrier. The source suggests setting a minimum amount before accounts payable will even manually process a one-off supplier invoice.
Like a gatekeeper.
Exactly. The suggested minimum is often around $2,000. The goal is to set this minimum high enough that the purchase card system captures at least 50% of the total transaction volume. If it's only capturing 10%, it's not worth the effort.
You have to make the card the default path for low-value spending.
Absolutely. Issue cards to all employees who make regular purchases, not just senior managers. And crucially, any existing corporate credit cards, the ones often used for travel, should be recalled and eliminated.
Why get rid of those?
Because they're just duplication of effort. They have poor controls compared to the detailed spend management you get with a true P-card system.
Okay, but what about supplier reluctance? Suppliers lose that 2 to 3% interchange fee when a P card is used.
Right, they might push back. The source offers a simple, financially sound solution, offer to reimburse the fee.
You just pay them the 2%.
You can base it on their actual annual spend, which is easy to track from the card system data. For the massive savings you get, avoiding that $35 to $55 processing cost per transaction, paying the supplier an extra 2 or 3% is negligible. It's a calculated cost of efficiency.
All right, so the purchase card eliminates the low-value volume. The next logical step, and this one feels both symbolic and practical, is eliminating the physical checkbook.
This takes not just courage, but real executive leadership, because it forces the whole organization to change.
And the sources offer this fantastic high-visibility tactic, the framed check story.
It's brilliant. The recommendation is to write the very last check, make it payable to an other for a tiny amount, like 99 cents. And then you mount this check in a golden frame with an engraved plaque.
What should the plaque say?
Something that declares the end of the old ways. This is the last check and is a symbol of our drive to end all Charles Dickens processes and transition to a 21st century paperless finance function.
That is incredible internal marketing for a change initiative. But the source suggests A very specific place to hang it.
Yes. The framed check should be mounted prominently, ideally in the CEO's office or the main reception area.
So everyone sees it.
So everyone sees it. And it actively leverages the CEO to start conversations about the company's commitment to modernization. Every time a visitor asks, why on earth is there a 99-cent check and a gold frame? The CEO becomes the champion of the AP project.
Okay, that sets the internal standard. But you still have those reluctant suppliers who insist on getting a physical check. How do you force that transition?
The sources suggest aggressive, time-bound tactics. Mailing letters is too slow, too easy to ignore. Instead, you hire temporary staff specifically to call every single one of those suppliers.
And the message needs to be direct.
Very direct. Blunt, even. The script should be something like, we would like to pay you, but we cannot. We are a modern company and have transitioned all our accounts to electronic payment only. We have thrown away the checkbook and are at a loss as to how we can pay you. If we don't have your bank details today, your payment will be significantly delayed.
That creates immediate urgency. There's a great anecdote in the source about this, isn't there?
There is. One company, to show they were serious, canceled its check payment run completely, just stopped it. This forced the issue immediately. They got 120 suppliers' bank details within 4 hours of phoning them with that simple message.
The risk of not getting paid is a powerful motivator.
It certainly is. And the benefits are undeniable. Lower payment costs, predictable cash flows, and far fewer calls about late payments because electronic transfers are instant and trackable.
Beyond just killing the checkbook, there's a need to optimize payment timing.
Yes. The idea of a payment run has to change. Better practice is to treat electronic funds transfers as just a normal day-to-day activity. You do frequent direct credit runs rather than consolidating everything into one or two massive, stressful runs at the end of the month.
So if an invoice comes in, it's matched, it's approved, it just gets queued up for payment on its due date, maybe that same day or the next.
Exactly. It creates a continuous flow, avoids those peaks and troughs in the AP team's workload, and makes sure suppliers are paid precisely on time.
And what about the month-end cutoff? This is always a stressful time.
Better practice is to implement a strict cutoff for accounts payable at, say, noon on the last working day of the month.
That sounds incredibly rigid. I know so many organizations where AP stays open for an extra day or two into the new month just to capture every last invoice.
And that's the old way of thinking. If AP is held open, even for half a day, it makes it extremely difficult to get prompt month-end reporting done.
But aren't you sacrificing accuracy?
Not really. Holding it open provides minimal financial benefit. Why? Because the accruals you avoid making by pushing those late invoices into the prior month are usually just offset by the accruals you had to make last month anyway. The priority has to shift from minute accuracy of the accrual to speed.
We've got the tech, we've killed the paper, now we hit the hardest part. Changing human behavior.
The hardest challenge. The source stresses that achieving this kind of deep-seated change requires a focused, committed effort for about 12 weeks.
12 weeks.
For the penny to drop, 12 weeks to fundamentally break old habits and build new ones across the entire organization.
And changing the habits of high-level budget holders requires more than just new software. It needs strategic management. Let's look at the proactive cooperative tactics first. The carrot.
The carrot is key. And the most powerful leverage point is often a direct financial incentive. The organization can link performance specifically, their turnaround time on invoice approval, directly to an element of their performance bonus.
So it hits them in the wallet.
It makes compliance personal, measurable, and consequential. Another thing you can do to foster a partnership is establishing account management within the finance team.
So not a faceless AP department.
Right. Instead, you have dedicated finance team members assigned to specific budget holders. Sarah looks after budget holders A, B, and C. Ted looks after D, E, and F. It builds a relationship, ensures consistency, and people know who to call.
I think the most important proactive measure, though, has to be training, especially for new hires. The source talks about a welcome letter for new budget holders.
This is critical. Preventative maintenance. The moment a new budget holder starts, they get a professional welcome letter from AP asking for a brief 20-minute session.
And in that session,
You cover the key procedures, the forms, why common problems happen, and how they can work most effectively with finance. The whole point is to get in there first and prevent new hires from being educated by the uneducated.
meaning they don't learn the bad habits from the existing staff.
You set the gold standard immediately. And on top of that, AP should hold structured mandatory workshops on all the finance systems for existing staff, too, to keep everyone up to date.
Okay, that's the carrot. Now for the stick. The shame and name lists. This sounds incredibly effective, but also a bit harsh.
It's pragmatic. The sources view the cost of noncompliance, that $35 to $55 per transaction, as too high to tolerate. The goal is rapid behavior modification over a short, intense period.
So how does it work?
You prepare a laminated card with league tables of the culprits.
And the card is cut specifically to fit the inside pocket of the CEO and senior management team's jackets.
It makes it literally impossible to ignore. And the source dictates that the SMT must commit to phoning a few culprits every week for those critical 12 weeks. Visibility from the very top.
What metrics are on these lists? What are you tracking?
Specific, measurable nonconformances, budget holders with missing purchase orders, employees with late expense claims, invoices that are sitting waiting for approval outside the set turnaround time.
Things that directly impact AP's efficiency.
Yes. And the message delivered by the CEO or SMT on those calls has to be unambiguous. It has to be blunt. Nonconformance is seen as career limiting.
Oh, career limiting?
The source suggests the budget holder has 3 options. You leave, or they change. It's tough. While the list might be politely titled Budget Holders Requiring Further Training, the underlying message is clear. This is mandatory.
And there's an extreme example in the source that really illustrates the level of commitment needed from the CEO.
It really does. One company implemented a strict 24-hour approval mandate. The rule was simple. If a branch manager missed this 24-hour turnaround on a single day for a single invoice, they lost 1 month's performance bonus.
A whole month's bonus for one missed approval? That is intense.
It's intense, but the sources show that this level of commitment rapidly smooths out the AP workload across the month. It stops that massive stressful spike that usually hits right at month end.
But it can't all be the stick. There has to be a reward.
Yes, and the reward mechanism doesn't have to be expensive. One accounting team gives a simple bottle of wine a month to the budget holder who provides the first complete, fully compliant month-end submission.
A small cost for a huge behavior change.
And, crucially, you amplify that recognition. You record the winner, maybe with a photo, on the finance team's intranet homepage. The positive recognition from peers and senior management is often worth more than the wine itself.
Okay, we've established internal controls and managed internal behavior. Now let's look outward, to the suppliers.
Developing a closer, more strategic relationship with your main suppliers is crucial for hitting that 60% goal. But this starts with a key IT caveat.
Which is?
The process of linking your systems to the supplier systems has to be led by the CFO or the management accountant. It cannot be left solely to the IT department.
Why not?
Because the source notes that IT professionals might find this type of exercise personally challenging, meaning they might focus too much on the technical difficulty and not enough on the strategic financial payoff. This has to be a finance initiative.
A finance efficiency project disguised as an IT project. So what's the aggressive target for integrating with these suppliers?
The goal should be set high and fast. Get the top 5 suppliers all electronic within 3 months. Providing consolidated GL-coded electronic invoices. This requires CFO to CFO level conversations.
Let's talk about the example of consignment stationery. It perfectly illustrates how this kind of consolidation cuts out process volume.
It's an elegant concept. Instead of buying stationery piecemeal with hundreds of small purchase orders and invoices, you designate a single supplier. Then you introduce consignment stationery cupboards on all floors.
So the stationery is owned by the supplier until it's used.
Exactly. Staff just take what they need, the stationer replenishes the cupboards weekly, and the organization completely avoids raising purchase orders or processing multiple invoices for those supplies.
You get one invoice at the end of the month.
One consolidated electronic invoice monthly. And the data is invaluable. That single invoice details floor-by-floor usage statistics. You cut dozens of invoices, eliminate purchase orders, and get critical data on internal consumption all at once.
That's a perfect example of value add. Another advanced tactic is asking major suppliers, like utilities, to adjust their invoice cycle.
This is a negotiation, but the benefit to the buyer is substantial. If a utility company shifts its billing cycle earlier, say it covers May 28th to June 27th, and you get the invoice by June 28th, Your finance team avoids the complex, time-consuming effort of making accurate accruals for those last few days.
Because it's offset by last month's accrual anyway.
Right. The impact on the financials is minimal, but the time saved at that crucial month-end deadline is huge.
And we also need to enforce the order mandate, but outwardly this time toward the supplier.
Yes. The AP department has to support the budget holders by returning any supplier invoices that don't have a corresponding electronic purchase order number on them.
The message is simple. No PO, no payment.
Exactly. We cannot process this invoice until the order number is provided and matched. The supplier won't want to repeat that hassle more than once. It shifts the administrative burden back to them.
And the final integration point, requiring supplier data entry.
This completely flips the responsibility. You require suppliers to enter their transactions directly into your system via a secure portal. The source uses the IBM example. No order number, no technical way to even enter the transaction. It's the final word in purchase control.
All right, we've saved the most advanced tactic for last, the self-generated or buyer-created invoice system.
This completely eliminates the need for the supplier's paperwork at all.
It takes the buyer's control to its logical extreme.
And it's usually reserved for high-volume, standardized goods. Raw materials, bulk items, things bought on fixed annual contracts. The customer generates the invoice based entirely on their own internal receipt metrics.
So you're telling the supplier, here's what we received and here's what we're paying you.
Precisely. That is a massive shift in trust and process, and it relies on the buyer's internal controls being absolutely impeccable.
So how does it work practically?
The process starts when the goods arrive. The quantity is determined by the buyer's validated internal systems. It could be a certified weighbridge, an automated counter, whatever. That verified quantity is then multiplied by the agreed contract price, which is already in the system.
So the buyer calculates the amount, generates the invoice document internally,
sends the supplier the electronic self-generated invoice, and then immediately direct credits the payment. The supplier's role is just to confirm the details against their own shipping records.
So AP moves from being a cost processing center to a verification center.
The efficiency gains are just stunning. You have a massive reduction in data entry costs. You eliminate duplicate and lost invoices entirely because you control the source document.
And you minimize clerical error because you're relying on your own validated system data.
And finally, it eliminates almost all the queries from invoice and delivery mismatches. When the buyer controls the receipting data and the invoicing process, that friction just disappears. This is truly the 21st century finance function.
This has been a really deep dive into practical, proven strategies for AP transformation. And achieving that 60% volume reduction, it really does require a coordinated and aggressive approach across tech, payments, and behavior.
To summarize, the organization has to adopt, really, 3 strategic pillars. First, leverage the purchase card, that free AP system, to just crush the high-volume, low-value transactions. That's where you get 70 to 80% of the volume burden.
Second, that symbolic and practical elimination of paper payment. You frame that last check in the CEO's office, and you use aggressive tactics to get all remaining suppliers onto electronic funds transfer.
And third, implementing those strict but fair budget holder compliance measures. You use the shame and name lists backed by the SMT, you link compliance to performance bonuses, and you offer that foundational 20-minute training session to all new employees.
So what does this all mean strategically for the finance department? What's the end game?
It means that by removing this heavy Dickensian processing burden, the accounts payable team can finally fulfill the promise of 21st century finance. Their workload shifts away from routine clerical tasks into more value-added areas.
Like what?
Analyzing spend patterns, identifying opportunities to improve supplier payment terms, negotiating better contracts, optimizing cash flow forecasting for the CFO. This is where finance truly becomes a strategic partner to the business.
The source material is full of these practical resources, purchase card instructions, checklists, even a draft welcome letter. The tools for immediate change are out there.
They are. And if implementing all this requires that focused, intense period of 12 weeks to fundamentally change human behavior, it raises an important question for you, the listener. What one small Charles Dickens process, whether it's requiring a manual stamp, a physical receipt, or that last little checkbook, what one thing could you commit to eliminating today to start the clock on your own 12-week AP transformation?
That is the crucial first step toward that 60% reduction goal. Thanks for joining us for The Deep Dive. Welcome back to The Deep Dive, the place where we take the fire hose of corporate data, stack up the sources, and distill the knowledge down to the essential, the actionable, and, well, the truly surprising.
And today we're diving into a topic that is, I think it's fair to say, a universal pain point.
I think so. If you work anywhere near a finance function, you know there's this one process. It comes around 12 times a year, and it's almost always synonymous with anxiety, late nights, and just a ton of stress.
We are, of course, talking about the monthly financial close.
Exactly. The month end.
It's this constant corporate headache that, very few companies seem to permanently cure. It just creates systemic delay.
And errors, right. People are tired, they're exhausted.
Absolutely. It introduces these totally avoidable errors, and most critically, it burns out your best people right before they should be moving on to the high-value stuff, the strategic analysis. It's just a massive resource drain disguised as governance.
Okay, let's unpack this. You, the listener, have provided us with some source material detailing a truly radical approach to re-engineering this whole thing. And this deep dive, it isn't about throwing millions at a new general ledger at GL.
No, not at all. It's about shifting the culture, shifting the procedure to move the entire company away from those slow, error-prone cycles.
And toward what the sources call the Holy Grail, day one reporting.
Exactly. We are talking about going from a month-end process that is defined by intense, unpredictable drama to one that's just a complete, anticipated non-event.
I love that phrase, a non-event.
It's the goal. For a CFO, slow reporting isn't just an admin inconvenience anymore. It's actually becoming career limiting.
Because you're making decisions on old data.
Precisely. The companies is making crucial strategic decisions based on data that's already stale. So our sources really emphasize that the ultimate goal here isn't just speed for speed's sake. It's about achieving 12 non-events a year.
And what does that do for the team?
Well, it drastically improves staff morale, it reduces your audit risk, and crucially, it frees up the finance team to actually spend 80% of their time on the high-level analysis that drives the business forward, not just reconciling the past.
That's the key distinction, isn't it? We're not just summarizing the numbers faster. We're giving the business strategic insights sooner. So how are we going to attack this? How are we structuring this deep dive?
Okay, so we've broken it down into 3 major transformational pillars, all based on the source material. First, we got to address the low-hanging fruit.
The easy wins.
The easy wins, the small process-driven refinements, and the cultural shifts you need to just eliminate wasted staff time and administrative friction before the books even get close to closing.
Yeah.
Second, we're going to dive into a huge structural change, one that really challenges historical precedent. We actually need to talk about Julius Caesar.
Oh, interesting.
Yeah, we'll look at why the 4-4-5 reporting model is just structurally superior for business. And then finally, we'll get to the ultimate goal, day one reporting, and we'll back it up with these really powerful case studies that show this is, 100% achievable, even with older systems.
If you have the right processes in place.
If you have the right processes in place, that's the key.
All right, let's start with that essential foundation then. Section 1, eliminating that administrative drag. Where specifically do companies just hemorrhage staff time and cause these unnecessary delays before the close machinery even officially starts rolling?
The sources are, they're unequivocal. The time and resource drain starts right at the base level. It's these unnecessary administrative tasks that, they're intended to improve accountability, but they end up just being badly managed and bloated.
And the single biggest one is?
Surprisingly, it's timesheets.
Timesheet treachery. I love the alliteration. And the source material is it's notably controversial about timesheets. The argument is that they're really only required for revenue generation, and even then, it's debatable.
It's a huge cultural and financial statement to make. The source gives this really compelling anecdote about an accounting firm in the UK.
Right.
They completely got rid of non-revenue timesheets for their support staff, their back office people, and they did it because they realized the sheer magnitude of staff time being consumed was just... It was totally disproportionate to the internal value they were getting.
And the result was immediate, right? The
Yeah.
staff turnover dropped dramatically.
Dramatically. But the critical business insight is the pure financial cost. That firm estimated that up to 6% of all staff time, and that's across the entire firm, not just finance, was wasted filling out timesheets in those tiny little 6-minute units.
The 6%, that's a staggering number.
It is an enormous administrative drag on the bottom line. Think about that at scale. For a company with, say, 10,000 people, 6% is like having 600 full-time employees whose main job is just administrative compliance and internal reporting.
Time that could be spent on Well, on actually generating value.
Exactly. And this is why the sources propose this fundamental change to the internal accounting timeline.
But hold on, if you just unilaterally decide to accept less precise timesheets, don't you risk eroding financial discipline? I mean, if you tell staff that a best guess is better than a perfect delay, aren't you risking a behavioral shift that harms your underlying accuracy?
That's a valid concern, and it's one that comes up. But the sources argue that speed and materiality, they outweigh hyper-accuracy in administration. So the refined rule for non-revenue timesheets is strict.
Okay.
They must be completed by day nice 3. That's 3 working days before the month end. And staff are actively encouraged to just put in their best guess for the last 2 days.
And the logic behind that?
It's just pragmatic. The critical rationale is that even if those estimates for the last 2 days were 100% wrong.
Which they won't be.
Right, they won't be. But even if they were, the resulting financial misstatement would almost certainly not be material to the overall P&L or the balance sheet. So you're prioritizing the timely completion of the close machinery over this non-material administrative precision.
So it's a calculated trade-off. You're sacrificing non-material detail for material speed. What about the ones that do matter? The revenue-generating timesheets that directly impact billing and cash flow.
They get a slightly different deadline, but it's still a hard one. They must be done by noon on the last working day.
And what about the rest of the day? The afternoon.
Staff have to provide a best guess for their afternoon's work, with any small corrections just processed on the next week's timesheet. And the source material raises this pretty pointed question for management. If your staff can't project what they're doing for the next 4 hours, it potentially raises some uncomfortable questions about their planning skills and maybe their overall efficiency.
It's a fair point. The goal is to enforce the behavior that gets all the relevant revenue data into the system before you start the critical calculations.
That's it. So that's the internal time sink. The next area of friction involves, internal operational managers, minimizing the time budget holders spend reporting to finance.
Well, this is a classic example of inertia and tradition just killing efficiency.
Totally. The source describes this common scenario. A finance manager sitting with a literal pile of detailed budget holder reports on their desk. And when they were asked about, the utility of these reports, the manager admitted they barely use them.
Let me guess. They said something like, I only call them if there's a huge variance.
Exactly what they said. I only call the budget holder if I need an explanation of a major variance.
That's just an enormous waste of executive time. I mean, you're talking hundreds of hours of high-value budget holder time people who should be managing supply chains, driving sales, focusing on R&D.
Right, and instead they're creating documents that serve no analytical purpose and are never even looked at.
That time could be spent contributing directly to the bottom line.
Or just letting key operational leaders have a better work-life balance. So the refined rule here is another hard limit enforced by finance. Reports should take a maximum of half an hour to prepare.
They have to be short.
Strictly limited to a single page. Maybe 2 if you have absolutely essential performance indicators. And their only purpose is to flag major agreed-upon variances, not to provide this deep, unused narrative context.
Okay, so we've addressed data entry and operational reporting. The third major friction point is purely cultural, and it sounds like this one goes right to the top of the organization. We're talking about avoiding the report rewriting treadmill.
This is where the cultural commitment really starts. Our sources are very clear that for rapid reporting to work, the entire organizational structure, the board, the CEO, the senior management team, the SMT, they all have to commit to avoiding rewrites at all costs.
And that move alone, just cutting out those review cycles, saves thousands of dollars monthly in highly paid management time.
Thousands.
But that sounds fantastic in a policy document. But how do you practically convince a board who are, by nature, detail-oriented and protective of their governance role? How do you convince them to agree that the quality or the style of a board paper is not a direct reflection of the CEO's performance? I mean, that feels like a massive political hurdle.
It is, and it requires a very conscious organizational commitment to delegation and empowerment, often led by the CFO. The commitment is to table SMT and board papers that are written with limited senior input.
And they're accepted with few amendments.
As long as the SMT generally concurs with the recommendations, yes. It's a deliberate process of forcing ownership down the chain. And the source material gives a very concrete mechanism for the CFO to delegate responsibility but still maintain accountability.
And that's key to overcoming the political pushback.
Right. So the CFO can add a little caveat to the finance report, something like, while I concur with the recommendations, the report was written by him. And then you name the person.
Naming the writer. That is a potent tool for empowerment. It sends a really clear message. We trust the analysis, and we empower the analyst who did the work.
It completely transforms the finance team. Board members are then encouraged to give their feedback directly to that junior writer about the strengths, the areas for improvement, instead of sending it back up through 5 layers of management for a complete stylistic overhaul.
Which just introduces delays and unnecessary complexity.
And, where appropriate, the sources recommend that the actual writers are the ones who present the data, which further increases their ownership and their motivation.
And the immediate benefits of making this, I mean, it's a profound cultural shift.
They're huge. First, you create motivated and significantly more competent staff because they have real ownership of high-stakes documents. Second, your general managers and executives, they're freed from editing and rewriting so they can focus on the core business. And third, the whole organization just has a much more relaxed, productive week leading up to board meetings. You've successfully delegated the stress.
So this cultural bedrock trusting estimates, avoiding unnecessary reporting, empowering staff, it's clearly the foundation. How do these seemingly small shifts translate into the massive efficiency gains you need for day one reporting?
But you see, they're not small. They are the essential prerequisites for speed. If senior management trusts that a junior analyst can table a critical report, and if they trust that estimates for the last 2 days of the month are adequate, they're setting the precedent.
The precedent that perfection can and must be sacrificed for speed.
Perfection and unnecessary administrative effort, yes. You just cannot go fast if your underlying culture mandates administrative drag, zero error tolerance, and endless review cycles. This trust is what enables the rapid, high-value variance analysis we're going to talk about later.
Let's move from process to structure, because here's where it gets really interesting, I think. We have to talk about the calendar. The source material is very direct, stating that the calendar Julius Caesar gave us, the Gregorian calendar, is fundamentally a bad business tool that creates 12 dramas a year.
And that drama is entirely self-inflicted and, easily avoided. The core problem is that standard calendar months, they have fluctuating durations, they end on different days of the week, and it just impacts the work week unpredictably.
So February might have 20 working days. March has 23.
Right, and July might end on a Tuesday, which forces this big midweek scramble to close the books.
And that's what forces finance teams to issue those detailed, shifting close instructions every single month. The instruction sheet is always changing. The task you did on Wednesday last month, please do it on Thursday this month, and so on. It's just a constant, resource-intensive re-education cycle.
And it introduces unnecessary risk of error. It's just operational churn and complexity. And the sources note this really critical observation. 3 to 5 months per year naturally close on a weekend.
And those are the easy ones.
Finance teams always observe that those month ends are naturally smoother, less stressful, and faster. And that insight leads you directly to the structural solution. You force the close onto a set day that maximizes predictability and minimizes that workweek disruption.
Enter the 4-4-5 reporting solution. Now, this is a major structural shift. How does this reporting cycle actually work, and why does it fundamentally solve that calendar problem?
So, the 4-4-5 model dictates that you close your financial periods on the nearest Friday, Saturday, or Sunday to the calendar month end. This creates financial periods that are precisely 4 weeks or 5 weeks long.
So a typical quarter would be, what, 2 4-week months and a 5-week month?
Exactly. A 4-week month, a 4-week month, and a 5-week month, which totals 13 standardized weeks.
So the biggest benefit isn't just that it happens on a weekend, which is, operationally convenient. It's that the comparisons between periods become dramatically more meaningful because the work weeks are standardized.
That is the core value proposition. You are comparing 4 full weeks of sales activity and payroll runs to another 4 full weeks of activity. It's apples to apples.
Whereas under a standard calendar, you might be comparing a 28-day month to a 31-day month that has 5 Mondays and 5 Fridays, which totally skews your revenue and cost comparisons.
Just based on the calendar composition, yeah. The
Yeah.
4-4-5 structure gives you that clean comparison that's so essential for management analysis. And by rolling the GL systems over at the weekend, there's minimal impact on the operational work week itself.
Right. The operational systems close on a Friday afternoon. The batch processes run automatically over Saturday. And on day one, Monday morning, you start clean with the close already done.
You move from a shifting, unpredictable calendar-driven, close to a systematic, predictable operational close. It's fundamentally about moving toward those 12 non-events a year because the procedural steps are identical every 4 or 5 weeks.
Now, the source material stresses a very specific point about choosing the closing day. It says it's critical to choose the nearest Friday, Saturday, or Sunday, not the last one. Why is that distinction so operationally important, especially when it comes to the annual audit?
Because accuracy and materiality, they still frame this whole discussion. If you choose the last Saturday of the month, your financial close could potentially happen 6 days before the actual calendar month end.
That's a huge gap.
It's a significant gap that would require really aggressive adjustments. But if you choose the nearest Friday or Saturday, you are, at most, only 2 working days out from the actual 30th or 31st. And that minimizes the estimation and adjustment you need at year-end, which keeps the variance immaterial.
Okay, so implementing this, it still sounds disruptive. It involves systems, auditors, the board. How do you manage that implementation without causing mass confusion among all those stakeholders?
The sources offer some really concrete practical steps. First, the crucial IT system check. You have to contact your general ledger supplier and just ask them which of your other clients close on a set day monthly.
I love them.
They will invariably link you up with existing users, which lets you see the operational benefits firsthand. And the key question the sources recommend you ask those users is, would you ever go back to regular calendar reporting?
And the answer is going to be?
The expectation is they'll give you a look that just says, are you crazy? Why would we ever introduce that predictable chaos back into our lives? And that builds this overwhelming proof of concept internally.
So that immediately addresses the fear of being some kind of technological outlier. What about the external auditors? That's usually where the regulatory red tape snags the whole process.
You absolutely need to talk through the audit ramifications, but the source assures us that any professional auditor will have handled the structural shift many, many times before. At your year-end close, your financial reporting will naturally be a few days off the calendar year-end.
Right, you might close on December 29th instead of the 31st.
Exactly. The crucial point is that the missing or extra 2 days of income and balance sheet movement are just taken up in the auditor's overs and unders schedule.
Could you just elaborate on that schedule for a second? For our listener who might be deep in finance but not a career auditor, what is that practical mechanism?
Sure. The overs and unders schedule is essentially the auditor's working document. It's where they track small, immaterial differences in accruals, prepayments, closing dates, things that are accepted as non-material for the final published statutory report.
So because the 2-day variance is highly unlikely to be material in the context of a whole year's results, it just gets slotted in there.
Right. You close on December 29th for operational efficiency, but you call the year to December 31st. That small misstatement, as the sources assure us, will be lost in the roundings of the overall financial picture.
Okay, that makes the audit logistics clear. Now, the final stakeholder, and maybe the most nervous of them all, the board. The recommendation in the source material is remarkably bold. It says, do not inform the board of this shift to 4-4-5. Isn't that a huge governance risk? Why the silence?
That is the ultimate test of confidence, and you raise a critical governance point. But the rationale is that the change is purely procedural, and it's immaterial from a statutory reporting standpoint, as long as you follow the auditor's guidance.
And the board's primary concern should just be getting timely, actionable, comparable data.
That's the argument. By simply presenting June's standardized results and balance sheet without highlighting the subtle date shift, you allow the improved predictability and speed to speak for itself. You're managing the change by delivering results first.
So the silence is a pragmatic choice to avoid introducing unnecessary procedural anxiety at the executive level. You let the enhanced analysis and comparability, the actual value drivers, prove the success of the model.
Exactly. The enhanced value of having 12 consistent, comparable reporting periods massively outweighs the fact that December's books closed on the 29th instead of the 31st. So we've established the process foundation of trust, and we've eliminated the tyranny of the calendar. Now we have to address this common, often panicked reflex that a lot of CFOs have when they're facing slow reporting.
The immediate desire to just throw millions of dollars at a new accounting system.
The dreaded general ledger upgrade. It's often sold as the panacea for all reporting ills.
But our sources say to delay that change, which is completely counterintuitive for a lot of finance leaders. Why is holding on to an older GL often the superior initial strategy?
Because fundamentally, companies should be able to get to day 3 reporting a significantly accelerated close, regardless of how old or antiquated their system is. An old GL is just not an excuse for slow reporting. The problem, 90% of the time, is deeply rooted in flawed process and flawed culture.
And there's a pretty biting critique of the new large GL systems themselves in here. The source notes that these massive systems are often designed by architects who always wanted to be NASA scientists and have never actually run a fast-paced, high-volume finance team.
And that speaks to complexity over utility, doesn't it? These large ERP and GL systems, they often introduce unnecessary layers of technical complexity and features that just go unused. But the bigger issue is that these business upgrades, they often just replicate the existing flawed processes instead of forcing the organization to redesign them first.
So you spend millions to get a high-cost digital replication of your administrative drag.
Instead of actually eliminating the source of the inefficiency. Yes.
So if we delay the GL upgrade, which can easily be an 8-figure cost and take years, where should the strategic purchase focus be technologically to help speed up the close?
The focus should be on integration that removes manual errors and administrative load before the GL even sees the data. The source specifically prioritizes integrated purchase order systems.
Okay.
These are systems that enable an order to be priced using the supplier's online price list automatically. It checks against your existing inventory, and then it's emailed automatically to the preferred supplier.
As long as it's within the budget holder's delegated authority.
Right. You're fixing the transactional input. Automated PO systems, they eliminate that manual matching of invoices to goods received notes and purchase orders, which is a huge ongoing source of error and delay. You clean the data at the source, which is infinitely cheaper than trying to clean it up inside the general ledger during the close.
All right, now let's talk about the single greatest danger in the modern corporate finance department, as the sources see it, the Excel calamity. The material is absolutely uncompromising on this. Excel has no place as a reporting or consolidation tool for the month-end close.
That's right. Excel is just too dynamic, too accessible, and fundamentally too prone to disaster, especially when high-stakes consolidation is involved. It's the reliance on these complex, fragile spreadsheets that is the calamity waiting to happen.
Elaborate on that disaster. Is it just about simple user error, like someone accidentally typing a number over a formula?
It's deeper and more systemic than that. The acute problem is when you have these complex, bespoke, in-house reporting systems, often built by a single person who's since left the company, that rely on reading imported GL downloads into a spreadsheet full of complex, undocumented Excel formulas.
Ah, the single point of failure.
Exactly. The CFO is waking up in a cold sweat hoping that Kevin in accounting hasn't accidentally pasted over a critical VLOO up formula. The accuracy of the consolidated reports relies entirely on the integrity of those fragile spreadsheets.
And the moment that one person leaves, the logic is gone, and the close just grinds to a halt while the team tries to reverse engineer a complex pivot table structure.
It creates unnecessary anxiety and delay. That reliance is explicitly described as a calamity waiting to happen because it's completely non-auditable and non-sustainable at scale. For organizations chasing day one reporting, fragility is the enemy.
So is there any acceptable use of Excel in this hyperspeed reporting environment?
There is only one acceptable use case, and that's if a system automatically downloads the data to Excel, but with all of the programming logic, all the consolidation rules, all the calculations residing bomb-proof in the primary general ledger or reporting system.
So Excel can be the display, but not the engine.
Precisely. If the GL is doing the heavy lifting, the consolidation, the calculation, the logic, and Excel is just acting as a display tool for graphing or simple summaries, that's fine. But Excel cannot be the engine. That's a non-negotiable rule for achieving high speed and high accuracy.
Okay, we've built the foundation of trust, we've escaped the calendar tyranny, and we've minimized our reliance on shaky tech. Now let's talk about the ultimate prize. Day one reporting, or DR. This is a concept that has existed and been proven since the early 1990s, so it's setting a firm precedent that slow reporting is really no longer acceptable.
DR is the pinnacle of month-end efficiency. It is the benchmark for finance teams globally. And it's defined as condensing the monthly reporting process so that all critical tasks are completed and final reports are issued by 5 p.m. on day one.
Day one being the first working day immediately following the previous month end.
Right.
5 p.m. on day one. I mean, that means by the time operational staff clock out on the first day of the new month, the CEO and the senior team have the comprehensive financial results and commentary for the entire previous month.
And that's not a preliminary flash report. It's the full actionable accrual result. The list of tasks shows the commitment needed, all transactions processed, all accruals raised, consolidations done, reports prepared, commentary added, and reports issued.
The sources are pretty blunt here. They say that reporting 5, 6, or 7 days after month end will soon be a perilous activity and potentially career-limiting for CFOs.
The precedent has been set. The competitive advantage of rapid reporting is just too high to ignore.
So let's look at the pioneers who proved this was possible. We start with the Johnson & Johnson Vision Products USA case study from back in the 1980s.
Right, J&J, specifically the unit that was manufacturing AccuView contact lenses. They were initially taking 2 weeks to close their books, and their breakthrough insight came when they benchmarked against their competitors, and they realized they were paying more to have monthly reports ready later.
Which is just a massive counterintuitive insight.
It means the companies that closed quicker actually required fewer overall accounting resources because they were so much more efficient. Speed doesn't increase cost, it reduces it.
So how did they manage that initial massive leap? They went from 8 days down to 3 days in the first 6 months.
They executed those foundational cultural steps we just talked about. They made all management deeply aware of the cost of delay. They got firm buy-in from the top. They set up an empowered, multifunctional project team.
So not just finance.
No, it had reporting, marketing, operations, IT, production planning. And they just focused relentlessly on continuous improvement and adhered rigorously to preset deadlines. And that got them to day 3.
But the sources say that at day 3, they hit the wall. The incremental gains just stopped. And to break through that barrier and get to day 1, it required a complete paradigm shift, a true re-engineering of their whole process.
They had to attack complexity and materiality with extreme prejudice. First, they rigorously applied the Pareto principle, the 80-20 rule, deciding to only focus their internal review on the big numbers, the most material accounts.
And second,
and this is the most critical and difficult step, they reduced manual journal entry line items by a staggering 80%.
80%. That requires fundamental automation and just eliminating complex reversals or non-standard entries.
Yeah.
How did they actually achieve that? Was it a system thing or a cultural decision?
It was a decision on process, driven by trust. They standardized as many accruals as they could, moving away from subjective, detailed entries to more formulaic, automated accruals based on predictable volumes or percentages. They also got rid of a lot of standard interperiod reversals that just created churn.
So they decided the time spent tracking and reversing tiny entries was greater than the value of perfect timing.
Exactly. They just determined that allowing the small entries to smooth out over the next few days naturally was acceptable.
What else did they eliminate that most companies still struggle with?
They got rid of all interdepartmental corrections at month end. So instead of finance mediating disputes, they transferred that responsibility. Budget holders now had to resolve their own departmental issues before the close began.
And the management review process.
Eliminated. They condensed management reports to a one-page summary of key indicators plus 1 page on business unit performance. And critically, they moved away from trying to track every activity throughout the month and instead demanded that budget holders track their own key activity so there were no surprises during the close.
The truly radical part, though, and the key to the speed, it must be their approach to estimating and analysis.
Absolutely. They made a fundamental commitment to use estimates to avoid slowing down the close. And they quickly found that the difference between the estimate and the actual was never significant enough to warrant the delay. It was just immaterial.
And they also replaced account reconciliation.
Yes, instead of detailed, time-consuming account reconciliation, where analysts check every single account balance against underlying documentation, they replace that process in days 1 and 2 with variance analysis.
That distinction reconciliation versus variance analysis is really fundamental for our professional audience. How does that shift practically save time on day 1?
Well, reconciliation is a detailed check for historical perfection. It is backward-looking. Variance analysis is forward-looking and focuses only on the exceptions.
So they set materiality thresholds.
Right. They set rigorous thresholds, say $50,000 or a 5% deviation from budget. And analysts stop checking every account for errors, and they start by looking only at the 20% of accounts where the variance exceeds that preset threshold.
And if an account variance is below the threshold,
it's automatically deemed accurate enough for day 1 reporting. This saves 80% of the analysis time and focuses management attention purely on actionable insights.
And for the very last day of the month's activity, which is often the biggest bottleneck.
They just captured the financial movement in bulk. They manually entered the last day's debtors and cash receipts as a single total figure. The granular details were cleaned up later in the week.
So the goal was to capture the magnitude of the movement to get a reliable net result for the CEO.
Understanding that the small detailed corrections would be processed automatically over the coming days without delaying the release of the overall figures.
And looking at their timeline starting at 8 days, then 3 days and 6 months, 2 days and 12 months, and finally 1 day and 24 months, it shows this is a dedicated, multi-year transformation.
And it was guided by 3 really powerful principles. First, eliminate what you can. Get rid of all non-value-add tasks like unnecessary journals and reports. Second, simplify what is left. Reduce journals, condense reports, standardize accruals. And third, consolidate similar activities or information. That 3-step philosophy became their permanent blueprint.
That's a perfect blueprint for process reengineering. Let's look at another major case study, Motorola in the 1990s. They achieved a 2-day close quickly, despite their massive scale and complexity.
Motorola was a beast. 6 operating sectors, multiple divisions, over 30 nations, managing more than 40 balance sheets globally. And they moved from an 8-day close to a 2-day close by focusing on several key strategies, like aggressively adopting world-class better practices and looking for hundreds of small, incremental 1% improvements.
One of their major internal drivers was cultural competition, which the source material highlights as a really effective motivator.
That's right. They institutionalized the measurement of processing errors and just let the sectors compete fiercely to be the most efficient. And this is where their adoption of Six Sigma quality methodology intersected directly with their finance operations.
They counted errors.
They did, and the results are just astounding. They targeted and achieved this massive reduction in processing errors, moving from 10,000 errors per 700,000 transactions down to only 1,000 errors per 2 million transactions.
That is 5 Sigma quality. And they were targeting 3 errors per million, which is the gold standard of Six Sigma. So the lesson here is pretty clear. Speed and accuracy are not trade-offs.
They are intrinsically linked. Going faster under the pressure of day one deadlines, it forced them to eliminate those time-costly errors through superior process design.
And the financial ROI was staggering.
Worldwide finance costs fell from 2.4% of annual revenue down to about 1%. That translated to reported savings of greater than $10 million per year, just in finance operations efficiency. It really puts the cost of slow, error-prone reporting into sharp perspective.
But the most surprising benefit, and the one that speaks directly to staff morale, is what happened to the finance team managers themselves.
Yes. They found that in the day one reporting regime, the finance team managers actually had more time for high-value strategic analysis than they had previously had during the slow 8-day error-prone close.
Because they weren't just putting out fires all month.
Exactly. By eliminating the errors and the administrative drag up front, they were released from the monthly reconciliation grind, and they gained valuable analytical time back. The month ends became drama-free, which resulted in less anxiety and significantly higher morale in the accounting team. So, day one reporting is the achievable benchmark, but the industry, it never stands still. Our sources note that DOR is already being superseded by the next frontier, the virtual close.
Virtual closing. That sounds like the ultimate endpoint of efficiency. A system that never actually closes, where the data is always fluid and reconciled. What's the working definition of this?
The virtual close is the capability to give the CFO a full accrual net result at any time during the month, not just on day one. This requires systems that are capable of continuous real-time reporting, where the act of closing is no longer this scheduled resource-intensive event.
It's just a continuous state built into the data architecture. So if the CEO asks for last night's profitability figures at 10 a.m., the system can calculate a reliable, accrual-based result without triggering some big manual process.
Precisely. It transforms the function of the finance team from a backward-looking scorekeeper to a predictive, continuous strategic partner. The emphasis shifts entirely to forward-looking scenario planning and real-time intervention.
And who is already achieving this level of continuous financial awareness?
Well, this capability is being successfully utilized by a lot of high-profile adopters, largely in the tech and financial sectors. You're looking at Cisco, Motorola building on their DOR-based Oracle, Dell, Wells Fargo, Citigroup, JP Morgan Chase, and Alcoa.
So these large organizations have engineered systems where the data is essentially live, standardized, and accrual-based 24/7.
That's the goal.
So what does this all mean for you, the learner, tasked with accelerating your own finance function? The fundamental lessons from the sources, they're consistent. Speed and accuracy are not competing goals. You actually achieve better financial control and higher quality by committing to go faster.
Speed forces necessary discipline. It forces you to question why you're performing an action, and if that action, like that 80% reduction in manual journals or eliminating unnecessary management review, if it's not materially adding value, you just eliminate it. And the cultural changes we discussed, they're the prerequisites for this kind of operational speed. Without trust, you cannot get rid of that 80% of journal entries.
Okay, let's wrap this up with the clear, actionable key steps for transforming the monthly close. For you, the listener, the mission starts with 4 clear actions drawn straight from the successes of these case studies.
First, you have to audit your administrative drag. Identify those non-revenue timesheets and strictly enforce DANIC 3 deadlines. Use the materiality argument to justify the estimates, calculate the cost of unnecessary budget holder reports, and enforce that non-negotiable half-hour, one-page rule.
Second, you must escape the tyranny of the calendar. Adopt the 4-4-5 reporting model to standardize your reporting weeks. This guarantees comparability, and it minimizes the workweek impact by closing on the nearest Friday, Saturday, or Sunday. Remember, the consistency is the key benefit.
Third, trust process over systems. Hold off on that expensive general ledger upgrade. It often just replicates your existing bad habits. Instead, focus your investment on improving front-end integrated systems like automated purchase order processing, and ruthlessly eliminate the extreme vulnerability of using Excel as a consolidation or logic engine.
And finally, eliminate, simplify, and consolidate, just like Johnson & Johnson. Focus rigorously on the Pareto principle, the big numbers. Replace time-consuming historical account reconciliation with proactive variance analysis based on set materiality thresholds, and empower your staff and your budget holders to resolve issues quickly using estimates when it's appropriate.
And a crucial observation that, it links all of these steps is that cultural requirement. The trust and delegation you need for staff writers to table reports without senior management rewrites. It's the exact same level of trust you need to let budget holders resolve their own variance issues and for analysts to move from tedious reconciliation to rapid, high-value variance analysis. Trust is the engine that generates speed.
It frees up all that analytical time, a powerful framework to take forward trust, delegation, and ruthlessly attacking complexity. Now, here is our provocative final thought for you to chew on.
The source material suggests a goal beyond day one, the virtual close achieving a full accrual net result at any moment during the month.
So if your organization achieved that instantaneous financial snapshot, what single analysis would you run that you cannot run today? And how would that immediate, continuous insight change your next strategic decision?
Think about that immediate data and how it could shift your organization from reactive cost control to proactive, real-time strategic leadership. That is the true competitive value hidden inside the rapid reporting revolution.
That's all for this deep dive. We'll see you next time. If you've ever worked anywhere near corporate finance, you probably know the feeling. It's not the budget meeting itself you dread. It's the arrival of the monthly management report.
Oh, yeah.
That, massive digital file, or sometimes still a 50-page binder that lands on your desk. And it's days, sometimes weeks, after the month has even closed.
And it's just saturated with detail. Columns upon columns of account codes that are, let's be honest, they're completely useless for timely action.
Exactly. Useless.
And that's the thing. Many of these reports that finance functions generate, they're not actually management tools at all. Our sources are very, very clear about this. They're memorandums of information.
Memorandums of information.
Yeah.
I like that. It sounds sort of official but useless.
It's the perfect term. They're relics of an administrative past. They show up late. They often have errors because the whole process was so rushed, and they're bloated with detail for no other reason than, well, that's how we did it last month.
Right? We did it last month, so we have to do it again this month.
Precisely. That binder isn't informing your strategy. It's just a history book that, might be useful as a doorstop.
The doorstop of history. Okay, that's a perfect description. So let's unpack this. Our mission for this deep dive is to give you a definitive escape plan from that information overload.
Yeah, let's do it.
We're going deep into what our sources call the foundation stones of lean reporting. This is a complete transformation, really.
Yeah.
Moving from that late, error-prone dissertation to an informative, error-free, one-page format that actually enables decisions, not just documentation.
And the ultimate goal here is speed and actionable knowledge. That's what it all comes down to. We're going to explore how modern tools, when you couple them with visualization best practices, and we're going to lean heavily on the incredibly influential work of data viz expert Stephen Few, can ensure managers get a true and fair view of the business.
And fast enough to actually matter.
Fast enough to matter. This deep dive is going to cover the whole overhaul. From the basic principles, conciseness and speed, all the way to specialized frameworks like value stream accounting and dynamic rolling cash flow forecasts.
So by the time we're done, you'll know exactly what to demand from your own finance function.
That's the plan.
So let's begin where all great improvements start.
Yeah.
Right? At the root cause. If we strip away the symptoms, the lateness, the errors, what is the fundamental problem that traditional reporting is imposing on the whole organization?
It's the sheer complexity of it all, and the cost associated with that complexity becomes this vicious self-defeating cycle. First, you just have the timing failure.
Right.
The reports arrive well after the period for effective action has passed. You're trying to fix a leak with information you got 3 weeks after the pipe burst.
Right, the damage is already done.
Exactly. But the second big issue, and this is the one that's often ignored, is the cost burden.
The cost of just preparing the thing.
Exactly. The intense preparation, the analysis, the checking that's required for these, excessively detailed reports. It's a massive operational burden on the accounting function itself.
And that burden is what creates the delays.
That's the vicious cycle. The burden creates the time delays, which then, ironically, just destroys the report's ultimate value. You end up spending, 80% of your time creating a report that is maybe 20% useful.
And I've seen that exact cycle in action. You rush the QA process to hit some arbitrary deadline, and that introduces errors. Then the errors erode trust in the data, which means you need late adjustments and constant rechecking.
And it just perpetuates this belief that the numbers are untrustworthy. You nail the core issue of reliability.
It's a spiral.
It is, and compounding all of this is the problem of just excessive detail. Our source material makes a really critical point about data simplicity. If you're reporting to senior management, do you really, really need to show 8 digits of precision? $23,456,327. Or is $23.5 million just easier to read, to remember, and to relate to? The excessive precision adds complexity and prep time, but it doesn't add any managerial relevance. It's accuracy for the sake of accuracy, not for decision-making.
I think that simplicity point is the critical mindset shift here. We're moving away from a regulatory accounting precision toward what managerial readability and speed.
Exactly.
So if we're tearing down that old structure, what are the new pillars? What are the 6 non-negotiable pillars of effective lean reporting that have to replace it?
Okay, so these 6 pillars, they demand a radical, almost cultural shift in focus within the finance department. It's a big deal.
Let's get into pillar 1 then. Speed and the true and fair view. What does that foundation demand in, practical terms?
Okay, so this one is absolutely non-negotiable. The reports have to be completed quickly, but, and this is the key part, they must still offer a true and fair view of the result.
Right. Speed without accuracy is worthless.
Completely worthless. So to get there, you have to start thinking about materiality at a group level. Not what's material to one tiny department, but what actually matters to the entire entity. And crucially, the numbers have to agree to the source system, and the report prep has to use robust reporting tools.
Okay, wait, you said robust reporting tools, and our source explicitly warns against using spreadsheets for core reporting. Why such a hard line against Excel? I mean, I know a lot of businesses that still run their entire reporting process through these huge linked spreadsheets.
I know they do. And Excel is fantastic for designing a template, maybe, or for a one-off analysis. But when it comes to enterprise-wide core reporting, it is the definition of fragility.
Fragility.
Yeah. Spreadsheets are just so prone to broken links, to manual data entry errors, accidental formula overwrites, and they rarely, if ever, offer the kind of audit trail you need for proper quality assurance.
So robustness means something else.
Robustness means using reporting systems that automatically pull clean data from your ERP or your general ledger, something that ensures traceability and consistency. Honestly, lateness is often just a symptom of a fragile manual reporting process built on Excel.
That makes a lot of sense.
Okay.
Okay, pillar 2 is the one that forces the most discipline. Conciseness, enforced by the one-page rule. I can just imagine traditional controllers fighting this one tooth and nail.
It's a deliberate provocation for sure. The one-page limit is what we call a forcing mechanism for prioritization. It doesn't matter if you use standard paper or that wider A3 fanfold paper. The constraint requires you to be ruthless.
Ruthless.
Absolutely. You can only include commentary and graphs that truly, truly matter to that month's performance. If it can't fit on that single page, it is, by definition, not material enough for the senior management report, period. It just eliminates the ability to hide in complexity.
It sounds like it's a psychological trick to demand focus.
It absolutely is. Simplicity is difficult. Complexity is easy. Anyone can make something complicated.
Okay, so Pillar 3 follows that logic. Data simplicity. Let's go back to that rounding discussion.
Right. Simplicity is all about managerial readability. We talked about rounding $23,456,327 to $23.5 million. Think about the cognitive load.
The what?
The cognitive load. When a manager sees a number with 8 digits, their brain spends half a second just trying to decode the scale. Is that millions? Tens of millions. But when they see 23.5 M, they process the magnitude instantly. Speed requires simplicity, and simplicity requires us to remove any unnecessary precision that doesn't actually affect the decision at hand.
Pillar 4 then addresses that trust deficit we talked about, comprehensive QA. You can't be lean if you're constantly second-guessing the numbers.
Correct. Trust is the currency of finance. You have to implement a comprehensive quality assurance process to make sure reports are totally consistent internally and agree to the source numbers every single time. This commitment to an explicit, visible, zero-error goal has to be communicated internally. We'll even get into the specific physical QA steps that make this whole process visible later on.
I'm looking forward to that. Pillar 5 brings in the visual element, which seems critical for getting clarity on that one page. Best practice visualization. And you mentioned Stephen Few.
Yeah, we have to move past aesthetic choice, what looks pretty, and embrace the science of perception. This means following proven visualization guidelines. And a key requirement here is that all trend analysis in these lean reports has to go back at least 15 months.
15 months. Why 15 specifically?
Because a 12-month or a year-to-date view often completely misses the seasonal fluctuations that are inherent in the business. If you're a retailer and your report only shows October to October, you miss the entire crucial holiday ramp-up cycle. The 15-month view makes sure that seasonality is always visible. It gives you context.
That's a great, simple operational rule. And finally, Pillar 6, modern tools. This sounds like it's about delivery, not just creation.
It is. If you achieve pillars 1 through 5, but then you deliver the report as a 50-megabyte PDF that has to be printed or can only be viewed on some special terminal, you failed.
Right.
We live in the 21st century. Information has to be instantly accessible. That means using reporting tools that generate output that's viewable easily on a manager's tablet or their smartphone. The medium has to serve the speed requirement.
Okay, so now that we've laid the foundation, speed, conciseness, we have to look at how we actually structure the content on that single page. Traditional reporting is built around detailed account codes, right? The raw ledger data.
Which is fundamentally obsolete for management.
Yeah. So let's talk about that shift away from the detailed ledger. Our source says that a report should only show a line item if it represents over 10% of total revenue or expenditure. Why that 10% rule?
That 10% materiality threshold, it forces aggregation. It keeps the summary concise, maybe 10 to 15 lines max. Reporting by detailed account code is obsolete because managers are no longer captive to the static printout.
What do you mean?
Well, they have drill-down tools available now. They can access the raw detail for any exception instantly on their own. The summarized report is for strategic oversight, not for bookkeeping. Anything less than 10% just gets aggregated into a miscellaneous or other category. If it's not big enough to matter, it's not big enough to be on the single page.
Okay, so now we get into what seems like a really radical structural departure. Value stream accounting, or VSA. This feels like it's more than just simplifying reports. It's fundamentally redefining how a business even understands its own costs and profitability.
This is where we get truly lean. VSA originated directly from the lean concepts developed within those high-efficiency Japanese multinational manufacturing companies. It represents a philosophical shift away from analyzing organizational silos, departments, business units, legacy product costing, and it focuses instead on the actual flow of value to the customer.
So how exactly is a value stream defined in this lean context?
A value stream is the end-to-end sequence of steps. and that includes both the necessary value-adding steps and the often ignored non-value-adding steps that are required to complete a product or a service.
Right.
And crucially, the costs assigned to that stream include all people and resources involved in that sequence. So you stop worrying about the efficiency of the IT department and you start worrying about the total cost and efficiency of the customer fulfillment stream. The focus is on the aggregated flow, for example, the total costs of the truck stream that are required to deliver that vehicle to market.
Wow, that is a fundamental paradigm shift. It aligns the costing structure directly with what the customer actually values, the outcome, rather than just your internal org chart.
Exactly.
Let's get into the technical details because VSA requires 6 very specific departures from classical management accounting.
Absolutely. The first key difference is the approach to direct cost assignment and the complete abandonment of complex allocation models. VSA requires that labor and machine costs get assigned directly to value streams using very simple, transparent cost drivers. The priority here is speed and clarity.
You mentioned complex allocation, and this leads directly to VSA abandoning activity-based costing ABC.
Oh.
I know controllers who have spent years implementing ABC models to try and achieve theoretical accuracy. Why does VSA just reject that?
Because ABC, while it might be theoretically precise, it often becomes overly complex. It requires enormous amounts of data collection and calculation that just slow the entire reporting cycle down to a crawl. It ends up being this sophisticated allocation engine that consumes vast resources and time. VSA prioritizes simplicity and actionability over theoretical precision. An analogy might be, ABC is like using a sextant and complex astronomical calculations to find your precise coordinates. It's detailed, but it's slow. VSA is like using a simple GPS map. It's fast, it's actionable, and it gets you where you need to go.
And within that cost assignment, you mentioned existing labor is typically treated as fixed. Why is that?
Because the vast majority of your workforce is stable, unless you are explicitly hiring extra staff for a specific stream, that labor is treated as a dedicated fixed resource for that stream. This just eliminates the constant time-consuming microanalysis of indirect labor allocation, and it keeps the focus where it belongs, on flow efficiency, not on labor utilization rates.
Okay, so difference number 2 focuses on sustaining costs. These are necessary overheads, but they are explicitly not allocated back to the value streams. Why separate them out?
So, sustaining costs include all the necessary elements that support the entire entity. Senior management, centralized IT infrastructure, corporate HR, general facility costs. Yeah, you get the idea. These costs cannot be directly and logically associated with one specific value stream.
So by not allocating them.
By not allocating them, we prevent the distortion of the value stream's true profit contribution.
Ah, so you're removing the noise. If value stream manager A performs better than manager B, you know it's based on their operational efficiency, not because corporate arbitrarily dumped a huge chunk of the legal department's cost onto their ledger that month.
Precisely. They're shown in a separate column, maybe called corporate burden or something similar. This transparency lets managers focus solely on maximizing their value flow and their profit contribution without the complexity of corporate overhead manipulation skewing their results.
Difference number 3. This one relates to the notorious complexity of inventory handling. In traditional systems, this can be a huge driver of internal accounting arguments.
It is, because traditional systems often allocate labor and overhead costs into inventory. VSA simplifies this radically. Inventory changes, meaning the costs of labor and overhead carried forward or released from prior periods, they're reported separately as a below-the-line adjustment for the entire entity.
So not for the individual value stream.
Not for the individual value stream.
And what's the profound benefit of doing it that way?
Well, it removes 2 major headaches. First, it instantly simplifies the value stream manager's P&L, letting them focus on the current period's performance. And second, and this is maybe more important, it removes the incentive and the ability to manipulate inventory values just to meet monthly profitability targets. If you're managing a lean business with just-in-time practices, this issue kind of disappears anyway, but VSA prepares you for that reality.
Okay, difference number 4 is a bit of a hybrid. Occupancy costs. These are assigned, but based on physical space.
Correct. We assign occupancy costs, so rent, utilities, things like that, to value streams based on the amount of physical space they actually use. This is a very conscious behavioral decision. It incentivizes the value stream teams to actively reduce their physical footprint and their occupancy costs. It promotes efficiency.
And unused space.
Any space that's non-operational or not used by any specific value stream gets appropriately charged to sustaining costs. It keeps accountability high.
Difference number 5. This one feels like a true declaration of independence from decades of classical accounting textbooks.
It really is. Value stream accounting abandons standard costs and price volume variances. These two metrics are the absolute backbone of classical management accounting. They're designed to analyze the difference between what should have happened and what did happen.
So why get rid of them?
Because in VSA and the broader lean philosophy, they're often seen as counterproductive. They can encourage batch processing and inventory buildup rather than continuous flow and improvement. They measure cost absorption, not value creation.
And finally, difference number 6. If it's not by labor time, how is the product actually costed?
Product costing is based entirely on the rate of flow or throughput through the value stream, not the traditional metric of individual labor or machine time expended. This just reinforces the core lean concept. Value is generated by continuous, fast throughput. If you move inventory faster, you generate value faster. You're measuring the velocity of value, not the time spent lingering in a cost center.
So moving from those really big structural changes of VSA, let's apply these principles of conciseness and speed to the presentation of the reports themselves. We need to create something that actually demands attention and action.
Exactly.
So let's look at the requirements for a standard business unit's performance report. This is where the time constraint becomes extreme. 1 page, and it has to be completed in 20 to 30 minutes. I can just hear traditional controllers having heart palpitations at that speed.
That time constraint is absolutely crucial. It implies that the report is just summarizing known facts. If the business unit manager had a major problem, the finance team should have been alerted, and action should have been underway during the month, not waiting for the close.
So it's a confirmation, not a discovery.
It's a rapid summary designed to quickly confirm or highlight major exceptions, not a detailed dissertation. It summarizes the entire profit and loss statement in just 10 to 15 lines.
And the supporting detail is limited to just 2 graphs. That forces some brutal prioritization.
It does. Those 2 graphs have to be the most pertinent visual information for that specific unit for that month. For instance, one might trend major expenditure items, and the other might be a combination graph contrasting financial numbers against non-financial drivers.
Like what?
Maybe tourist count versus personnel costs for a hotel chain, or unit production versus machine maintenance spend for a manufacturer. The graphs have to tell the most important story.
That brings us to the variance system. Management shouldn't be distracted by noise. How does the automated icon system highlight exceptions without causing that distraction?
This is critical for managerial focus. The system has to be automated and based on materiality. Variances are simply ignored, no notation, no commentary below a specific amount. The recommended threshold, for example, might be $20,000 monthly or $100,000 for year-to-date or year-end. If it's below that, it's just immaterial noise.
And what about the variances that are over that threshold but are still, acceptable?
For variances that exceed the dollar threshold but stay within a set tolerance, say plus or minus 10%, you use a specific icon. Our source suggests something like an asterisk inside carets. $. That instantly signals, yes, it's a big number, but it's within acceptable boundaries based on historical volatility, and it requires no commentary.
So commentary is only for the big problems.
Only significant variances that exceed both the dollar amount and the percentage tolerance require an explanation and a proposed action. This ensures that limited commentary space is focused only on required action steps.
So the commentary is focused on what we must do now, not just what happened. And we need to apply that same narrative urgency to the graph titles, right?
Absolutely. Ditch the passive descriptive titles like Q4 revenue performance. Use banner headlines that say something meaningful like a journalist's article title. Revenue drop is seasonal, not structural, or uncontrolled major costs are rising due to supply chain bottlenecks. The title has to provide the key insight immediately.
Now let's scale this up to the consolidated P&L report for the whole organization. This changes the focus of expenditures.
Right. While it still summarizes the P&L in 10 to 15 lines, it stops reporting consolidated cost categories like total premises expense or total personnel costs. Instead, it reports expenditures summarized by division or business unit. This structure aligns the reporting directly with managerial accountability.
So if Division X is overspending,
The CEO sees Division X's result immediately, not just a note that total personnel costs are high.
And here's a major departure in forecasting that the source mentions. We ignore the year-to-date budget. Why is that specific metric considered useless in this framework?
The YTD budget is often a relic. It's frequently just an arbitrary, linear apportionment of the annual plan that was created months ago and is quickly outdated by shifting operational realities. It becomes a flawed measure that forces unnecessary explanation.
So what do you compare to instead?
Instead, the focus is on YTD actual performance compared as a percentage of the most recent year-end forecast.
And what does that comparison achieve?
It highlights the realism of the current projections. If YTD actuals are significantly underperforming the run rate needed to hit the latest forecast, it forces a conversation about whether that forecast is too optimistic. If YTD actuals are far ahead, it highlights pessimism. It's all about driving conversations about realistic future performance.
That's a smart shift.
And a side note on discipline, our source recommends that forecasts should only be revised quarterly, not monthly, to prevent management and finance from just wasting time churning numbers constantly.
The ultimate test of this conciseness, I suppose, must be the CEO's one-page finance report. This is the top summary document.
Yes, the CEO's report often becomes the true main report, and it's provided on a single A3 or fanfold page. It has to deliver an immediate whole picture view. It needs 5 critical elements: areas to note, the exceptions, financial performance YTD, a succinct review of major business units, performing versus underperforming, key actions required, and a high-level summarized P&L and balance sheet.
That's a lot for one page.
It is, but the back of the fanfold page can even hold a simple ranking of business unit performance or a high-level dashboard.
Moving to the balance sheet report itself, the rules of simplicity, again, they apply strictly.
Absolutely. The balance sheet should contain no more than 10 categories, and it has to adhere strictly to that 10% materiality rule we talked about earlier. And the numbers must be rounded. Management needs to know that debtors owe $3.2 million, not $3,189,235. The simplified number is the one that's easily remembered and acted upon.
What graphs are essential for the balance sheet view? It's often seen as more static than the P&L.
The graphs have to focus on critical operational issues and risks. We need trend analysis on debtors aging. How long is it taking us to collect? Stock levels. Are we building up obsolete inventory? The aging of key operational assets for an airline. What's the average age of their 737 fleet versus the rising cost of maintenance? And, of course, cash levels. These drivers indicate immediate risk and future investment needs.
Okay, let's shift our attention completely to looking forward, the quarterly rolling accrual forecast. This report spans 18 months. Why 18?
You need continuous forward visibility that spans beyond the arbitrary annual budget cycle. 18 months forward provides the necessary horizon for long-term strategic decisions, particularly around CapEx and major hiring decisions.
But you don't need the same detail for month 18 as you do for month 1.
Exactly. We have to respect the diminishing need for granularity over time. We only show monthly data for the first 6 months, then we transition to quarterly data after that. It keeps the report manageable and actionable.
And the detail level remains high level, focusing on categories.
Always. You only forecast at category status, never at the account code level. And we have to be smart about accuracy. Finance teams often forecast everything to the nearest dollar, which is pointless. You should reflect the expected accuracy of the forecast.
How so?
Well, the top revenue line might be forecast to the nearest $500,000, while minor expenditure lines might be to the nearest 100,000. This avoids giving a false sense of precision where none actually exists.
And the analysis aspect of this forecast isn't just passive. It's meant to be a tool for holding managers accountable, isn't it?
The graph should absolutely highlight the reasonableness of things like sales projections, but yes, they must also point out behavioral anomalies, specifically where budget holders might be hiding funds. If certain expenditure lines show high volatility or major unexpected spikes, the analysis needs to suggest that management might be padding their budget or anticipating large unapproved expenditures. It's a tool for transparency and accountability.
Finally, within this section, we have the ultimate application of the one-page rule, and this one's derived from the Toyota way, the one-page investment proposal.
This is the pinnacle of clarity driven by constraint. The rule states that all investment proposals, regardless of magnitude, whether it's a $50,000 software license or a $500 million facility expansion, must fit on a single A3 page.
Okay, why apply that iron constraint to a massive $500 million decision?
Yeah.
Doesn't that require huge amounts of context and backup?
Because the larger the document, the less clarity there is, and the fewer decision makers will truly read and understand the core logic. A 50-page investment memo can hide flawed assumptions and technical detail. By forcing the project team to summarize the current situation, the detailed proposal, the implementation plan, the controls, the detailed costs, and the return on investment all onto one page, you force clarity of thought.
You force transparency.
And logical integrity. The document becomes readable and understandable by everyone in the boardroom, instantly.
So, if we accept that conciseness drives clarity, then speed is what's necessary for action. This moves us entirely past the tyranny of the month end. Leading organizations are making decisions based on daily and weekly progress, which effectively renders the traditional monthly close almost a historical compliance exercise.
This is the cultural shift toward becoming what our source calls future-ready. The corporate accountant's job is no longer to tally the score at the end of the game. It's to provide prompt, actionable information during the game.
I like that analogy.
The ideal state is when members of the management team intuitively know, before the month is even over, whether it's going well or badly. The accountant becomes a predictive enabler, not a historical scorekeeper.
So what are the absolutely non-negotiable daily deliverables that facilitate this kind of speed?
Daily reporting has to be surgically focused. The absolute minimum is yesterday's sales reported by 9 a.m. the following day. This isn't just a number, it's a heartbeat. If your sales system can't provide this by 9 a.m., your system is broken and you're missing the window for immediate operational response.
And beyond that daily heartbeat, what specific information needs weekly attention?
Weekly reporting is critical for monitoring market shifts. This includes tracking transactions with your key customers and monitoring the sales of your top products. This is vital, especially if you've just launched a new flagship product or if a major competitor has just entered the market. You can't wait 30 days to see if the customer reacted negatively.
We also need to talk about internal project accountability, which often gets messy. I think we've all been in an organization where innovative managers start projects with great enthusiasm, but then they let them hang. They get stuck in limbo.
That phenomenon is a massive drag on productivity. The solution is weekly reporting on late projects and, just as importantly, late reports. This effectively creates a kind of shame and name list, focusing management's attention on completion. The overdue projects tracker should clearly state the original deadline, the revised deadline, and the manager responsible.
The source material even mentioned tracking overdue reports, which seems like an administrative function, but I imagine it's actually a proxy for internal friction.
It's a phenomenal managerial tool. The tracker for overdue reports should even include things like tracking version numbers and the manager's in-tray column, helping leadership pinpoint where the bottleneck for final sign-off is occurring. It highlights the cost of constant revisions and refocuses attention on the guilty party, whether that's the finance originator or the senior manager who constantly delays approval.
Let's focus on a perennial source of organizational frustration: CapEx, or capital expenditure, slippage. Everyone's seen the scenario where the critical new equipment, or the office renovation, is completed in the final month of the year instead of the first, delaying all the intended benefits.
CapEx slippage is a direct loss of benefits. The solution requires visual accountability. The report needs to visually contrast the percentage of capital spent on key projects against the percentage of the year gone. It's a simple bar chart. The project status should beat the year-gone progress bar.
So if half the year is gone,
If 50% of the year is gone, the project must be 60% complete. If it's lagging, it forces immediate action from the executive team.
and the second key CapEx headache is controlling budget overruns. How do we make sure these are surfaced immediately rather than discovered too late to react?
Transparency has to rule. You need a system that tracks and reports forecast overspend or underspend immediately, even if the overrun is still unapproved. You can't wait for formal approval mechanisms to kick in. This provides the board with time to act.
They can be proactive.
They can proactively decide to require a formal application for the additional expenditure now, or they might choose to defer the decision until the magnitude of the overexpenditure is clearer. It shifts the entire conversation from reactive crisis management to proactive risk management.
Okay, moving to cash flow forecasting. This is the ultimate forward-looking metric, but it's notoriously error-prone and complex, often because organizations don't use adequate historic data.
That's where we bring in the wisdom of strategic foresight. There's a wonderful quote from the futurist Paul Sappho. He said, "The best way to gauge the present against the future changes is to look back twice as far as you look forward. This informs our need for detailed, long-term historic data to spot reliable trends."
I love that quote. So using that principle, what are the building blocks for creating a robust daily cash flow forecast?
Okay, first, you must enter the certain figures first. This provides a reliable, non-volatile foundation. Fixed payments, rent, payroll, taxes, loan servicing are highly predictable. Then you isolate the expected cash flows from your major customers, those over 10% of sales, and any direct debit customers or suppliers. This provides a guaranteed foundation for the short-term forecast.
And applying Sappho's rule, how much historic data do we actually need?
We need at least the last 24 months of cash flow data, and this historical data must be categorized identically to the forecast categories. This allows you to generate robust trend graphs instantly, which is the only reliable way to understand the seasonal fluctuations in your cash cycle. That historical view, categorized correctly, is worth its weight in gold.
What about the appropriate time frame for the forecast itself? Given the focus on speed, a monthly view must be totally inadequate.
For cash flow, the month end is irrelevant because a liquidity crisis can happen on any given day. You have to forecast daily for at least week 5 and then weekly up to week 13. That's 3 months of high granularity focus. Modeling in month is acceptable from month 4 onward, and that long-term view should ideally be automated from your main accrual forecasting model to reduce manual input.
And we have to reiterate the tooling point here. Can the finance team still get away with a custom-built
Core cash flow forecasting necessitates a specialized forecasting application. Excel is inherently inadequate for the level of dependency mapping, data management, and historical trend analysis required for an accurate daily cash flow forecast. If it's your core survival metric, it needs a robust, specialized system, period.
We've repeatedly stressed that reports have to be error-free to build and maintain management trust. So now we need to dig into the specific, practical, and visible mechanisms that ensure that comprehensive quality assurance.
Yes, let's do that.
Let's start with the low-tech, high-impact approach to checking internal consistency. This sounds like the finance team's secret weapon.
It is the ultimate QA check. The internal consistency check is mandatory for all multi-page reports. You physically mark all the pages, say 1 of 5, 2 of 5. Then, for every single number that appears elsewhere in the report, in a summary table, a graph caption, a box, you write the page reference next to it, and you initial it to confirm you've checked that the number is identical on the subsequent page.
The genius isn't just performing the check, though. It's making the process visible.
Exactly. This QA document, full of references and initials in red ink, should be intentionally left visible, maybe on the table when the report is presented. When the CEO inevitably asks what this marked up document is, you explain, "This is the documented quality assurance process we perform every single time we issue a report to you." This doesn't just check for accuracy, it builds immediate visible credibility in the finance function.
Next up, there's the two-person read-through for important reports. Why is a human reading superior to just using the text-to-voice functionality we have built into modern software?
Text-to-voice is great for catching typos, but it cannot replace the human interaction for readability and narrative flow. The originator reads the report aloud, while a second person follows along on another copy. The process of hearing the words allows the writer to check the dance of the words, the rhythm, the grammar, and the narrative flow. It catches awkward phrasing, confusing sentences, and logical gaps that a silent read-through or a computerized voice will almost always miss. You get the benefit of collective editing on the narrative quality.
This is a critical point that might challenge some finance people.
Yes.
You mentioned the two-gremlin rule, which suggests leaving minor errors if they're found late in the cycle. That sounds completely antithetical to the finance obsession with accuracy. How do you justify that?
The two-gremlin rule acknowledges reality. Perfection is infinitely expensive, and time is finite. If you find 2 minor non-material errors, a slight typo in a graph caption on page 4, or a minor grammatical flaw, and correcting them would delay the report by an hour, the cost of that delay, in terms of lost action time for management, outweighs the benefit of correcting the minor error.
So it's a calculated decision based on materiality and speed.
Precisely. You must never mention these minor errors, you just absorb the gremlins. However, you must always correct any typo or error in the first couple of pages or in the final recommendations. Those errors are highly visible, and they severely undermine the credibility of the entire report, regardless of how accurate the numbers are. Credibility is fragile. You have to protect it fiercely.
So with credibility established, let's move to presentation. Best practice graphics. We have to abandon personal bias, what colors we like, what chart styles we prefer, and adhere to the science of perception championed by Stephen Few.
Few's principles are the gold standard because they're based on how the human brain actually processes visual information efficiently. Most poorly designed dashboards fail because they introduce aesthetic clutter, excessive decoration, or misleading visuals. Few's rules are designed to eliminate those flaws.
Okay, let's talk about the banned list first. What visualizations must be avoided entirely?
Pie charts, radar graphs, and 3D graphs are on the banned list. Pie charts, especially, are just fundamentally ineffective because the human eye is notoriously poor at judging and comparing angles in area. A horizontal bar graph instantly communicates magnitude and comparison much more effectively than any segmented circle ever can. 3D graphs are pure clutter. They add zero informational value.
Now, for the critical design rules for graphs themselves, what is the single biggest sin that Few highlights that leads to managerial misinformation?
It's the failure to always start the scale at zero. If you truncate the y-axis, say, starting it at 10 million when you need to show performance from zero, you drastically magnify small movements in the data. This leads to a misleading view of volatility and can drive poor decisions because management believes a slight wobble is actually a catastrophic plunge. Starting at zero provides the true visual context.
And what about necessary context and precision? What are the guardrails there?
Graphs must supply adequate context. Simple speedometer graphs that just show a pointer without showing the historical context of what constitutes good or bad performance are useless. Furthermore, you have to avoid displaying excessive detail or precision. Use $5 million, not 5 million.00. Use 23%, not 23.4%. Graphs are for quick strategic summary, not for the auditors.
We previously mentioned the need to capture seasonality. Let's reinforce that point here.
This is a mandatory rule. Show a minimum of 15 months trend analysis. This ensures that seasonality in operations, the holiday boom, the summer dip, the quarterly tax cycle, is fully captured in every single graph. Relying on a 12-month window is mathematically insufficient for cyclical businesses.
And the old nemesis returns, the YTD budget line.
Yes. You should avoid displaying a YTD budget line on performance graphs. As we discussed, it represents an arbitrary apportionment of the annual plan, and it's often wrong from the start, confusing the visual narrative and diverting attention from the meaningful variance, which is actual versus last forecast.
What about grid lines and color choices for a clean visual presentation?
You have to minimize visual noise. Grid lines should be limited to about 5, and you should use a very faint medium gray tone. If you use color, use it sparingly. Our source suggests the optimal combination for maximizing clarity is black text on a faint yellow background. That combination is proven to reduce eye strain and maximize readability.
I find the rule for comparing financial and non-financial data particularly useful for clarity.
That's the use of combination graphs. When you contrast financial costs against a non-financial driver, for instance, production units against maintenance costs, you're often forced to use two different y-axes. To avoid confusion, you must color combination graph axes. The left axis color should match the series color, like blue for production units, and the right axis color should match its series color, like green for cost. This visually links the scale to its respective data instantly, aiding interpretation.
Finally, let's look at the dashboard design rules, especially since managers are viewing this information on tablets and smartphones these days.
This adaptation is absolutely essential. Dashboards must avoid exceeding the boundaries of a single screen. Requiring the manager to scroll or click defeats the purpose of the immediate one-page view. You must define what should be seen instead of demanding clicks to find hidden data. Also, avoid meaningless variety. Don't introduce different graph types just because your software has 30 options. If a simple table clearly communicates the performance, use the table.
And the final layout and use of color.
The arrangement has to be logical. Position related subjects together on the dashboard, and maintain extreme color minimalism. Use color only to highlight areas of concern, typically reserving red for critical warnings, and always acknowledging the necessity for colorblind-friendly palettes. And critically, avoid useless decoration. Every single element on the page must serve an informational purpose. Manage your white space and focus ruthlessly on what matters.
This has been a deeply practical guide to transforming finance reporting from a backward-looking historical exercise into a predictive, forward-looking operational engine. We're really talking about moving from the administrative past to the strategic future.
Absolutely. The foundational rules are clear. Effective reporting is defined by non-negotiable speed and conciseness. That one-page format forces focus. It has to rely on the visualization best practices of experts like Stephen Few to make sure data is correctly and instantly interpreted. And most importantly, the strategic focus has to shift entirely to daily and weekly data to enable timely, proactive action rather than waiting for the month-end post-mortem.
And for you, the listener, implementing these reporting disciplines is the ultimate shortcut to becoming truly well-informed. You stop drowning in obsolete detail, you escape the cost and confusion of the old binder, and you start focusing entirely on material variances, flow efficiency, and those future-ready metrics like cash flow and 18-month rolling forecasts.
We'll leave you with this final provocative thought. The framework we've explored today operates under the principle that a corporate accountant becomes future-ready when members of the management team intuitively know during the month whether it is going well or badly. If the goal of finance is to enable timely decision-making and your daily and weekly operational metrics already provide this perfect, intuitive insight to management before the month is closed, what does that ultimately mean for the entire relevance, cost, and purpose of the traditional month-end close process?
If management is perfectly informed on day 25, is day 30 just about generating historical paperwork, something to chew on as you evaluate your next reporting cycle? Welcome back to the deep dive. You know the drill. We're here to take that whole stack of source material you've pulled together,
All the research, the notes.
the articles, everything, and really just turn that mountain of information into something you can actually use, something clear and actionable.
And today, wow, we are wrestling with, I think, what has to be one of the most persistent, maybe frustrating corporate issues out there.
Oh, absolutely. It's the classic catch-22 of corporate governance, isn't it?
It really is. It's a cycle that just, it burns through talent and cash at the same time.
Right. So on one side, you have the board, and they are perpetually complaining about being overwhelmed.
All the time.
They get these massive documents, they arrive way too late, and they're just stuffed with, irrelevant detail.
And then on the flip side, you've got your senior management, your highly paid executives
Yeah.
who are spending a staggering, just a painful amount of time tied up in preparing that exact same reporting package.
Exactly. So this whole process, for a lot of companies,
Even really efficient ones.
right, even the best ones, it's just fundamentally anti-lean. It's bloated, it's redundant. And today, we're going to expose just how expensive it really is.
Mm-hmm.
Our mission here is to dive deep into exactly how the corporate accountants, the CEO, and even the board itself need to revolutionize this whole thing.
Right. How do you move from this burdensome, sort of backward-looking activity to something that's actually a strategic asset?
A concise, forward-looking strategic asset.
Yeah.
That's the goal.
And we have a really comprehensive stack of sources here that doesn't just, describe the problem. It provides a pretty detailed roadmap for the transformation.
Yeah.
We'll show you the calculus, the math you need to do to actually quantify the financial waste.
Which, as we know, is the only language a board truly understands when you ask for a big change.
It's the only language. And then from there, we pivot to the practical stuff, the solutions.
We'll get into the strategies for streamlining requests, cutting out those agonizing rewrite cycles, and moving toward truly paperless governance. But the real transformation, the ultimate nugget of knowledge we're aiming for today,
Is how to build that powerful A3 one-page board dashboard.
yes. And this means a fundamental shift in focus, right? From management metrics, your KPIs, to strategic oversight indicators.
The key result indicators, or KRIs, this is it. This is the path to high-impact, lean governance.
Okay, so let's unpack this cost issue first, because you can't sell a radical change inside an organization without laying bare the financial pain the current process is causing.
You can't.
The inefficiency has to be quantified in dollars and cents.
That's the crucial first step. When we look at organizations that are deep in this anti-lean reporting cycle, the time drain on highly paid executives is truly immense.
So what do we talk about?
Our sources show that for some, the senior management team, the SMT, is effectively writing off one full WIC, that's 5 working days, every single month.
A week a month.
A week a month, just dedicated to board paper preparation. That's what, 20% of their leadership capacity? Gone, just to communicate the status quo.
1/5 of their available time. That's staggering. And when you translate that lost productivity into cash, I mean, you expose this massive financial shockwave that I bet few directors ever truly realize they're causing.
Precisely. To overcome that inertia that it's always been done this way, thinking you have to cost the process.
Okay.
We have a very clear, very illustrative example in the source material. It's drawn from Exhibit 8.1. And this model, it's based on a mid-sized organization, say 500 full-time employees, or FTEs, that holds 11 board meetings a year.
Which is a very common structure.
Very common.
So
Yeah.
I think we need to linger on this figure because this is the leverage point for the whole transformation. Tell us what that prep cost looks like annually for this company.
Okay.
Give us the exact figures that should shock a board into action.
So based on the detailed calculations, the annual cost just for preparing the board papers for this 500 FTE organization, and this is salaries, benefits, executive time,
Everything.
everything. It can range, alarmingly, from $5 million on the low end up to $8 million on the high end.
$8 million.
$8 million. Think about that. That's $5 to $8 million spent annually, not on R&D, not on sales, not on product development, but purely on the internal mechanics of documenting the past for the board.
That figure it's just unbelievable. I mean, if you project that waste over a decade, you're talking $50 to $80 million spent simply on preparing documents.
Right.
That's an entire medium-sized acquisition. Or the budget for a decade of tech overhaul, just burned up in inefficient paperwork.
Yeah.
It fundamentally changes the conversation from, my report is too long, to, we are hemorrhaging $7 million a year.
And to really appreciate that cost, you have to look closely at how the time input is measured because, well, executive time is not the same as staff time.
No, it's not. And the sources note a critical distinction in how you calculate productive weeks, right?
They do. So for the bulk of the accounting staff, people doing the data collection, the initial drafting, the calculation uses 42 productive weeks a year.
So that accounts for holidays, sick leave, the usual.
The usual. But for the most senior executives, the CFO, the CEO, the members of the SMT, their productive time is far scarcer.
And more expensive.
And so much more expensive. We only account for, I think it's 32 productive weeks for them, which, it just recognizes the intense time they spend on things that aren't internal.
Like traveling, conferences, regulatory issues.
And yes, sitting in internal meetings that provide very little productive output. So the time they spend preparing these reports is time they are explicitly not spending on strategic leadership.
Okay, so using those constrained productive weeks, that really expensive, scarce leadership time, how much of their calendar is being eaten up by this process?
Well, let's start with the senior management team collectively. They spend between 14 and 26 days per month preparing their reports, reviewing, coordinating, redrafting.
That's like hiring 1 or 2 full-time senior managers whose only job is board paper prep.
That's exactly what it is. And that inefficiency, it just cascades upward.
I assume so. What about the very top, the CEO and the CFO?
The CEO, who should be focused almost entirely on the future and external relations, is spending between 7.5 and 12.5 working days a month on board papers.
So almost 2 full weeks out of every single month are tied up in reviewing reports about what already happened.
Yes. And the CFO, the key financial architect, is even worse off. They're consuming 10.5 to 17 working days per month on this process.
Wow. When you look at those numbers, it's not just an efficiency problem. It's a massive failure of strategy. If your CFO is spending 3 full weeks a month just reporting the past, who is looking out 6 months ahead?
That is the opportunity cost. And that's the unquantified piece of that $8 million figure. What strategic analysis, what efficiency project, what market opportunity did the CEO miss because they were locked in an office redrafting a paper on regional sales figures?
Right.
The cost calculation detailed in Exhibit 8.1, that is the primary tool to get the board to buy in because it shows them the steep price of their current anti-lean process.
So beyond the financial cost, what's the practical day-to-day result of all this time being wasted?
The primary result is just a fundamental operational failure in governance. I mean, first, papers are late.
Of course.
The board meeting is often held with papers sent only a day or two before, which gives directors no time to absorb anything. It leads to a really superficial review.
And then the meeting itself is compromised.
Totally. It gets sidetracked by minor, often irrelevant detail because directors latch on to the few things they could read quickly.
Right. They grab onto what they understand.
Exactly. And the strategic overview, the high-level policy setting that the board is supposed to be doing, It's just inadequately addressed.
And crucially, the sources highlight that this isn't just a management failing. Directors themselves are often, the guilty parties. They're contributing directly to the waste.
That's the hard truth. They are part of the very problem they complain about.
How so?
Well, directors, often acting in good faith, out of curiosity or diligence, they'll request a format change, or they'll demand an unnecessary level of detail, or ask for some deep, expensive analysis without first telling management how much time or money to spend on it.
And a simple question turns into a massive, multi-week exercise that yields almost no strategic value.
Exactly.
So we have a clear massive cost, and we've established that the director's own unstructured behavior is often fueling the fire, which means now we have the leverage we need to sell the change.
Now we can start talking about the process revolution.
Okay, so having quantified that annual waste, let's say it's $7 million, we can now propose some pretty aggressive strategies to streamline the whole process.
Exactly. We're focusing on three things: minimizing those ad hoc requests, radically avoiding the rewrites, and fixing the meeting schedule itself.
Let's start with strategy A, scoping information requests. This goes right at that director is guilty party problem you mentioned. So what's the danger of an unstructured request?
The sources call it the charge of the light brigade effect.
Huh, I like that.
It's a perfect description, right? A heroic but strategically disastrous effort. So a seemingly simple director request like, can management look into the competitive landscape in Southeast Asia?
Seems reasonable.
Seems reasonable, but it gets passed down the management chain. By the time it hits the analyst level, the instructions have been magnified, they've been distorted.
The analyst wants to impress their boss. Who wants to impress their boss?
Right. So the analyst launches this massive 150-page global market study, burns through $20,000 of budget and 2 weeks of specialist time. The board gets this tome, and they probably spend, 15 minutes skimming the executive summary.
That's the exponential information explosion we have to shut down. So what's the fix?
The solution is process control and mandated cross-functional communication. A discussion has to happen before the work starts.
Between who?
Between three people: the requesting director, the researcher who will actually do the analysis, and the relevant general manager who's accountable for that business area. This little group, this trifecta, allows them to properly scope the exercise, confirm the data even exists, and make sure the investment is strategically worth it.
And the most crucial directive here, the one that really shifts accountability back to the director, is making them commit to resource limits up front.
Absolutely vital. This is a cultural change that has to be enforced by the chairman. The chairperson has to implement a rule. All ad hoc requests must be pre-scoped.
So the director has to commit to a maximum investment in time and money before it even starts.
Yes, they have to cap the project. They need to submit a proposal that says something like, I'd like to know about this topic. I suggest we invest no more than 3 days of analyst time and $2,000 on researching this. If it goes beyond that, management has to stop and come back to me.
That forces realism, it forces discipline, and a focus on ROI right into the request process. A powerful gatekeeper.
It is.
Okay, let's move to strategy B. Avoiding expensive rewrites. This one feels like a radical cultural shift. It challenges the CEO's reputation.
It's the hardest political hurdle, for sure,
Yeah.
because it asks the CEO to show a bit of humility, and it asks the board to suspend their judgment on, stylistic issues.
We're trying to eliminate the polish cycle?
That's the goal. You need a commitment from the board that the original report, the one drafted by the subject matter expert, can be sent, grammatically and structurally unaltered, straight to them. We're targeting those expensive, time-consuming rewrites where the report goes from the analyst to the GM to the SMT to the CEO and back again.
With everyone adding a comma or tweaking a phrase.
Yes.
But let me challenge that. The board is evaluating the CEO's strategic guidance. If the CEO sends up an unpolished, maybe grammatically flawed report from a junior staff member, how do they overcome that director's bias that, quality prose equals quality thinking? Isn't that a huge risk for the CEO?
That is the core political difficulty, and it requires the board to formally agree to a kind of cultural charter. They have to agree formally not to consider the quality of the prose or the formatting as a reflection of the CEO's competence. They have to focus on substance, the recommendations, the data, the analysis, not the style, and the chairman has to champion this view.
So empowerment in practice means those board papers are written with minimal senior management input. The executive's role becomes verification, not editing.
Exactly. The CEO is still accountable, but they're empowered to add a simple caveat in the cover memo. Something like, while I concur with the recommendations and the analysis is sound, the core report was written by Jane Doe, senior analyst.
So it gives credit, it provides context, and it signals that the CEO's scarce time wasn't wasted on formatting.
And the positive side effect of this is delegation within the finance function, which is strategically invaluable. It's a win-win.
How so?
Under this new system, the CFO delegates the presentation of routine financial results to the senior management accountant who's closest to the numbers. This frees the CFO from being bogged down in historical reporting and lets them focus on true strategic papers, mergers, acquisitions, capital structure, forecasting.
And the accountant who presents gets crucial board-level exposure.
Which is excellent career training and motivation.
That's a powerful incentive structure built right into the lean process. Okay, let's hit strategy C, changing the schedule and delivery. We have to yank board meeting procedures out of the Victorian era.
Indeed. The sources note that in many organizations, the process is largely unchanged since, Charles Dickens was writing about bureaucracy.
So what's the first step?
First and simplest, use electronic board software. Paperless meetings should be the norm, not the exception. The cost of printing, binding, and couriering 200-page board packages for 10 directors 11 times a year. It's astronomical.
And beyond just the delivery method, we need to address the frequency of the meetings themselves. If the board is truly focused on strategy, they don't need to meet every single month.
Enlightened companies are recognizing this. They're moving to bi-monthly meetings, or at most 4 to 6 times a year for the full board. I mean, the pace of strategic change doesn't demand 11 monthly meetings unless the company is in a serious crisis.
But directors still need to be engaged. How do they invest that saved time if the full board meets less?
The saved time is immediately reinvested in strategic engagement. Instead of full board meetings, directors focus on subcommittees, audit, risk, strategy, technology, which meet in the intervening months.
So they can share their specialist knowledge, maybe act as mentors.
Or, critically, they use their networks to open doors to new markets or government bodies. The board shifts dramatically from policing the past to actually influencing the future.
That brings us to promptness, the idea that the longer you allow for a task, the greater the chance of inefficiency. This applies to the board calendar, right?
It applies completely, and it exposes organizational slack. Best practice is for the board to meet within 10 working days of the last reporting period.
And why is that so important?
Because the longer the time that passes, the less urgent and less efficient the data becomes. If the board meets 6 weeks after a month end, they're reviewing ancient history. Another month has already passed, which prevents any kind of timely course correction.
So what does it take operationally to hit that 8 to 10-day window? Management has to radically compress its month-end processes.
It requires forcing parallel processing and setting hard internal deadlines, not soft ones. So, for example, instead of waiting for subsidiary A to finish its consolidation before subsidiary B starts, both get a deadline of 2 days after month end. Central finance works concurrently to consolidate, not sequentially. The pressure from the hard board deadline forces the organization to streamline its internal data pipelines.
Okay, let's give the listener the benchmark from the source material. We have this efficiency rating scale in Exhibit 8.2. If I'm a CFO trying to sell this change, where should I tell my board we need to aim?
To be considered exceptional, the meeting should be held in less than 8 working days.
Okay, that's a high bar.
It is. The realistic initial target is above average, which is 8 to 10 working days. Average is 11 to 15, and anything below average is more than 15 working days.
So if you find your organization is tracking below average, that lack of promptness is directly fueling the inefficiency.
It is. It's delaying strategic decisions, and it's encouraging management to take their time on all internal reporting.
That scale is a fantastic, quantifiable metric for improvement. It shifts the discussion from vague complaints about timeliness to a concrete goal management can actually execute against.
So now that we've fixed the process and the schedule, we have to fix the actual content of the finance report, which is often the foundation of the entire board package.
Right. We have to eliminate the common mistakes that force directors to waste their time analyzing instead of deciding.
And the sources are very clear on the CFO's role here. They emphasize that directors are, in essence, customers of the CFO.
Which implies a service mentality. The CFO is responsible for efficient information delivery.
Absolutely. The CFO's future career path and the confidence the board places in management can be heavily influenced by how well the finance function communicates. The whole purpose of the report is to facilitate strategic insight, not to showcase the depth of the general ledger.
Okay, let's run through the top 7 mistakes to avoid, drawn from experts like Graham Knocke's that seem to plague most finance reports. Mistake number 1, a failure to use important financial ratios.
This is so fundamental, yet it's consistently overlooked. Directors should not have to spend time with a calculator figuring out basic health metrics.
No.
If the board needs to know about liquidity or solvency, the relevant ratios like the quick ratio, days sales outstanding, they must be calculated, formatted, and presented clearly right alongside the raw figures. You're there to serve insight on a platter, not force them to cook it themselves.
Which naturally leads into mistake number 2.
Yeah.
A lack of interpretation. Just dumping ratios on a page without context is useless.
Exactly. Ratios have to be interpreted against targets and forecasts. Simply showing the quick ratio is 1.5 is meaningless unless you add the story.
So you need the narrative.
You need the narrative.
Right.
For example, the quick ratio target is 2.0.
Right.
We are now tracking down toward 1.5 because this month we had a substantial planned investment in capital equipment, reducing short-term cash. We project recovery to 1.8 by the end of Q3.
That interpretation turns raw data into decision-enabling context.
Yes.
Okay, mistake number 3. Meaningless graphs. I have seen so many reports cluttered with graphics that are just decorative. Or they show data that's only relevant to a department manager, not a director.
Graphics are powerful tools, but they have to focus exclusively on board-level relevance. You have to avoid cluttering reports with charts like departmental expense breakdowns or daily call volumes that are unlikely to show a material strategic change.
A useful graph shows 3 years of margin analysis. A meaningless one shows last month's consumption of office stationery.
That's it, exactly. If the graph doesn't inform the director about the long-term health or strategic well-being of the company, it should be cut.
Mistake number 4 deals with a psychological assumption, assuming total recall.
This is a major failure point. The financial story you deliver at each meeting has to be self-contained. You can't rely on directors' memories or their ability to refer back to a document from 6 months ago.
You have to remember, a typical non-executive director sits on 3 to 5 boards.
Exactly. You can't expect them to instantly recall the specific variances of your organization from the last quarter. You have to provide that context and acknowledge that not all directors are highly financially literate. You need simple, encapsulated explanations.
Okay, mistake number 5 is about the strategic placement of the finance report on the agenda. We always default to putting it right at the start because it's about money.
And that default is usually wrong. The finance report should only be the first item on the agenda if the organization is facing a true crisis liquidity failure, a covenant breach, major fraud.
Right.
Otherwise, if it's business as usual, it should be placed toward the back end of the package. And this point is absolutely critical. The board's primary function is to talk about the future, because that is the only thing they can influence.
So if they spend 2 hours scrutinizing last month's accounts, they've wasted that strategic time.
Completely.
So the goal is to shift focus to strategy, using the pre-circulated finance report as purely background context. And this is where the discipline of exception reporting comes in.
Precisely. The finance report, having been pre-read and reviewed by the audit committee, is assumed to be accepted. The board agenda should only highlight the exceptions, the things that are not as they should be, and require board attention or a decision.
And to make that work, the CFO has to work with the board to predefine the materiality threshold for what counts as an exception.
That is the key actionable step defining that threshold. The board has to formally agree on the parameters.
So what does that look like in practice?
They might agree that management will only flag budget variances greater than 5% on any material line item, or that working capital variances greater than $500,000 will be reported. By setting a clear numerical threshold, the board frees up 90% of the discussion time. The motto becomes, no news is good news, and good news does not require discussion.
I like that. Okay, mistake number 6 is poor quality reporting, which speaks directly to the confidence the board has in their key financial advisor.
Boards rely so intensely on the accuracy and professionalism of the financial reporting. If reports are poorly written, disorganized, or contain obvious errors, even simple typos, it immediately undermines the director's confidence in the CFO and the entire finance function.
Right.
The sources strongly recommend practical training for finance teams. These teams are experts in numbers, but they often struggle with the executive art of concise, error-free narrative writing for a non-technical audience.
And finally, mistake number 7 ties directly back to our earlier discussion on efficiency. Slow month-end reporting.
Yes, the later the data, the less strategic value it holds. Leading practice demands speed. The timeline has to be compressed aggressively.
So what's the benchmark?
The finance team should deliver the full internal finance report to the CEO inside 3 working days of the new month. The complete board report, the final consolidated document, should follow by the end of the first week.
And that allows the board meeting to be scheduled for the latter part of the second week, hitting that above-average 8 to 10-day promptness target.
Exactly. Speed isn't just convenience, it's a prerequisite for timely strategic intervention.
So we've fixed the process, we fixed the schedule, and we fixed the presentation of the underlying numbers. Now we hit the core transformation, fixing the content structure itself.
Right.
The goal here is to move entirely away from management papers and focus solely on governance information.
This transition is the most challenging culturally, but it's the most rewarding strategically. The board's role is governance, not management.
I love the analogy of the organization as a ship.
It's perfect, isn't it? The board needs to be up in the crow's nest, focused on the horizon, looking for icebergs, storms, new, valuable ports of call.
They should not be parking themselves on the bridge, arguing with the captain about the day-to-day rudder position or the temperature of the engine room.
Exactly. And management papers are the details of the engine room. We need severe content contraction, especially on the traditional financial statements, to stop the board from falling into that management trap.
So the level of detail has to be ruthlessly culled.
Ruthlessly. The profit and loss statement and the balance sheet should be reduced to an absolute maximum of no more than 10 lines each.
10 lines, that's it.
That's it. And if a director starts asking for more detail, the answer should be, that is available in the management accounts, but we only present material lines here.
So how do we define materiality in this context, where the goal is extreme conciseness?
Materiality is defined strictly, and it forces management to use intelligent amalgamation. For the P&L, no number is shown unless it's over 10% of total expenditure. For the balance sheet, it has to be over 10% of capital employed.
That is a harsh but necessary contraction. Can you give us an example of how that amalgamation works? What does a clever, encompassing caption heading look like?
Sure. So traditionally, you might have line items for stationery, janitorial services, office utilities, and cleaning staff wages.
Right, all separate.
If none of those individually pass that 10% materiality threshold, you amalgamate them into a single line item called office overheads. If that combined figure is material, you show it. This stops directors from asking management to explain a $500 variance in the stationery budget when the company is debating a $50 million investment.
This brings us to the core conceptual shift that underpins this entire deep dive, moving from key performance indicators, KPIs, to key result indicators, KRIs. We need to clearly define the difference for the listener.
This is where so many organizations fail. They just report management KPIs to the board and then wonder why their directors are focused on the wrong things.
So what are KPIs?
KPIs are the very heart of management. They are granular, short-term operational metrics monitored 247 or at least weekly. KPIs tell the captain how to steer the ship metrics like fuel consumption per hour or individual engine temperatures.
So if the KPIs are the tools the captain uses on the bridge to navigate minute by minute, what are the KRIs for the board sitting up in the crow's nest?
KIIs are indicators of overall strategic performance and organizational health. They tell the long-term story. They're reviewed monthly or bi-monthly. Their purpose is to answer key governance questions. Is the organization being steered in the right direction? Is the ship performing optimally? Are customers and staff happy? Is the entity acting responsibly? The KRIs help the board focus on strategic issues, enabling governance, not day-to-day management.
And the physical mechanism for enforcing this disciplined focus is the famous A3 fanfold one-page board dashboard. The A3 size, often used in lean manufacturing, is key here.
It's the destination of this whole lean reporting journey. The goal of limiting the entire summary package to one A3 page, which is twice the size of standard U.S. letter paper, is to force management to be surgically concise.
The physical space constraint means management can't cloud a problem with prose or unnecessary detail.
Right. They have to set out the issues clearly and crisply within a limited footprint. It forces true summarization.
Okay, let's review the core composition of that dashboard, based on the guidance in Exhibits 8.3 and 8.4.
Okay, so first, the required content includes our summary, 10-line P&L, and balance sheet. Second, the commentary is tightly restricted. It can't be long narrative paragraphs. It has to be short, punchy bullet points covering only areas of concern and areas to note.
If it doesn't fall into those two categories, it doesn't make the page.
It's out.
And for the vital visualization component, the source stresses using traditional graphs, but with some very specific requirements for strategic context.
Yes. The graphs have to provide trend analysis, showing at least 15 months of performance. Last month versus budget is a management report. 15 months of trend analysis is a governance report. The graphs show the trajectory, not just a static point. And critically, their titles must be highly informative. They have to explain the trend itself.
So instead of a graph just titled ROCE, it should be titled Return on Capital Employed is Recovering. The title itself gives the strategic conclusion before the director even looks at the line.
Exactly. And while management might maintain 30 or 40 graphs in their internal KPI systems, the board dashboard should only feature 10 to 15 graphs in total, and only the most relevant subset are shown each month.
Okay, this is the deepest part of the dive. We need to go through the detailed examples of KRIs provided in the source material. These are the specific strategic nuggets our listener needs to build their own governance dashboard. Let's start with one that goes beyond finance: staff satisfaction.
This is a critical KRI for any organization that believes in the philosophy. Happy staff make happy customers, which make happy shareholders. If staff satisfaction is dropping, the board needs to be alerted immediately as it predicts future performance issues. This KRI should track rolling survey results, not just a single snapshot annual survey.
And the example chart in the source is powerful because it doesn't generalize. It highlights a specific operational problem.
It does. It shows that overall satisfaction is stable, but there is a distinct, deep concern specifically in Division 3. This immediately focuses the board's attention, leading to a strategic question. What is management doing to address the retention risk in Division 3, and what impact will this have on our Q3 deliverables?
It moves the board from asking about salaries to asking about strategic risk mitigation.
Precisely.
Okay, next up, a fantastic indicator of continuous improvement success: expenses as a ratio to revenue.
The board is deeply interested in the effectiveness of tech investment and CI efforts. This KRI tracks whether operational costs are steadily going down as a percentage of revenue over time. If you invest millions in a new ERP system, this ratio has to show improvement. If that line isn't trending favorably over 15 months, the board needs to know why those efforts are failing to deliver.
It forces accountability on large capital projects.
It does.
Customer satisfaction is standard, but the way the sources suggest reporting it is highly nuanced. It focuses on different customer groups.
You can't treat all customers equally for governance. Customers have to be grouped based on their strategic importance. For example, satisfaction needs to be measured at least every 3 months for your key Tier 1 clients and the next level down.
And there's a controversial suggestion in the sources about the lowest tier of customers, isn't there?
There is, yes. The sources suggest that the lowest customer category, the one with the most disgruntled, low-value customers, should often be abandoned in terms of frequent, high-effort surveying. They're often outliers, and spending management time analyzing their perpetual dissatisfaction is just a distraction.
So you report the satisfaction trends of the top 3 critical customer levels to the board, because those are the relationships that drive sustainable value.
That's where the focus should be.
Let's move to the traditional bottom line. Net profit before tax, or NPBT. How is this elevated from a mere KPI to a strategic KRI?
Since the board is always focused on the year-end target, this KRI has to show the cumulative NPBT. It's not just last month, it's year-to-date and future-focused. And critically, this graph has to be updated with the most recent quarterly bottom-up forecast.
So the board can see where management thinks they will land.
Yes. The graph should compare the year-to-date actual against budget, against the latest forecast, and against last year's performance, giving a full strategic context.
Moving to non-financial but equally critical areas, health and safety is a major pillar of responsible governance.
Boards are intensely interested in this, not just for compliance, but for risk management, For manufacturing, the focus should be on the accident rate, and crucially, near misses the accidents that almost happened.
And for service or nonprofit sectors?
A more appropriate KRI is the staff turnover rate, as this is the primary indicator of operational instability and culture risk. The source example showing an alarming increase in accidents immediately requires strategic board input on resource allocation for safety.
We established earlier that return on capital employed, ROCE, is explicitly an important KRI. Why is this always a governance metric?
ROCE, which measures how effectively the company is using its invested capital, has always been recognized as a key result indicator. It's the ultimate measure of capital efficiency and a proxy for management's ability to allocate resources wisely. Its trend analysis showing recovery, decline, or growth is fundamental for strategic decisions about expansion or divestment. ROCE tells the board whether the entire business model is financially coherent.
And what about cash flow? That seems like a classic management metric.
It becomes a KRI when it's projected strategically. The dashboard shouldn't just show last month's cash balance. This chart has to project the organization's cash flow out at least 6 months forward.
So the board can see the impact of long-term decisions.
Right, like planned capital expenditure or upcoming debt repayments. The source example ensures the board sees a liquidity requirement far enough out to arrange financing appropriately.
And finally, capacity utilization. This is the ultimate forward-looking KRI, forcing the board to discuss major investment.
Absolutely. This involves monitoring the utilization rate of key machines or plant. The graph has to project forward at least 6 to 12 months based on current order books and forecasts.
So it focuses the board's attention on future capital investment needs.
Exactly. If capacity utilization is projected to hit 95% in 9 months, the board has to approve a capital project now to avoid a production bottleneck and lost sales next year. The source example highlights a necessary reinvestment in IT needed, which turns the discussion away from past IT spending to future IT strategy.
This entire approach, from the aggressive amalgamation of the P&L to this forward-looking capacity KRI, it seems incredibly powerful because it just solves the director's problem instantly.
It does.
And this brings us back to that perfect anecdote in the sources, the overnight success story of implementing this A3 dashboard.
It's a wonderful illustration of how to sell the change by just delivering a better product. An accountant, energized after learning about this lean concept, went home and prepared a full one-page A3 dashboard overnight.
So it wasn't that difficult.
No, because they simply recycled, updated, and strategically repositioned the high-quality graphs and summaries they had already created for previous sprawling board papers.
And the delivery of this new, lean product just bypassed all the bureaucracy.
Completely. The next morning, the accountant arrived early, intercepted the chairman before the meeting, and presented it with a simple, confident pitch. I know you don't like surprises, but I have prepared a one-page strategic summary of the organization. I think you'll find it useful.
Yeah.
The chairman, tired of the usual mountain of paper, was immediately captivated. He presented it at the start of the meeting. It was such an undeniable immediate success that the accountant was instructed on the spot to make it the first page of all future board papers.
That's how you bypass years of committee meetings and pushback, by offering a superior decision-enabling tool that instantly solves the director's main problem. Too much information, too late.
That accountant understood that substance beats style, and conciseness is the ultimate sign of respect for executive time.
So what does this all mean for you, the learner, whether you're the corporate accountant tasked with drafting the papers or the CEO trying to free up your management team?
Well, the path to lean governance is not a soft suggestion. It requires a radical two-pronged attack. First, radical process changes. You have to cost the waste to get buy-in.
You have to speed up the reporting process to be inside that prompt 8 to 10-day window.
And you have to empower your staff by eliminating those expensive, time-consuming executive rewrites.
And second, you have to achieve a fundamental content shift. You have to purge management KPIs and replace them with strategic KRIs, ensuring your board papers focus exclusively on the health, direction, and strategic capital allocation of the ship.
Not the day-to-day details of the engine room. The objective is simple. Make information consumption efficient. You're moving away from those 200-page paper packages, which truly belong to the time of Charles Dickens, to concise, decision-enabling A3 documents that focus the gaze firmly on the horizon.
And this is the final provocative thought we want to leave you with, one that the discussion about the finance report placement really revealed. The ultimate non-negotiable value a board provides is discussing the future, because that is the only thing they can influence.
If your current board papers force directors to spend 80% of their time correcting the past calculating ratios, demanding interpretation, scrutinizing minute P&L lines, you are failing in your strategic mandate. What major market shift, what emerging competitive threat, or what strategic opportunity are you missing on the horizon right now simply because your top talent is tied up debating last month's stationary budget?
So you should look at your next board agenda and ask yourself, what percentage of this meeting will focus on the unchangeable past versus the actionable future? The answer to that question should drive your reporting revolution starting tomorrow.
It really should.
That's the deep dive. We hope this gives you the tools you need to clean up the clutter, quantify the waste, and bring your board's focus back to where it belongs, the future.
Welcome to the Deep Dive. We are here to take a massive stack of research articles, expert analyses, and practical guides, and really distill it all down to the non-negotiable knowledge you need to succeed.
And today, we are tackling a beast.
We really are. It's that perennial headache, the financial ritual that strikes dread into the heart of almost every manager and finance professional out there.
The annual financial planning and budgeting cycle.
Exactly.
It is truly the universal pain point, and for good reason. I mean, it's a multi-month, often frustrating chore.
A total chore.
And it consumes vast amounts of organizational energy, it kills productivity, and worst of all, it ultimately produces a document that is often irrelevant the moment it's finalized.
The second the ink is dry, it's wrong. So our mission today is to provide the blueprint for escaping that months-long misery. We are extracting the essential foundation stones and the practical techniques needed to radically transform this process.
And we're talking about compressing the entire annual budget marathon down to 10 working days or less.
10 days. Just 2 weeks to conquer what usually takes a quarter or, sometimes even longer.
And achieving that, it requires a complete philosophical and operational overhaul. The core concept we really need to embrace, the paradox that makes all this possible, is a fundamental truth.
Which is?
The only thing certain about the annual financial plan is that it's wrong as soon as it's finished. It is, by its nature, a necessary fiction.
So if the plan is always wrong, the strategic goal has to shift. Right.
It completely changes the game.
It's not about agonizing over microscopic details, trying to be perfectly right. It's about accepting that fact and then designing a process to, get it wrong quicker.
Exactly. While still maintaining a reasonable, usable estimate, this shift focuses management time where it belongs.
On strategy.
On strategic maneuvering, adaptation, and actual value creation, rather than, endless arguments over arbitrary internal targets.
So if you are currently sitting through variance meetings, or maybe you're watching your finance team burn out, or just dreading the next planning round, this deep dive is absolutely custom tailored for you.
We are laying out 9 non-negotiable foundation stones. These are the prerequisites that promise an escape from the months of wasted effort.
And they provide the structure for a leaner, more effective financial future.
Let's do it.
Okay, let's start the argument. To sell a change, this massive, a move from 3 months to 10 days to the senior management team, pure logical arguments about efficiency often aren't enough.
No, logic rarely changes embedded bad habits on its own.
So we need to appeal to the emotional and financial drivers of change. Why is the current annual planning process so staggeringly wasteful?
Well, you have to start with the human cost. Think about your highly skilled finance team members.
Right.
They lose months, literally working late nights, weekends, holidays, all to produce a plan that they know deep down is fundamentally incorrect.
The morale hit alone has to be just devastating.
It is. Then look at the leadership. The board, the SMT, your general managers, they are all tied up in these drawn-out, often combative arguments.
Arguing about what?
Discussing a financial period that is just too far out to predict with the level of forced accuracy they're demanding. It's a ritual.
A ritualized activity that absorbs all this organizational bandwidth without delivering any real value.
And that waste immediately creates these deeply dysfunctional behaviors downstream.
Oh, absolutely.
Yeah.
When management approaches budgeting with that philosophy of you must spend what you are allocated or you won't get it next year.
Then rational budget holders become rational in their dysfunction.
Right. They start requesting funds they don't actually need right now.
But they feel they must have it just in case that crucial project comes up later, so they stockpile resources.
Which means money is locked away in these internal slush funds that could be deployed productively somewhere else in the organization.
Precisely. This inflexibility means that when a genuinely new, high-value opportunity arises during the year, say a new market opens up or key competitor falters, the organization just can't adapt quickly.
Because the funding is already tied up in these defensive little buckets.
Yep. You have your best operational talent dedicating precious time to defending a fictional number rather than actually delivering market value.
Now let's pivot to the reporting side, because this is where the sources we looked at deliver one of their most powerful critiques. There is a strong assertion that setting monthly targets based rigidly on that annual plan commits what they call one of the greatest mistakes since Luca Pacioli invented double-entry bookkeeping.
That's a huge statement.
It is a profound statement, and it really highlights the depth of the error. The mistake stems from our desire for order, We take this annual high-level forecast, and we break it down mathematically into 12 neat little monthly columns.
Sure, that seems logical. It seems logical, but the issue is that the split is almost always arbitrary, and often, as the source says, radically wrong. Market seasonality, capital projects, even just the number of working days ensures that the monthly split you generated last September is now functionally meaningless.
So when management sits down in, say, the month of June, they are reviewing performance against a target that might be closer to what the business actually achieved in November.
Exactly. And this corrupted data forces management to write generic, valueless variance commentary. We all know the phrases.
Oh, yeah. It is simply a timing difference.
Or market conditions shifted radically since the plan was approved.
Right.
So if management is tied up writing analyses that simply say the plan was wrong, you've created a reporting yardstick that fundamentally undermines finance's value proposition to the business.
You become historians of failure rather than partners in strategy.
That's it. It's exact.
So the logic for change is compelling, but, logic alone doesn't sway organizational inertia. We need the dollars.
You always have to cost the pain.
To really sell this transformation, we need to cost the pain. So, based on the detailed calculations presented in our source material for a typical 500-person organization, what is the estimated annual cost of this inefficiency?
The cost is, it's staggering, based purely on personnel costs, so the time wasted by highly paid individuals. The estimated annual cost of this traditional, drawn-out process is between $1.2 million and $1.7 million.
Per year.
Per year. This is the organizational tax you pay just to produce that flawed annual document and then track meaningless variances against it.
$1 million plus annually, just for a chore that we all acknowledge is incorrect and often demoralizing. That should stop any SMT conversation cold.
It should, and that's why you have to stress the long-term perspective. If the organization chooses to do nothing and allows this inefficient process to continue,
You're looking at.
the 10-year projection shows a total investment of between $12 and $17 million into this outdated, low-value ritual. That is the true inertia tax. And that money could fund innovation, capital projects, or, competitive staff retention.
We need to see where that time is being swallowed. Can we break down the workload? Who exactly is carrying the biggest burden in terms of weeks spent on this?
Yeah, the time breakdown is crucial for communicating this to the SMT. Your general managers, the core drivers of the business, are estimated to spend collectively between 8 and 14 weeks every single year.
Doing what?
Engaging in budgeting, rebudgeting, reporting, and reforecasting. That's up to 3 months of their time that could be spent solving customer problems or driving market share.
And what about the top leadership? The C-suite?
They're not exempt. The CEO and the CFO, they spend between 4.5 and 7 weeks each annually on this process.
That's nearly 2 months of the most expensive and strategically valuable time in the entire organization, just dedicated to internal process management.
Right. But the real sinkhole, the place where the most potential is just wasted, is at the budget holder level.
That's where the numbers get truly eye-watering, I imagine.
They do. The source estimates budget holders spend a staggering 400 to 560 weeks annually across all phases.
400 to 500 weeks.
Yes.
Across initial budgeting, mid-year rebudgeting, monthly reporting against the budget, and continuous reforecasting of the year-end result. I mean, that is hundreds of person weeks that need to be unlocked and redirected toward core business activities. This cost analysis is really the blunt instrument you need to force change.
Okay, so we've convinced the SMT that they're wasting up to $17 million over the next decade. The urgency is there. Now we need the blueprint for the 2-week escape plan.
The how.
The how. And you said these 9 practices are non-negotiable prerequisites. If you don't lay these foundations, the two-week sprint simply won't work.
That's the critical point. You absolutely cannot build a streamlined structure on a shaky foundation of old habits. These 9 stones, they tackle the philosophical and the structural issues first. Let's start with what you call the most important philosophical shift. Foundation stone number 1. Separate targets from the annual budget. This is the reality check.
It's fundamental because boards and management teams, they constantly conflate two distinct concepts. The stretch target, which is what the organization wants to achieve for aspiration and bonuses.
Right.
And the planning process, which is about what is realistic based on current capacity and market conditions. Planning must always relate to reality.
So if the board demands, say, 20% growth, but management objectively looks at the pipeline and says, look, we can only do 10%.
Forcing the plan to show 20% growth just creates an immediate piece of organizational fiction, a lie.
And that fiction is sustained because performance bonuses, especially for mid-level managers, are so often pegged directly to hitting that internal plan regardless of what the market is actually doing.
Precisely. This encourages management to sandbag or manipulate the numbers to create an achievable target just to ensure their bonus payout. The sources argue pretty strongly that performance bonuses should ideally be pegged to market performance.
How you did relative to competitors.
Exactly. How you performed relative to competitors or a basket of relevant indices, not against a flawed internal plan. Removing that manipulation is step 1 to getting budget honesty.
But how does management then have that necessary yet difficult dialogue with the board when they know they can't hit the desired target? How do you report that shortfall?
Management has to report the performance gap. They present the realistic forecast, the 10% growth based on what they can actually do. Then they report the gap between that realistic forecast and the board's aspirational 20% target.
So by reporting this shortfall, management shifts the burden onto the board.
It does. It effectively says, this is what we can do now. Where do you want us to strategically invest to find the missing profit?
It forces the board out of the operational weeds and back into strategy.
Yes. They have to address closing that gap strategically, maybe through M&A, significant price increases, or investing heavily in new product development that wasn't previously costed. It prevents the annual charade.
And we need to describe what that charade looks like. I mean, we can't show the graph from the source, but it's a perfect visual of corporate dishonesty.
Right. So imagine a chart showing performance against the target line. Management forces the initial plan to meet that aspirational target, so the line is flat and high in the first quarter.
Okay.
In the subsequent quarterly reforecasts, management maintains this facade. They keep promising the same high target, even as reality is screaming otherwise.
And just kick the can down the road.
They kick the can down the road until the final year-end reforecast, sometimes performed in March of the following year, where the truth, that inevitable, sharp, ugly shortfall, is finally revealed.
Separation forces timely action.
It does. Reporting the gap in the beginning compels the board to solve the problem immediately, not a year later when it's too late.
Okay, moving to foundation stone 2. Bolt down strategy beforehand. This is about not letting the financial planning cycle start before the strategic direction is actually clear.
Strategy has to precede finance. If planning starts while key assumptions, like whether you're entering a new market or launching a high-risk product, are still vague, the finance team just ends up planning multiple scenarios unnecessarily. It's wasted work.
So what do leading organizations do?
They tackle this head-on. They hold strategic workshops, usually off-site, facilitated by an experienced external professional, to set those key strategic assumptions before the planning round begins.
And the source material here, it draws heavily on the philosophies of Jack Welch and Jim Collins. The idea being that great organizations don't have these huge, dense strategy plans.
Yeah, they have focused ones. Jack Welch, during his time at GE, famously stopped business units from writing those big strategic documents that no one ever read.
Right.
He mandated that the entire strategy plan had to fit onto just 5 slides. And these 5 slides provide the strategic foundation that the 2-week budget sprint will then cost out.
So let's walk through those 5 slides because they're really the blueprint for the year's financial decisions. What's on slide 1?
Slide 1 is the playing field. It describes the current reality. Deep competitor analysis, detailed market share data, and characterizing the business. Are we high value or commodity? Is the cycle long or short?
Just snapshot.
It is, and it has to include a brutally honest SWOT analysis on your key competitors.
Okay, so that's the static view. What's on slide 2?
Slide 2 looks at the recent past. What have the competition and new entrants been doing over the last year? What innovations have they deployed? Any potential game breakers? And this needs quantitative data, estimated competitor revenues or investment levels.
Slide 3 then forces introspection. What have we been doing?
Yes, the internal audit. Key product innovations we've launched, significant changes in our sales force, any gain or loss in competitiveness. This forces an honest assessment of internal capacity, which directly informs that realistic growth forecast we talked about in Stone 1.
And slide 4 brings in Jim Collins's famous hedgehog concept.
The hedgehog. This represents the organization's reliable, robust, and safe place to be. It's the core competency you find at the intersection of 3 circles.
Which are?
What you are deeply passionate about, what you can be the best in the world at, and what drives your economic engine. The strategic plan has to ensure that all resource allocation in the budget is directed towards fortifying or growing this hedgehog area.
So if a budget holder asks for a massive investment in some side project that falls outside the hedgehog,
the Financial Planning Committee immediately has a strategic reason to say no, or at least defer. The strategy provides the filter. If you're in that 3-day lockup reviewing budgets, you don't want to debate core purpose, you want to debate cost efficiency. The hedgehog gives you that guiding principle.
and the final slide, slide 5.
That one looks ahead. What disruptive technologies are on the horizon? What competitor actions could hurt us? And this leads to defining the winning move, the specific actions needed to build a bigger hedgehog or change the playing field. Locking this down beforehand ensures the financial planning process is purely mechanical and cost-driven.
Got it. Okay, next up, Foundation Stone 3. Avoid monthly phasing of the annual budget. We touched on this massive error earlier, but we need to understand the fix. Why must we hide those 12 monthly columns?
We hide them because they generate false confidence and they corrupt the reporting process. Breaking the annual plan into 12 neat columns creates these radically wrong monthly targets that undermine value every single month. The finance team is simply not equipped to accurately forecast the precise timing of customer purchases 12 months out.
But if we don't have monthly targets, how do we track performance? I mean, that seems like a basic control.
The annual plan should only present quarterly indicative splits, just quarterly totals, a 1-page summary. The monthly targets, those should be set much later, using a quarterly rolling forecasting process, which is far more flexible and responsive to real-time market changes.
So you're only ever forecasting the next 3 to 6 months in detail, where you can actually have some accuracy.
Exactly, and that immediately frees up immense time currently spent on useless monthly variance commentary. You're allowing the natural fluctuations of the market to average out, and you're far more likely to detect genuine deviations that require action.
Okay, Foundation Stone 4. The annual plan does not give an annual entitlement to spend. This is the core management philosophy shift that stops the stockpiling and slush funds.
This is critical to eliminating that dysfunctional behavior we identified earlier. Asking budget holders what they want and then giving them an annual entitlement, a lump sum they feel entitled to spend, is described as the worst form of management possible.
Because it creates that defensive use it or lose it mentality.
Right, and this is where the 9-year-old's birthday cake analogy is so perfect.
I love this one.
Imagine dividing the child's birthday cake immediately and giving them the whole thing. What do?
They eat too fast, or they lick the edges of the cake to stop anyone else from taking a piece.
They lock the resource away. But the clever parent gives the child the first slice and says, enjoy this, but if you finish it and still want more, I'll give you a second slice based on your needs.
So, applied to corporate finance, we fund budget holders on a rolling quarter-by-quarter basis based on demonstrated need and realistic expectations for the next 90 days.
Yes. Management asks, we know you need $1 million for the year, but how much do you need in the next 3 months, and for what specifically? This forces precision.
But doesn't that just shift the dysfunction? Won't managers just rush to spend all their money in Q1 to make sure they get their Q2 allocation?
That's a valid concern, and it's where the other stones come in. If their performance metric is linked to the market, not just internal spend, the incentive changes. And the lockup process, Stone 5, allows the CFO to challenge any rapid, unjustified spending that appears mid-quarter.
So let's talk about that. Foundation Stone 5. Commit the budget committee to a lockup. This is the logistical move that compresses months of negotiation into just a few days.
This is how you enforce the timeline. You have to force the question on the budget committee. Do you want 3 days of intense focus and pain or 3 months of drawn-out, draining negotiation? The forward-thinking CEO will always choose the 3-day sprint.
Who is on this small, powerful committee?
It has to be small and high level. The CEO, 2 rotating general managers to get that business unit perspective, and the CFO, they book out 3 to 5 days well in advance and sit in a lockup. No interruptions, no other meetings.
And what happens during those 45-minute sessions?
Every single budget holder comes through the door. They have up to 45 minutes to discuss and justify their annual plan forecast. They review non-financial goals, and, most importantly, they raise key financial issues. A manager might say, "My Q2 revenue forecast is contingent on the timely release of product X." This concentrated, focused interaction replaces endless email chains and spreadsheet version control battles.
Okay, which brings us to the focus on materiality. Foundation Stone 6. Budget at category level rather than account code level. This seems to run counter to the traditional finance desire for granular detail.
Because detail screens you from the obvious. We rely on that quote from Carveth Reed. It is better to be vaguely right than exactly wrong. Planning an entire year in minute account code level detail in a dynamic market is just a naive exercise.
And we illustrate this with the counting the trees in a forest analogy.
Right. The traditional budgeting way is to send 10 teams out for 3 weeks to count every single tree, only to end up with a wrong consolidated count because of errors. Exactly wrong, and it took a month.
And the helicopter way.
The helicopter way uses satellite imaging to take 5 large sample counts, averages them, and delivers a good approximation in a single day. For forecasting, that quick approximate answer is much more valuable to management.
So what are the practical rules for this? How do we apply Pareto's 80-20 principle to the chart of accounts?
The rule is strict. You should only budget for an account code individually if that line item is over 10% of the budget holder's total expenditure or revenue.
And if it's under 10%?
It must be amalgamated with other small costs until the resulting category exceeds that 10% materiality threshold. And we strongly recommend limiting the categories the budget holder has to forecast to a maximum of 12.
So that forces them to only focus on the material drivers, the things that really move the needle.
Exactly.
Okay, Foundation Stone 7. Get it wrong quicker. This is the non-negotiable timeline enforced by the CEO.
If we agree we spend months getting a number wrong, we have to agree to spend days getting it wrong quicker while still generating a reasonable estimate. And budget holders have already proved they can handle this.
How so?
Most of them only finish their current budget submission in the final few hours anyway, usually under flat.
That's true. So the new timeline has to start later in the year.
Yes. For a December year-end, don't start in July. Start the process in the second week of September. This minimizes the period of uncertainty between planning and execution.
And what is the key message the CEO has to deliver in every single communication about this?
2 things. We want a fast, light touch annual plan. Fast means less than 2 weeks. Light touch means no unnecessary detail. And the CEO has to make this non-negotiable.
All right, on to technology. Foundation Stone 8. Build in a planning tool, not in a spreadsheet. This is about professional standards.
This is a fundamental structural requirement. The source material is very adamant. There is simply no place for a spreadsheet in core financial routines like budgeting if the model exceeds 100 rows. It's just unprofessional.
Why? What's the risk?
They are inherently risky, they lack audit trails, they are prone to hidden formula errors that just propagate, and they're incredibly difficult to maintain. A robust, dedicated planning tool is essential. And the good news is that modern tools are far more affordable and accessible now.
But what if a company can't implement a new tool in time for this year's cycle? What's the immediate stopgap advice?
If they absolutely must use spreadsheets, they have to simplify dramatically. Use macros or security to hide all the rows not required for the category-level budgeting. Hide the monthly columns, forcing quarterly inputs. And leverage the general ledger for final consolidation, not manual aggregation of spreadsheets.
Finally, Foundation Stone 9. Plan with months that consist of 4 or 5 weeks. This addresses the structural hindrance of the standard calendar.
The standard calendar just compromises forecasting. The number of weekends and weekdays differs month to month, making direct comparisons and modeling very difficult.
So the solution is the 4-4-5 quarter.
Exactly. You design the budget models based on a rolling 2 4-week months and 1 5-week month in each quarter. This structure ensures every quarter has 13 weeks, minimizing variance and simplifying calculations dramatically.
And how does that specifically help with modeling?
Think about revenue and payroll. Revenue is easier because you have complete weeks. Payroll is simplified because you're always calculating either 4 or 5 weeks of salary. Property costs, things billed monthly, can also be automated much more accurately.
That seems like a big change to internal reporting.
It is for internal financial reporting, and it's highly effective. The source strongly recommends talking to your GL supplier to find other sophisticated users of 445. They will testify that once a business migrates, they would never go back. The accuracy gained is just immense.
So we've laid the 9 foundation stones. That's the framework for the 2-week sprint. Now we need to populate this fast, light-touch plan with the most accurate input possible. We start with sales, forecasting demand by major customers and products.
It's the 80-20 rule, but applied with surgical precision. If 80% of your revenue comes from 20% of your customers, that's where your intense forecasting effort must be focused.
Then the rest.
The rest of the customers and products should be grouped into meaningful categories and modeled simply, based on their historic relationship to the big accounts. You free up capacity by accepting approximation on the small stuff.
The key to getting those major accounts right, though, is talking to the right people. And this is where the source shares a really illuminating anecdote.
That anecdote is critical. A finance team was trying to get accurate demand forecasts by speaking to the major customer's headquarters staff, and the forecasts were still frustratingly error-prone.
So what did they do?
When they dug deeper, the realization was profound. If you want accuracy, you need to speak to the people who actually place the orders. So they shifted their focus to contacting the procurement managers responsible for specific capital projects at those customers.
That's a fundamentally different conversation, isn't it? You're moving from a generic, what do you think you'll buy, to what projects have you funded and when do the materials need to arrive?
Precisely. By delving deep into their main customers' businesses, sometimes even getting electronic order data for confirmed projects, the finance team found their sales forecast accuracy increased 7-fold.
Wow.
It wasn't about complex modeling. It was about shifting the contact point from vague headquarters staff to the specific project buyers with concrete timelines and committed budgets.
This quest for external, unfiltered accuracy leads us directly into a powerful strategic concept: the wisdom of the crowd.
Yes, popularized by James Surowiecki. The fundamental concept is that a large, diverse group's aggregated answers are often superior to the answer from any single expert, no matter how seasoned.
Why is that?
Involving a crowd in forecasting has several benefits, but the most important is behavioral. The crowd is less motivated to forecast what management wants to see, so it mitigates the optimism bias you get from a small team of internal sales experts.
And the crowd processes an unlimited harvest of data.
Right, correct. A few sales experts can only process what's in their CRM reports, and they're inherently optimistic. The crowd, however, processes limitless real-time trend information.
What kind of information?
They see unsold products piling up in the warehouse, they hear customer comments about pricing, they note the mood of the sales team over lunch. They collectively generate a more sober, accurate picture.
So how do we practically implement this during the 2-week cycle? You can't ask 500 people to fill out a budget. This is where the Best Buy example comes in.
You set up a controlled experiment. You generate 2 distinct forecasts. One is produced by your small team of sales experts, the traditional method. The second is generated by a selection of sages, say 20 to 30 people chosen from diverse non-sales roles, logistics, marketing, operations.
Okay.
You give the sages the same historic data, limit their task to forecasting only the key category lines, and you promise them a prize, a substantial cash bonus, or a team dinner if their aggregated forecast proves to be more accurate than the expert forecast after 6 months.
And the prediction is that the experts will eventually plead to merge their forecast with the crowd's.
In every documented case of this experiment, the expert team, after realizing the crowd's sober assessment is consistently more accurate, eventually asks for the 2 forecasts to be merged. It just institutionalizes accuracy.
Let's move to the second major cost input: accurately forecasting personnel costs. For most organizations, this is 30 to 60% of total expenditure.
And the primary financial flaw to avoid here is huge. Never, under any circumstance, give budget holders last month's payroll total and ask them to multiply it by 12.
Why not?
That number is pure garbage. It includes one-off costs like long service leave payouts, and it misses positions that were vacant but authorized. You're just multiplying a flawed number by 12.
So the process has to be centralized and automated by finance, but executed by the manager.
Exactly. The finance team prepares a precise schedule of every current staff member, with salary records pulled directly from the HR system. The manager's job is critical. They review this list and only enter known changes.
Known leaving dates, salary reviews.
Right. They enter known leaving dates, any salary review percentages, and project bonus allocations. For new authorized staff, they just enter the likely start date and salary. The manager is focusing on the operational reality, who is actually going to be at the desk.
And the planning model handles all the complex year-long calculations.
The model does the heavy lifting. It calculates the monthly and quarterly figures automatically, including local taxes and benefits. And since we're using quarterly funding, the manager sees the impact on their quarterly expenditure, not 12 confusing columns.
The source also suggests a helicopter way for handling the variable items, like temps and contractors.
Yes. After the model has calculated the precise fixed costs, the budget holder forecasts the total permissible employment costs for their department, their ceiling. The difference between the fixed costs and the ceiling then becomes the balancing item for temps, contractors, and interns.
Because precision on those variable costs isn't really possible anyway.
No, they flex constantly, so the high-level helicopter approach is sufficient and fast.
Now for the costs that should be fully automated by the finance team. Automation of expenses. Why should budget holders not be wasting their 3 days on these?
Because budget holders often misinterpret historic trends, and they aren't responsible for large organization-wide contracts. For speed and consistency, finance should calculate and lock down categories based on standardized data.
Things like
Communication costs, property costs like rent and power, fleet costs, depreciation schedules, and miscellaneous costs. The manager has no control over the depreciation schedule, so they should not spend any time inputting it.
And finally, a highly specific automation area that saves countless hours. Automated travel and accommodation.
We want to eliminate the endless hours budget holders waste searching the web for imaginary special deals to justify their annual plan. This is low-value, high-effort work.
So what's the solution?
Finance sets up a simple internal calculator tool within the planning system. It uses standard average costs for the top 10 travel routes, standard accommodation rates, and standard per diem allowances, all based on recent actuals.
And the budget holder just inputs the basics.
They input the date range, the staff count, the destination, and the number of nights. For non-standard travel, they use a generic code like Flights Other, which defaults to a standard $300 return fare. It's not perfectly right, but it's generated in seconds, it's a good approximation, and it saves dozens of hours.
This entire process hinges on that 3-day data entry window for budget holders. So implementing this lean 2-week process requires careful, almost military orchestration. Let's detail the required pre-work before the sprint even begins.
That pre-work is the foundation for success. The finance team has to complete these tasks before the official 2-week cycle starts. First, the entire planning model has to be amended to incorporate all 9 foundation stones.
Category-level budgeting, the 4-4-5 quarter structure.
All of it. The new personnel section, everything. Second, the high-level sales forecast has to be generated and sense-checked. Third, current personnel details have to be pulled from HR and inserted into the payroll section. And fourth, all historically based categories, depreciation, property, communication, have to be calculated, automated, and locked down by finance.
So the budget holder sees these as fixed inputs, not variables they need to calculate.
Correct.
Once the system and the inputs are ready, change management becomes paramount. You need internal buy-in, so you have to hold a focus group workshop well in advance.
The purpose is twofold. Air all the likely objections in a controlled setting, and secure agreement on the new foundation stones and the radical time compression. You need the budget committee, business unit heads, management accountants, and a selection of experienced budget holders in that room.
And this is where they conduct a post-it re-engineering exercise. How does that work?
It's a powerful visualization tool. You use different colored Post-it notes to map every single step of the old months-long process. Then, side by side, you map the new 2-week lean process. The contrast is usually stunning.
It really shows the waste.
It highlights wasted steps and forces attendees to actively agree on the streamlined flow. The output of this focus group has to be a collective green light to sell the concept to the SMT.
Given that the data entry window is compressed to only 3 days, they will need immediate one-to-one assistance. So finance needs to expand your support team dramatically during those 3 days.
If you mandate that managers compress months of work into 3 days, you must provide the necessary high-touch support to prevent frustration and failure. This means mobilizing every resource available.
All hands on deck.
All hands on deck. Get all qualified accountants involved. Even the CFO should be helping. Ask your external auditors if they can loan audit seniors for remote locations. Hire temps with budgeting experience. Utilize capable senior accounts payable staff for smaller budget holders.
It's a deliberate, intense, 3-day surge of support.
It has to be. And for remote locations, leverage technology aggressively. Offer one-on-one training sessions via live webcast or virtual meetings. No manager should be left confused or unsupported during that short, high-pressure window.
The final step is the official communication, the compulsory briefing workshop. And the sources are very clear. Never just issue budget instructions via email.
Budget instructions are universally ignored or misinterpreted. A compulsory briefing workshop or a mandatory webcast for remote staff ensures everyone hears the mandate directly from the top. It removes any ambiguity.
And the CEO's role here is absolutely critical. What are the 3 non-negotiable points the CEO has to make crystal clear?
First, the CEO must reiterate the dual mandate. The process is fast, light touch. Second, the CEO must state unequivocally that late forecasting will be a career-limiting activity. This message has to be delivered clearly. And third, the CEO must personally explain the level of detail required, only material categories, no monthly breakdown.
And the presentation itself has to be a how-to, not just a why.
Oh, absolutely. Show them the new planning tool live. Walk them through the simplified screens. Explain why certain categories are automated and locked down. It's not about hiding information. It's about finance being better equipped to forecast those trends. This transparency, combined with the mandate and the promise of support, is what secures cooperation.
This has been a transformative deep dive into escaping the budgeting nightmare. The central philosophical shift is simple but revolutionary. The annual budget is wrong the moment it's published, so you should spend less time making it.
We are replacing months of agonizing detail with 2 weeks of focused, strategic approximation.
And operationally, this whole blueprint is about shifting management incentives. It moves the focus from chasing an internal, manipulated annual target to quarterly funding based on demonstrated need.
That essential separation of stretch targets from realistic planning is what unlocks true efficiency.
We started by costing the pain. $1.2 to $1.7 million annually for a 500-person organization to get the number exactly wrong. That translates to a $17 million inertia tax over a decade.
And we have provided you with the 9 foundation stones and the specific processes needed to reduce that cost dramatically and release significant management time for value-adding work.
So the question you must now confront is, what is the emotional and financial cost of getting that number exactly wrong year after year in your specific organization? If the cost is measured in millions and in lost management hours, the cost of doing nothing is immense.
And here's the final provocative thought raised by the sources for you to consider. The future of financial planning, most experts agree, lies in a complete transformation to quarterly rolling planning, which replaces the fixed annual plan entirely.
Right.
However, a full implementation of rolling forecasts takes significant time, often 9 months or more.
So the real question isn't whether to change the annual plan.
The real question is whether radically streamlining the annual plan using these 9 foundation stones is the first essential and necessary step toward that full future transformation into a continuous process where long-term rolling forecasts are the norm.
The 2-week budget isn't the finish line.
It's the immediate, achievable starting point for a truly flexible financial future.
Thank you for joining us for this deep dive. Go forth and get it wrong quicker.